Welcome back to Squawk Box. Let's get the latest on the 2024 race for the White House and what we are learning about the Harris economic plan, which is due out later today. Joining us right now is Jonathan Martin, Politics Bureau Chief and Senior Political Columnist. I want to thank you for joining us. What do you think we're going to learn? There's been some expectation that it's going to be somewhat vague, but there could be something
somewhat vague.
Trying to bring down prices at grocery stores and the like.
Grocery stores.
The words middle class probably 73 times, Andrew, today. Yeah, look, this is going to be heavier on vibes than substance. I think you're going to hear talk a lot about, symbolic issues like cutting costs, like her identifying with the middle class. She may refer to her own childhood where she thinks she worked for a summer during college at a McDonald's. I mean, so much of this is more biographical than it is substantive because she is new to so many American voters. Look, I think one of the things we will hear, though, that is new is a plan to try to induce home builders to build more units for first-time home buyers by rolling out a tax credit for home builders that are willing to build housing for folks buying for the first time. I think recognizing the challenge for a lot of people with housing these days.
Jonathan, do you think it would be a politically smart thing for her to get into details about tax policy or
No.
regulators or
She ain't that
all
bright.
of the things? I mean, all the questions that I imagine you may very well have for her about
She's not that bright.
her
She
economic
can't do
plan.
it.
When do you think
She doesn't
if
have
you
one.
were- if you were
Obama.
advising her,
Yeah.
when is it that she's supposed to tell the public about these things, or is the plan not to?
February of 2025, probably. I mean, I'm only half kidding, Andrew. Look, I think her entire bet is to make this race a question of, do you want the Donald Trump persona? Look, Democrats have flourished for almost 9 years whenever Donald Trump is in the headlines. When American politics is about Donald Trump and his conduct, Democrats do well. And so clearly that's going to be her strategy. And then you overlay that with some reassurance based upon her biography and her messaging that she is somebody who was willing to hew to a more centrist political persona. And I think that's really the campaign. Yes, she'll put some meat on the bones on policy. She's going to have to, I think, just to get by for the next 80 days. But I really think most Democrats want to make this about, do you want Trump talking, as he is given to this or that for the next 4 years in your living room, and the bet is that most Americans will say no.
Okay.
One of the big issues, though, is if you have no sort of concrete policy, it gives you flexibility, but also it prevents the sort of full-on critique of whatever that plan is. Does that become problematic at some point when people say, I need meat on the bones?
I think it does if we see more activity like we did 2 weeks ago, obviously when you had those really unsightly unemployment numbers and a 2-day collapse in the market. And I think, that raised fears of, oh my gosh, maybe she can't run as a de facto incumbent. Maybe she's going to have to run from Biden in the White House. I think obviously those fears the last couple of weeks have been allayed because obviously that didn't presage a broader panic in the economy. So look, I think a lot of it will hinge upon where things are with the economy, with external events. We haven't talked about the possibility of a wider war in the Middle East and more instability abroad. If that happens, obviously it's going to force her to speak more precisely about where she actually stands on policy. But I think if you have a status quo or better in the economy, you don't have a wider war in the Middle East, I think her bet, Andrew, is to sort of run out the clock here and just hope that Trump, day in, day out, says things that are going to dominate the headlines, and she could put together a crackerjack campaign and beat him just like Biden did in 20.
Jonathan, Republicans are already dubbing the effort to address price gouging as price controls,
Sure.
adding to this accusation that she is a communist,
Yes.
and all that other kind of rhetoric around it. Does this backfire on her? How does this play in Peoria?
No, I think, look, it's the best thing the Republicans have going is to say that she's trying to intervene in the marketplace. Look, we told you she was even more liberal than Biden, and this proves it. They're playing the hand they're dealt. I get it. I think obviously it's not ideal when you have Donald Trump as your nominee, who heartily is a poster boy for the Wall Street Journal editorial page. So it's the best hand they have with her, and I think it sort of helps make their case that she's somehow drastically more liberal than Biden. I think the good news for her, to be totally frank, guys, she's not encumbered by a deep ideological anchorage. She's never been that way. She wants to win elections, and she wants to be the next president. She's going to do what it takes, I think, to try to accomplish that, and she's going to be largely deferential to what advisors tell her that she ought to be doing on policy and substance. It's hard to recall a presidential campaign in which both major party nominees were so little grounded in any real, ideological worldview. I think the great story in this election is that a lot of the action is going to be taking place in January and beyond of 25, more than it is today, because regardless of who wins, we don't know where they're going to come down on so many issues, economic and otherwise.
Feels a lot like Huey Long running in New Orleans for mayor, promising each district a different,
Jonathan, just
different benefit.
Right, in North Louisiana, he was a Baptist, and he was Catholic in South Louisiana.
Exactly.
Right. Yeah,
Jonathan, just going back to the grocery issue, which polls well in many respects, but even if you look at some of the articles in the New York Times, Jason Furman being quoted saying, you know what, on the math, it's a very difficult thing to make sense of. Do you think that will undermine that argument, or do you think it's a win? I mean, as I said, in the polls, it's a winning argument in some ways, but if you think about it too long, then it may not be.
Well, you don't have time to think about it too long because you've got what, 40, 45 days till early voting starts in some states or less.
But there's a disconnect too, Jonathan. I mean, she's going to sell, an economy where inflation is coming down, and then she said she's going to go after price gouging. Prices are already coming down.
In an industry with very short margins.
Yeah, well, they're not coming down. There's not going up as much. Yeah,
right,
I mean, inflation is still stinging American voters. It's just not as bad, obviously, in terms of the increase, but it's still obviously dramatically worse than it was a few years ago. And so I think the burden is still on her to say what she would do on inflation. And yeah, talking about price gouging is obviously not ideal from a sort of marketplace standpoint. But look, she's trying to sort of buy enough credibility with the voters that she is saying something, proposing something with 80 days to go here. In truth, this is all window dressing. This is all election season politics so that she can obviously, beat Trump and get to the White House. This is entirely about how do we find a way to offer just enough to the American voter to say that we're proposing something. When you and I know really the centerpiece of this election for Democrats is stop Trump.
Well, final question, Jonathan.
Sure.
We keep hearing, at least I hear privately from folks who are around the Harris campaign, that one of the things you're going to hear over time is attack more to the middle in terms of economic policy, maybe even on the regulatory front and other things. We obviously haven't seen that part yet. Do you think that she moves that way? Do you think that she moves more to the left? What do you think for those viewers who care about these issues?
Sure.
What do you think that we're going to be hearing?
I think that you'll be hearing in public a more populist positioning, again, because we are in election season. What are we going to be hearing in private when she's talking to donors? Perhaps something different. Because, look, I don't think she's a deeply ideologically liberal figure. I think she's a classic California Democrat pragmatist who is fine with the business community, who has deep ties to the business community, and I think is going to be up for grabs politically next year on a lot of economic issues. But sure, for now, for 80 days in public, I think she'll sound much more like, to borrow somebody that was just mentioned, Huey Long, than Bill Clinton in terms of economic philosophy. In terms of how she governs, Andrew, if she wins the next 4 years, I'm not sure how populist she'll be. I think she is very much open to hear from Wall Street and the business community.
That's my sense too, but we will see. Jonathan, thank you. Appreciate it. Nice to see you.
All right, coming up, Kroger is doubling down on its pledge to cut prices if its merger with Albertsons is completed. Details coming up next. And later, we have former Fed Vice Chair Rich Clarida will join us to talk about this week's inflation data and the changing calculus for rate cuts, and Jackson Hole next week. Squawk Box coming right back. Welcome back to Squawk Box. Kroger is saying it plans to lower grocery prices by $1 billion if its merger with Albertsons merger is completed. That's more than double its previous pledge of $500 million in price cuts. It's a bid to appease regulators who have challenged the merger in federal and state courts, as well as the FTC's in-house court. Kroger agreed to the merger with Albertsons in October 2022 in order to try to compete with larger rivals like Amazon and Walmart. It's a really interesting story. Coming up, the media drama that never seems to end. Now another bidder may be emerging for Paramount. We'll talk to an analyst next on how this drama works out.
NBC.
Edgar Bronfman Jr. preparing to make a new offer for Paramount Global, possibly setting off a bidding war with a company that had agreed to merger with Skydance Media. Joining us now on this development and what it could mean for Paramount, Barton Crockett, Rosenblatt Securities senior analyst. Barton, we thought this was all settled, and here we are. Do you think this could actually happen?
You know, look, I never say never, but I think it's a really long shot for anyone at this point to step up and outbid the Ellisons, the Skydance with their resources, and also, you know, get the mind and the backing of Sherry and that board of directors. So never say never, but I'd be very surprised if this actually disrupted the existing deal.
In terms of the partners that Bronfman supposedly spoke to, any surprises? I thought Roku was sort of an interesting partner to speak to. And what would you surmise could be the relationship there if this were to go forward?
To me, that is, you know, maybe the most interesting part of this whole report. Now, the presence of Roku was just mentioned. We don't know whether they're just dipping a toe in or whether they're really, you know, looking at this as something more meaningful. But, you know, obviously that platform as, you know, a really large presence, gateway portal to streaming access to your television set for Americans, the number one kind of access device. You know, they have the potential, one would think, to really rethink the bundle to leverage this. But I'm just not sure that Roku's up for a disruptive investment. They've been talking to investors about efficiency, about improving margins. Their revenue trajectory has been a little bit troubled in recent quarters. They hope it improves. You know, this is really kind of a blocking and tackling setup they've been giving to the world, not one of be prepared for a real disruptive investment from us. So, you know, I suspect that if they're there, it's more, you know, it's kind of a minor league supporter rather than someone front and center really trying to rock the boat.
Even if it's in the role of minor league supporter, does that sort of give you an indication as to where Roku's head is, so to speak, in terms of where it needs to be in this landscape?
Well, certainly. I mean, I think that Roku is leaning into improved advertising capabilities. They've got new openness to programmatic. They've got a new head of ad sales from Fox, and you know, and I think they're trying to diversify from someone that's so reliant on kind of the streamers using it as a promotional platform for the subscription services and become more kind of a mainstream advertiser. So, you know, I think that their presence here would be part and parcel of that kind of thought process. I'm just not sure that they're going to do a lot to commit their P&L and their capital structure that would really move the needle. And so it's interesting. We'll have to see what happens there.
Barton, great to speak with you. Thank you.
Great, thank you.
Barton Crockett.
It is just past 7 a.m. on the East Coast on this Friday morning, and you are watching Squawk Box right here on CNBC. I'm Andrew Russ, working along with Melissa Lee and Steve Weisman. Joe and Becky are off today. We got a lot going on, though, this morning. Take a look at the futures. Things have been moving around just a little bit this AM. As we flip it around, you're seeing the Dow now up just marginally. It had gone red. Now we're a little bit green, about 4 points up. NASDAQ, give it a point and a half. The S&P 500 off close to 4 points. A couple big stories to tell you about this morning, including that Paramount story that Melissa was just talking about. Texas Instruments, the latest company now to receive money from the CHIPS Act. It's going to get $1.6 billion in direct funding to help build 3 new facilities in Texas and also in Utah. Meantime, a bipartisan group of lawmakers seeking answers from Meta CEO Mark Zuckerberg over illicit drug ads that are taking place on his platform. They sent a letter to Zuckerberg on the matter, Meta confirming receipt of the letter, now saying it does plan to respond. Also, TikTok telling a federal appeals court that the Justice Department misstated the company's ties to China. It's the company's latest bid to prevent a potential ban in the U.S. from taking effect. Oral arguments scheduled to take place next month. That's going to be a big story. I think we'll all be watching. Meantime, Epic Games, maker of Fortnite, just out with some breaking news. And Steve Kovac is at the table this morning to tell us about it. What's going on?
Yeah, this is an important one, Andrew, because Epic Games, they're launching their first app store on iPhone and Android today. This is only happening in the European Union, but it's really interesting because you have Epic Games, one of the chief antagonists of Apple, challenging Apple on its own turf on the iPhone, competing directly with the App Store for gaming. Now, gaming is the most lucrative part of the App Store business. It's about 70% of revenues there. And this is all possible because of the EU's Digital Markets Act, which went into full enforcement earlier this spring. And it forces Apple, in part, to allow third-party app stores on the iPhone for the very first time. But the European Commission says Apple is likely not complying fully with the DMA yet. Their problem with what Apple's been doing is Apple is still collecting some fees on these third-party app stores, though those fees are a little bit less than they were before. Now, Epic says, despite those fees, it is going to be launching the store anyway. On a call with CNBC CEO Tim Sweeney told us, he said the fight is, quote, far from over. They're still going to be pushing the EC to push Apple to lower those fees. Epic's goal, though, at least in the nearer term, is 100 million installs of this new store across iPhone and Android. And starting with its own games at first, just a few of them. That includes Fortnite returning to the iPhone. Famously got kicked off the iPhone back in 2020. And it wants to eventually offer more games, but again, this is just in the EU. In the United States, they lost their case against Apple for this, so it's going to be a while. But the DOJ's antitrust case against Apple overlaps many of those DMA regulations, and that could be Epic's best hope in the US to do something similar. But this is really interesting, seeing that walled garden come down and a chief antagonist really go after Apple on its own turf.
Do you think they can hit these numbers?
It would be surprising. So one thing that they point out, Epic Games, is the install process. You have to go through like a dozen screens, warnings. They call them scare screens, meaning like if you install this, it might hurt your privacy. It opens up to malware and so on and so forth. So they see that as a barrier. First of all, not just the fees, but this whole process the user has to go through just to get the store on there. So it's going to be tough. It's tougher to do it than just, installing an app. So maybe, maybe not.
What's it look like? Have you tried? I don't know. I can't conceive of what another store looks like.
It looks like an app store, but this one is focused on gaming. And again, this is Epic Games does a very similar kind of store on PCs and Macs. They sell PC games. Think of it as an app store for PC games. Yeah, it looks just like a store.
It looks like the App Store.
Yeah.
Oh, it's another icon.
It's another icon on
I see. So you don't go into the App Store and then find Epic. You go to the Epic store.
There's
And
no,
then you
Apple, there's no Apple involved here.
Yeah.
There's no Apple involved. And then once you hit it, you click on the thing you want, and that's how.
And there's another barrier here too, besides just the wonky process you have to go through. It's when I was on this call with the Epic CEO a couple days ago, and they were saying the approval process for even just apps in these alternate stores, they said it's been taking them up to 30 days to get those apps just approved. They're supposed to look for things like malware and things like that, but it seems to be taking a longer process to get this done. So Apple is really, pumping the brakes every way they can with these regulations.
Does Apple have liability here? I mean, if you go and install a game in there and it ruins your iPhone or somehow...
That's what Apple thinks could happen.
Is that legitimate?
Potentially, we don't know. If you ask Apple, this is a privacy nightmare and a virus nightmare, and people's phones are going to be flooded with viruses and so forth. If you ask the EU, it's going to unleash a wave of innovation on the iPhone that we've never seen before.
Right.
It's only been a few months. Neither of those have happened yet.
The truth is, Apple's basically saying, look, and we've talked about this, when you buy this phone, you're buying into not just the hardware, you're buying into the whole ecosystem.
Playing our sandbox.
It's a structure. And that's what you want.
And the EU is breaking down that structure.
And the EU is breaking down that structure. And so the second you have other people building their own stores and doing all sorts of crazy things, could happen or not, and they're trying you talked about it as being slowing it down.
Yeah. Or and new fees too.
Or maybe they're trying to be careful though.
You can see it both ways. I mean, obviously,
right?
Apple.
And then there's the cost of actually, by the way, to monitor all this stuff, you have to have more people physically doing all of these things. So it actually does take time.
Yeah, there is an
I do have
review
some
process.
sympathy to this
I mean, it does open up in a way that it hasn't happened before, and I do understand why they would want to be careful with the approval process and warning users that, hey, this could happen. This opens up your phone in a way it hasn't.
And that's to prevent the liability issues.
That could be to prevent the liability,
right? Because
but it could also,
you're accepting. If they show you 100 times, if
I
you
want
do
to
this,
push back
and
on
all
you,
the
Andrew, in the following way. Is it any more cost to them to approve a game or to scrutinize a game inside of the Epic Store compared to inside of the regular Apple Store?
that I don't know, and I don't
It
think
sounds like
I
it
don't
might
think
be
they
the
need
same.
to hire necessarily a ton of more people. I really don't know the answer to that, but they do have to approve the store. They do have to approve the apps that go into those third-party stores, not in the same way they approve them for the regular app store. For example, pornography would be allowed in these third-party stores. That's not allowed in the Apple App Store. So they're, you know,
Ooh,
if there's
that's interesting.
So if someone wants to put a pornography store, in theory,
Oh, I'm
they
sure
could.
it's happening as we
I'm
speak.
sure someone's
How
thinking
much more
that.
money does Epic make now?
How much?
Yeah,
we
cutting
don't
out
know.
the middleman.
The fees are less, but
Right.
it's not. I mean, if you ask Epic, they'd want zero fees, but I mean that's never going to happen. But what the EC is having problems with Apple is, you know, they say we'll take away these fees or we'll lower these fees, but we'll find other fees to charge you because, like I said, gaming is the most lucrative part of the App Store, up to 70% of revenues. They want to protect that revenue source. Services is a huge part of their business. This is a threat to that.
Thank you, Steve.
Yeah, thank you. Appreciate it.
All right, well, coming up, we're going to talk markets and where you should be putting your money to work. And then Council of Foreign Relations President Michael Froman joins us to discuss foreign policy issues, of which there are many, including China tariffs, chance of a Gaza ceasefire. We're going to come right back.
markets and stocks. Carrie Firestone, Aureus Asset Management co-founder, joins us now. Carrie, great to have you with us. It's been quite a couple of 2 weeks here. But interestingly, we've got a lot of the old leadership back firmly in place, back above those August 8th levels, and talking about the semiconductor index, NVIDIA, Apple, Meta, Amazon, the KRE, so banks are back up there. And the yen carry trade is mostly unwound here, although there is a move back to it this, in the past couple of days. Have we de-risked? Where are we now? What's your assessment of this journey?
Yeah, hi Melissa. I would say that we had a scare. It seemed to be a panic. That was resolved because it seemed to be mostly technical and yen related and the carry trade. And so now we're about 2% back from that all-time high. That was July 21. And it's been driven mostly by the big cap names because their businesses are on track. Of course, we're waiting for NVIDIA, which reports on the 28th. But also, we've seen this big jump with consumer discretionary, which very recently was down for the year. I mean, the market is up 16%. Consumer discretionary is now up under 4%. All that has happened in the last couple of days. So that's a shift. We're seeing some money that's been moving into other parts of the market. The broadening of the market has been talked about endlessly now all year, and it hasn't really happened, but it seems to be starting to occur. This is a catalyst, and we had Warren Buffett buying Ulta, the Walmart news, July retail sales up 1% versus a much lower consensus, and Brian Nichol moving to Starbucks from Chipotle. All those ignited this rally.
What do you make of Walmart at this point? They had great earnings. Their second half guide stood still. So overall, it looks like the full year got raised, but actually it was just outperformance from the first half that was added onto their guidance. But it is the #1 stock in terms of performance on the S&P 500 retail to date. And its forward PE is like 31, so above the market multiple. Is it worth it?
Well, it's not a cheap stock here. I think that the market is really looking at the glass half full scenario where the Fed is going to lower interest rates and we do not fall into a recession. We've been in a soft landing. There's been a lot of talk about whether this softness that we've heard through earnings season, where earnings beat for the quarter, but revenues were light. A lot of the benefits came from cutting costs and margin improvement, but from every part of the economy, whether it was software, healthcare, financials. Even the tech names said that revenues were not as well, they just didn't come through as much as expected. So Walmart is a stock here that we've seen consumers were spending. They saw it all across demographic sectors. And while people traded down, they still came to the stores. They bought food. I mean, food is more of the business now than consumables or the typical retail products. But customers come to Walmart, and if they're feeling stretched, they're more likely to buy private label. They trade down, and that is exactly what Walmart is offering them. 30 multiple, that's fairly expensive. The market sells for about 19 times next year's earnings. But earnings expectations are strong there and across the S&P. The estimates are for 15% growth next year, which is a big ask. And so we have to see consumers spending money, consumers 70% of GDP. And so there I would say, kind of the North Star. If Walmart is leading, we'll see what happens in the next couple of weeks. Names like Target and across the board, we have to see retail also holding up.
Are you placing retail bets, Carrie? And I'm wondering because Walmart was talking specifically about the majority of their gains in market share came from the customers with household incomes $100,000 and more, and they're coming in, they're buying groceries, but they're also buying discretionary. And actually, the sale of discretionary goods like like pillows and T-shirts and things like that was actually flat for the quarter versus declines in previous quarters. So is that a good read through for Target or a bad one because they're actually just gaining the share?
It's unclear, I think, to the market whether it's good or bad. Target, of course, has underperformed Walmart. Target has been a difficult stock because they've mentioned this, that the consumers have not been back in force. What we know is that for 2 years, people spent their money at home, online, and then renovating their houses. Then for 2 years, they spent money on travel, vacations, experiences, concerts, restaurants. So now we may be entering a period where the spending is more at the mall or at retail because you can go to the mall many, many times for the price of a Taylor Swift concert, and that may be what's happening. We're shifting the whole sector think, the consumer spend think, toward traditional retail, and we'll see if that follows through with the other participants and companies in the field. It's a good thing that the Fed is lowering rates because credit card debt goes down and there's been an increase in delinquencies. But one name, you had Walmart, good, Tapestry, 2% growth in revenue, and the stock was up big yesterday. And we have to see if the revenues really come through over the next month or so. We'll hear more, and then there's back to school.
Carrie, great to see you. Thank you. Carrie Firestone.
Okay, still to come, Michael Froman of the Council of Foreign Relations joins us to talk foreign policy and the election. And later, the Fed has set the stage for their first rate cut in 4 years, perhaps. Well, we're going to speak to Cam Harvey, the inventor of the inverted yield curve, about the risks of recession and more.
Time now for today's Aflac trivia question. Elon Musk is the most followed person on X. Who is number 2? The answer when Squawk Box returns.
Every day.
And now the answer to today's Aflac trivia question. Elon Musk is the most followed person on X. Who is number 2? The answer, former President Barack Obama.
Welcome back to Squawk Box. As the U.S. gears up for the Democratic National Convention, voters and global leaders awaiting cues on Vice President Harris's plan for foreign policy should she get elected. Joining us right now is Michael Froman, President of the Council on Foreign Relations. Good morning to you.
Good morning.
Do you think there's a lot of daylight when it comes to the foreign policy of Vice President Harris and President Biden?
I don't think there's been a lot of opportunity for them to show daylight at this point. I think probably more will come out over time.
If you were going to speculate about what that daylight looks like, what would it be?
Well, look, I think there'll be a lot of convergence on Russia, on China, probably on trade. I think there's some sense that she's been more outspoken in terms of urging Israel to reduce the number of civilian casualties, to focus on the humanitarian crisis. But those are messages that the Biden administration, including President Biden, have been sending quietly to.
Right. She's just doing it in a more outspoken way.
I think that's probably right, but I don't think there's a fundamental difference of policy there yet. At least it has not emerged as of now. She'll have to figure out where she wants to make a difference, if she does have a different point of view than President Biden. But as of now, it's the Biden-Harris administration, and she's been a very loyal and part of that administration.
What's your sense? You said China. Where do you think she really lands on China? We were talking about TikTok, by the way, which is appealing this ruling right now about whether it's going to get removed. She has not been public, I don't think yet, actually, on the subject of a TikTok, for example.
Not that I'm aware of, but I think there's such a convergence of a consensus on China between Republicans and Democrats in terms of everyone trying to be as hard as they can vis-a-vis China. So I don't expect a lot of daylight there between her and the president.
Do U.S.-China relations worsen no matter who is elected?
You know, it's really in China's court. There's a lot that the U.S. has laid out that China needs to do to try and address the relationship. They're waiting to see what happens in the election to decide what they want to do. But the whole issue of overcapacity, of engaging in a very export-related economic recovery plan as opposed to stimulating domestic demand, that's really in their hands. And so a lot of the issues around the future of the relationship, I think, will be dependent on what happens in Beijing, not so much in Washington.
I was thinking this morning about the future of a world where the Federal Reserve cuts interest rates. It takes its foot off the neck of the economy, and the economy can grow, and the world supply chain is not able to supply it because of the barriers and the tariffs that have been put up in place, and concern about a global inflation that would come if we can't do it. Are higher tariffs coming either way, Michael?
Well, I think the Trump campaign has laid out a tariff plan,
Right.
Putting 60% tariffs on everything coming from China and 10 to 20% tariffs on everything coming from the rest of the country. And most people close to that campaign say that's really a transactional move to try and get countries to come to the table to talk about various issues in the economic relationship. But the Peterson Institute, which is a great think tank on economics, they've come out with a report saying this will cost the average American family $1,700. So it's a tax, effectively, on the American family. President Biden has kept in place the tariffs that he inherited from President Trump. And I think one question for the Harris administration, if she's elected, will be, can some of those tariffs be lifted, particularly on goods where they're not strategic, where we don't necessarily need to make T-shirts and toys in the United States, but where that is still having a tax on the low-income Americans who spend a bigger portion of their income on those kinds of products.
One of the questions we've been asking, especially about economic policy, but maybe the question should be asked about foreign policy too, is how deep the vice president needs to articulate her views even during this election process at all, because the clearer your views are, in some ways, the easier they are to at least be critiqued and or attacked. And so, does she get put in a position, is it at the time of the debates where you actually need to have a foreign policy or an economic policy that actually runs deep, or can you effectively stay at the surface? What's the best political approach?
I'm not a campaign expert. Those of us who work on foreign policy would like to think the campaigns really are determined by policy. I think it ends up being about a lot of other issues. I think some of those issues will likely come out on the campaign trail and in the debates, but particularly with this short window of campaigning, 90-plus days, my guess is there'll be less opportunity to lay out a lot of brand new policies than there will be to sort of introduce herself to the American people, and former President Trump making his case about why their character is such that they should be the next leader.
How consequential is this election for Ukraine?
I think it's quite consequential. I mean, former President Trump has said he will end the conflict in a day. That tends to be interpreted that he will make it clear to the Ukrainians that there won't be much more support coming from the United States.
They'll have to make concessions.
They'll have to make concessions, where I think President Biden has certainly been very firm on supporting Ukraine and providing them with everything possible that they need to push the Russians back out of Ukraine. And I think Vice President Harris has been close to that policy as well. So I think there's a real distinction between the two candidates when it comes to Ukraine, probably the most important one.
It's very nice to see you.
Good to see you.
Coming in on this Friday.
Thank you.
Coming up, a look at stocks on the move ahead of the opening bell on Wall Street, and later in the show, former Fed Chair, Vice Chair Richard Clarida will join us to talk about the Fed's interest rate path and recession risks. Squawk Box will be right back.
.com today.
Welcome back to Squawk Box. I'm Dominic Q with this Friday morning Movers Edition. We'll start with shares of microchip technology higher by just about a couple percent this morning. Helped along by analysts at Piper Sandler, who upgraded the chip stock to an overweight from a prior neutral. They've also raised the target price up to $100 from 90. They're citing numerous growth levers. That stock is poised to ramp up in the short term here. So microchip up 2%. Also, analysts at Wells Fargo giving Fox a big double upgrade, citing upside potential from its joint sports streaming venture with Warner Brothers Discovery and Disney. The firm is also upping the media giant's price target to $46 from 29 for the Class A shares. Those are now higher by just about 2.5% in the pre-market. And by the way, for more on those big analyst calls and other top analyst calls of the day, head over to cnbc.com/pro. Subscribers get full access to the detailed analysis of those reports. And we'll end with Applied Materials. That chip stock right now lower by just about a couple percent, despite reporting third quarter results that beat estimates. The chip equipment maker is also forecasting fourth quarter revenue slightly above expectations as it anticipates a surge in AI demand for its products. So some folks do consider Applied Materials a leading indicator, Melissa, of that chip trade. I'll send things back over to you guys.
Dom, thank you. Dom Chu. Coming up, we'll talk rates and the risks of recession with the inventor of the inverted yield curve indicator, Professor Campbell Harvey. And then new details emerging on Vice President Harris's economic plan ahead of the DNC. We'll talk about some of the issues at hand. Squawk Box, be right back.
game plan.
And now for a look at this week's economic data and how it may impact the Fed's inflation battle. Let's bring in Campbell Harvey, professor of finance with Duke University's Fuqua School of Business. Cam, thanks for joining us. Earlier this morning, I credited you with inventing the yield curve, so congratulations. That was a mistake I made.
Thank you.
But you are the person who originated the idea of the yield curve as a recession indicator, and I'd like to ask you to update us on how that's going, or not.
Yeah, so the yield curve has got a record of 8 out of 8 with no false signals going back to the 1960s. It is a leading indicator, and the lead time varies between 6 months and 23 months. We've been inverted since November of 22, and we're about in the 20th month. So again, this is a leading indicator. And I do want to contrast the yield curve inversion indicator with the so-called SOM rule, which is not a leading indicator. It's a lagging indicator, and I think people misunderstand that.
So you're saying you still have 3 months to get this right, if I'm not mistaken?
So not exactly. So historically, the lead time has been 6 months to 23 months. So if it goes 23, 24, 25, I'm not sure, that's just within what could happen.
So I guess my question has always been, Cam, and it's really a pleasure to have you on to talk about this. Does the yield curve, the inversion of the yield curve itself cause the recession? What is the relationship of this inversion to the ensuing recession?
So originally, when I published this idea in the 1980s, so it's been a long time, this indicator would pick up expectations of economic growth. So if we think about interest rates, they contain expected inflation, but also an expected real interest rate, and that's linked to expected real activity. However, recently, the model, I think, has changed, and the yield curve is more causal. So people see an inverted yield curve, it changes their behavior. So as a CEO, when you see an inverted yield curve, you're just less likely to pull the trigger on a bet the farm type of investment in the face of inverted yield curve, which is 8 out of 8. So you don't want to take that risk. So that investment is decreased. Employment, we saw these layoffs, 5–10% of the workforce. So the yield curve now is a causal mechanism, and I believe it has slowed economic growth, and it's a risk management tool.
Cam, I've heard an economist describe this moment when we're going to be cutting interest rates as the most dangerous time. To what extent does that feed into your theory here, in that when interest rates are changing and say perhaps about to go down, you actually cause more delay in investment decisions?
Yeah, so uncertainty is bad in general. So uncertainty holds back economic decisions. As for the cut, really what the Fed needs to do is to undo the damage of raising the rate too high. So they overshot, in my opinion. Indeed, they inverted the yield curve. So you talk about a causal mechanism, they inverted the yield curve and have pushed us towards slower growth. So what they need to do is quickly, and this should have happened far earlier, move the rate down, hopefully substantially, at least 50 basis points in September.
Cam, I'm curious in terms of it becoming a causal indicator at this point, because I was going to ask you, with each passing month, you have to wonder whether or not that 8-for-8 streak is going to be broken. The fact that it's moved to become a causal indicator and has actually altered how people act within the economy and has altered the path of economic growth, could that recession actually be averted at this point?
Yes, hopefully. So actually hope my indicator is wrong. So nobody wants a recession. But I do believe that you're correct, and this is an important insight, that often a popular indicator that does really well stops working. And I think that what my indicator is doing is people see it, they see the track record, it changes behavior, it actually slows growth, but in the context of risk management, this is really important. So companies are not going to be surprised if a recession starts later this year or early 2025. They're actually ready for it. And what we don't want is a surprise recession where companies have to slash their workforce. As soon as you do that, that makes things worse. It deepens the recession. So think of this indicator as actually slowing economic growth, but leading to a situation where we can have a downturn without like a hard landing. So slower growth rather than something like the global financial crisis, which nobody wants.
Cam, we have to go, but you said 15th September. How aggressively should the Fed be bringing down interest rates here?
So I will be very disappointed if they don't lower the rates by 50 basis points. Real-time inflation, if you use, let's say, Zillow or Apartment List, is 2% or below already.
Right.
So there's no excuse for not cutting at least 50 basis points. Indeed, they should have delayed the last meeting by 2 days to get that important employment data.
But I know what you're thinking about for September. I mean, over the course of this year or so, how much should they be taking off the funds? Or where should we be a year from now, in your opinion?
Oh, in the low 3 range. So 3.5.
So 200 or so off of where we are now.
A little less, yes.
Cam, I feel a little smarter this morning. Thank you for joining us.
Thank you for inviting me.
Coming up, new details emerging about Vice President Kamala Harris's economic plan if she were to be elected president. Details after the break, and later housing starts data will be released. We'll talk about the state of the industry and the issues facing homeowners after the data. Squawk Box will be right back.
Vice President Kamala Harris set to unveil a portion of her economic agenda later today, and early details, they are coming out. Who has them but Megan Casella? She joins us now with more. What's the plan, Megan?
Good morning, Steve. It's a big plan. So we now have the full details on Harris's economic agenda. It's focused in 4 parts on taxes, healthcare, housing, and food. On the tax front, just this hour, we're learning Harris is calling to restore the child tax credit and to expand it to provide up to $6,000 for families with kids under 1. She also wants to expand the earned income tax credit and reduce taxes on health insurance premiums. On healthcare, she wants to cap the cost of insulin at $35 and cap prescription drug costs at $2,000 for everyone, not just seniors. She's also vowing to increase competition in the pharmaceutical industry and to cancel medical debt for millions of people. On housing, she wants to use tax credits to incentivize construction of 3 million homes in her first term and provide up to $25,000 in down payment assistance for first-time buyers. She also wants to ban corporate price gouging in the grocery industry. So clearly here, guys, this is a left-leaning populist agenda that expands on and actually takes further some of President Biden's policies. It'll be celebrated by progressives, but it has already earned some criticism from some economists who compare it to price controls and who say it would exacerbate supply issues, especially in food and in housing. And for Trump's part, he's offering some of his own ideas this week, including cutting electricity and energy costs by half within a year by drilling for more oil. And he wants to permanently extend his 2017 tax cuts and cut regulation while imposing that minimum 10% tariff on all imports. Again here, of course, economists have concerns. The tax cuts would dramatically increase the debt, while tariffs would drive up prices. But clearly there's still a long way to go before any of this becomes reality. It does show us, though, the priorities that each candidate is carrying into November. Andrew, back over to you guys.
Thank you. Well, we're going to continue this conversation. Manhattan Institute Senior Fellow Allison Schrager and Ben Harris is the Director of Economic Policy at Brookings. Good morning to you. Listening to that report and just even thinking about the child tax credit, I don't know how bipartisan that child tax credit would be. $6,000 for folks, families making under $100,000. It equates to about $500, obviously, a month. Allison, what do you think?
Well, I mean, it's a sad day for economists. I mean, these are not policies that, a lot of economists would support. I feel like what's missing in all of them on both sides is any real interest in growth. What we're just seeing is, ways to sort of give a lot of give outs. There's no concern about debt, as I said, let alone talking about if we really, really want to bring down inflation in a sustainable way, we want to think about productivity and innovation. And I just don't see anything like that there.
Ben?
Yeah, so this is just a partial plan. I would expect that the vice president will come out with other details around innovation, around productivity, but this is aimed squarely at household costs. I think I would disagree with the assertion that economists aren't going to get behind this. I mean, economists have recognized the housing shortage as a major driver of inflation over the past 4 or 5 years. So, the vice president coming out with a plan to add 3 million new homes to the market should certainly be welcomed by, I think, most economists across the board.
Yeah,
Allison, go ahead.
But she is also putting like increasing demand more, but with all these credits. And, just because she says 3 million more units are going to be built doesn't mean they are. If we want to have more housing, we should look at the local level of relaxing zoning restrictions. I mean, that would do it without increasing the debt and do it in a more market-friendly way that would just bring prices down.
Yeah, so the federal government, I mean, I agree that local zoning laws are a big part of this, but the federal government doesn't have a ton of discretion over local zoning practices. What it does have discretion over is the tax code. And so the way I look at this plan is an extension of the Biden administration approach, which really doubles down on a low-income housing tax credit, which isn't perfect, but is one of our best tools for stimulating greater supply by home builders.
Allison, if you were queen or king for the day, what is it exactly you'd be proposing? If you were just after growth and you thought that was a winning strategy, by the way, a winning strategy for the electorate, right? Not just a winning strategy for the public.
I mean, this is the challenge, is that policies that feel popular, like particularly price controls, do tend to poll well. But I mean, I'm an economist, I'm not a politician, so in my view, it's about explaining to the population what is good, what's going to grow the economy. And to be honest, during the Clinton administration, a lot of his growth policies were popular. People were happy to see the debt reduced. And people, were a little skeptical of NAFTA, and in the end, I think it did work well. So if I were president of the day, I would get rid of a lot of the subsidies. I would get rid of a lot of the tariffs. I would extend the tax credits that encourage innovation. And as I said, sort of think more carefully about reducing the debt.
Yeah, Ben, does anybody care about the deficit here? Should they care about the deficit?
People should definitely care about the deficit. I mean, we just heard from Megan before this segment came on about how President Trump wants to extend the 2017 tax cuts. I haven't seen any plan to pay for that. Independent scores put that around $4 trillion to extend permanently. You know, that makes any of these proposals pale in comparison in cost. So, you know, I think the Biden administration has been pretty responsible on debt. The IRA was more than fully paid for. So my hope and expectation is that the vice president would continue that tradition.
Okay, we got to leave it there. Allison and Ben, thank you.
Coming up, a coincidence or master plan. Warren Buffett now owns the same number of shares of Apple as he does Coca-Cola after slashing the tech holding by half. More on what that move means and where Apple stock could be headed. And later, former Fed Vice Chair and Global Economic Advisor at PIMCO, Richard Clarida, will be our guest. Squawk Box will be right back.
Jim.
Warren Buffett now owns as many Apple shares as Coca-Cola after halving his Apple stake and even $400 million, sparking concerns or speculation that he's done selling. Joining us now is Ben Reitz's head of technology research, Melius Research. Ben, great to see you.
Hi, Melissa.
Is this any sort of verdict on Apple shares and whether or not they've peaked, do you think, or no?
Yeah, I think it was an opportunity for folks on that Monday morning when it opened up. I feel that Apple's in a generational upgrade cycle. First, the install base of phones are old, so we have that going for us, but then Apple Intelligence only works on the newer phones, and we think there'll be form factor changes as we go throughout the years as well over the next few years. So we're pretty upbeat. I know that he's sold, but I think he's got some other motivations.
There is some skepticism, though, regarding Apple Intelligence and how much of a force it will be in the upgrade cycle. If you really pared back expectations in terms of that being a driver, particularly because it's only in the highest end of the phones, what does that upgrade cycle get you in terms of valuation, if it's the most conservative estimates for Apple Intelligence?
Well, we have a bull case where within a few years we have Apple earning well over $9, even approaching $10 in our bull case. But in the historical cycles, we've seen growth that can well eclipse 20% in iPhones. But the way we look at it is expectations are actually relatively low. The street's only at mid-single digits iPhone growth this year and even less the next. So that looks very beatable. It should be a gradual upgrade cycle and then probably come to its peak in 2026, in our opinion. But even gradual is better than what we've had with the lack of growth. And it's a very profitable product. So we are really upbeat. I think it among the Mag 7, it's pretty good visibility and the growth's accelerating.
Yeah. For NVIDIA, we're awaiting the earnings on the 28th, and I'm wondering how the story sets up. You know, on August 5th, people were really doubting the growth story within the AI sector, but now all of the stocks are pretty much back above August 5th levels, roughly. So where are we in terms of the setup going into those numbers?
Well, there's been what we call ROI fog, where everybody's worried about, is there an ROI? And ROI is the most subjective thing probably within our coverage questions lately. But we feel that NVIDIA is really still the market leader, still dominant, and they are really set up well for next year. The reason is a lot of the apps that are coming are going to start inferencing. Video is a big catalyst, so we're hoping to see that. But I think that their Blackwell concerns that there was a push out were a little overblown. You know, we think that the Hopper stuff is going really well for them in the near term, but hopefully there's no air pocket.
Ben, have you thought about when might be a time to start thinking about investing in the people that are buying the chips from NVIDIA, as to whether or not that would mean something to their bottom line?
Well, NVIDIA actually invests in some of their own customers.
Right.
In terms of investing, you mean in the other equities?
Well, no, let's say I think NVIDIA is either overblown or is fully valued here, and that NVIDIA makes a chip. And that chip is like an input into the process. Somebody's using that chip, and they're going to make money with that chip. Who's going to make money with the chips NVIDIA is making?
Well, first it's going to be the clouds. So the hyperscalers, Meta, Microsoft, Google, Amazon, they'll create tools, and then folks join their clouds and then start creating AI apps. Now, a lot of people are like, hey, I'm not using it, or I got bored with it. So what we need to start seeing is enterprises layer their data on some of the tools these companies have, including their models, and then start generating returns. What it's looking like right now is that it helps them cut costs, which means some people, which may actually help the Fed's reasoning here, but it does look like a lot of the leading tech companies are using AI to
So it's the same as 7. It's an incestuous circle here.
I do think that a lot of companies, it'll be led by tech, but a lot of the enterprises over time will be using AI to be more efficient. Customer service already looks amazing as a use case, coding, and then a lot of stuff in healthcare. I actually do some work with Mount Sinai, and you're really optimistic about what it means for healthcare and diagnoses.
In the chip race, we heard this morning that Texas Instruments is receiving some CHIPS Act money. How do you think that rollout is going, and is there going to be a better backdrop for our national champion in the chip sector, and that would be Intel, which has been really troubled stock this year?
Yeah. Well, look, I think that what you have to remember about the CHIPS Act is it's not just the Intels of the world. There's also TSMC, which is the leader, undisputed champ of manufacturing, and we need to get their expertise over here. They're a friend of the U.S., so they're going to be getting some money. And where I'm focused more is on the real leading edge stuff, the AI chip stuff. Obviously, Texas is a little different than a few. But remember, the CHIPS Act's also going to invest in packaging, so there's a company, Amcor, that can benefit there, as well as the entire ecosystem. So AMAT, reported it very worrisome that they may lose some China revenue, but the CHIPS Act money could underpin some growth, more growth for them, and replace that revenue.
Two very quick questions. Is Intel fixable?
It's
20 seconds.
Yeah, 20 seconds. No, look, it's been, yes, I think it's fixable. I've said before on your air, on the later show, look, this is like a Boeing kind of situation where we really need this company to work.
Right.
And it's going to be very hard to kick them out of the enterprise. However, AMD is going to gain share, and we need to see it. We need to see them stop the bleeding soon. But it should be a few more quarters of share losses.
Do you have a view on this Epic Games App Store situation?
Look, it's not surprising. It was in line with my expectations. All our work is showing that actually AI and Apple Intelligence and what Apple's doing in services may actually help the App Store, but I would view it as not a surprise given the regulation that we see in the EU, but we'll watch it carefully. But I'm actually pretty optimistic about services for Apple.
So you don't think it's going to change the dynamic? I think no one's going to be buying games on Epic's App Store as opposed to
when we talk to Apple and look at the results, it's not like users love going outside the App Store. There's a convenience, and it's secure, and it's going to work. And then you got to stop what you're doing and go outside. It's really, would you do it? It's only certain kind of high users that might actually want to go outside the walled garden, as you said in a prior segment.
Ben, good to see you. Thank
Great
you.
to see you guys. Thanks for having me.
Just after 8 a.m. right here on the East Coast. You're watching Squawk Box right here on CNBC. I'm Andrew Ross Sorkin, along with Melissa Lee and Steve Leishman. Joe and Becky are off. Got a lot of top stories to tell you about right now. We could see another twist in the fight over Paramount Global. Report saying media executive Edgar Brofman Jr. getting ready, perhaps, to make a bid for the company. Wall Street Journal reporting that partners for an offer could include Roku and Fortress Investment Group, though still a steep climb ahead, given that there would be a breakup fee, a matching right by the Ellisons, and etc. So if Brofman bids, he would be going up against that Skydance media bid, and we'll see where all this goes. Meantime, Facebook parent Meta being targeted over illicit drug advertisements on its platforms. A bipartisan group of lawmakers sent a letter to CEO Mark Zuckerberg saying they're concerned the company failing to prevent these ads from running. Meta saying it's planning to respond to the lawmakers. And Kroger now out saying that it will cut grocery prices by $1 billion after, and maybe if, really, it completes its merger with smaller rival Albertsons. It's a $25 billion transaction announced late in 2022. It's facing lawsuits over concerns it could lead to higher food prices. Kroger previously promised to lower prices at Albertsons locations by $500 million. Again, always hard to enforce these things. You say, I'm going to do X. Is there some kind of behavioral remedy?
Then later
the
they don't
FTC
do it,
says,
and-
sure, we'll allow you to do this, and,
I'm supposed to read the futures board, but I don't have a board to read in front of me.
we can get you one.
There we
it
go.
is.
Nice, right there. Or is it?
You ask
There
and
we
you
go.
shall receive.
At 8 points down on the S&P after accounting for fair value, 22 on the DJIA, and the Nasdaq down 30 points. So it's we gotten worse over the course of this morning here. Looking at treasuries, let's see, yields are down 386 on the 10, 4.03, and don't forget the 4.035 on the 2-year, because millions and billions will be made and lost on that. Let's get to Dominic Chu with a look at the other millions, billions, and trillions being won and lost just this morning before 8 o'clock, Dominic.
That's right, Steve, Melissa, Andrew. I am supposed to tell you about some of these morning movers, so let's get right to it with German pharmaceutical giant Bayer, or Bayer if you want to call it that here in the U.S. That company is seeing a surge in European trading, up by about 10.5% so far, after scoring a big legal victory here in the United States over claims that exposure to its weed killer Roundup causes cancer. A U.S. appeals court ruled for the company against claims that Bayer-owned Monsanto violated state law by failing to add a cancer warning label to those Roundup products. So Bayer up 10.5%, however you want to pronounce it here in the U.S. Shares of Estee Lauder falling almost 2% after analysts at Bank of America cut the beauty company's rating to a neutral from a buy. That reversed an upgrade that they made back in March. B of A is citing sluggish growth in China, amongst other things, as the reason for that downgrade, so those shares are down roughly 1.5%. And we'll take a look at Nike, shares of the athletic footwear and apparel giant and Dow component, rising just about 0.75% or so right now after analysts at Williams Trading upgraded that stock from sell to buy. The stock rose over 5%, you may recall, on Thursday after Bill Ackman's Pershing Square revealed a new stake in the company. worth roughly $229 million at the end of June. So keep an eye on Nike. Analyst upgrade and play today. For more on that and other big analyst calls of the day, just head over to cnbc.com/pro. Subscribers get full access to all the analysis there. Andrew, I'll send things back over to you guys. I'm supposed to toss it back over to you.
Thank you, sir. You guys have a great weekend. Want to talk more about the markets this morning. I want to welcome our guest, John Morey is the CIO and Senior Portfolio Manager at NFJ Investment Group. Good morning to you.
Good morning, Andrew.
What have you made of this, I don't know, we'll call it a wild ride, like a week and a half or now 2 weeks.
2 weeks.
2 weeks of crazy. It's almost like it didn't happen. We could almost just forget that it happened.
Maybe not, though, because actually since the July 10 data point, the NASDAQ's still underperforming the Russell 2000 value by 1,000 basis points. So time will tell if that marked a pivotal moment. And I think that one of the key, obviously, indicators has been, obviously, the inflation reading coming down. And something that I would posit is that if you look at the spread, Andrew, between the 2-year bond yield and the Fed funds rate, and to be clear, the 2-year bond yield is set by the market, right? Fed funds rate set by the committee. The 2-year bond yield has been below the Fed funds rate for now 18 months. And if you go back and you look at this all the way back to the 70s, this has generally predicted aggressive rate cuts, and that duration matters. And so I think that when you look at the setup, you have a really interesting dynamic in some of the less loved areas of the markets that are more exposed to interest expense on their balance sheets.
Okay, so what is your expectation come September in terms of what the Fed is going to do?
Well, I'll say this. The 2-year bond yield is telling the Fed they need to take 140 basis points out. Okay, so if you look at where that yield sits relative to the Fed funds rate, that's 140 basis points. And if you look back historically, they generally have taken the stairs and then had to go and take the elevator on the way down. If you go back to 2000, for example, they raised twice in the first quarter and the second quarter, and then in January of 01, they pulled 50 out. So I think they need to pull out 140, and that's based on what the bond market's saying. How quickly they do it is up to them. And what I would say is that just because you showed up late to the party doesn't mean you get to overstay your welcome. And it seems to me that we're doing that right now. So I'm a little bit nervous about the prospects that things are going to get more challenging for these companies.
Okay, so you talked about the stairs and an elevator. What about an escalator?
What about an escalator?
An escalator.
They took an escalator. They took an escalator on the way.
So for you, does that mean you think 50 basis points comes in September?
I think they should do 50 basis points.
But you think they won't?
I think they probably won't. I think they want to give the opinion that they are moving in a very methodical way, but generally that's not what happens. There's some data point that comes out, like the inflation or like the unemployment print, that really starts to jolt them. So again, I think that investors should be thinking about the areas that would be benefiting from less interest expense, and one of those areas is REITs, not very loved.
Right.
But I'll point to 2 areas that are actually beating the S&P 500 year to date that not a lot of people realize. Utilities and regional banks, both beating the S&P, which is pretty remarkable considering NVIDIA makes up such a large portion of the S&P and is powering so much of the gain. So you're already seeing the interest rate sensitive plays start working out in the marketplace. I expect this will continue.
So you're coming on our air here with a guy who's talking about a sector that's not yet fully valued with the thing about to happen.
Well,
is there more to come?
I mean, if you look at the valuation dislocation in regional banks,
right,
it is material. And something that I'd like to always point out is that what occurred in 2023, okay, with the regional banks, that was a liability crisis, not an asset crisis. An asset crisis is what occurred in 2008. This is very different. As those rates come down, that should be further alleviate that pressure on the balance sheet, and the capitalization of the regional banks is far better than it was in 2007, 2008. So I think those areas have a long way to go, Steve.
And is there a time and a place to be buying commercial office real estate, or is it too early yet on that?
I think commercial office real estate is the hairiest and the hardest to get right. And to be quite candid, I don't think you need to go there. You can look at industrial REITs.
Right.
Those are very well positioned strategically for a number of reasons. They actually will also benefit from what's going on with the AI chips in terms of robotics, automation, how they're going to work their warehouses. If you remember the scene from Indiana Jones in the last scene of Raiders of the Lost Ark, where they're putting that crate in the warehouse, think of a robotic doing that. So it'll be a very different story for the industrial REITs, I think, going forward. So I like other areas than just the office play.
Why not small caps? Small caps would probably be the #1 area to benefit from lower rates.
Correct. And one thing I would point out, if you look at interest expense as a percentage of total debt, okay, for the Russell 2000, That's the highest since '04. But for the S&P, it's only the highest since 2014.
But I don't hear you saying just go buy the Russell 2000.
Well, no, I would not do that because I think there's a lot of companies that are not profitable or not high quality and you should not own. So I think that within small caps, active management does play a heavy role. And to be quite candid, when you look at that opportunity set, there's a lot of companies that simply are not going to be able to navigate the environment. A lot of them have not been able to push through these costs to the end customer.
John, I want to thank you for coming in. Have a good weekend.
Thank you, man.
Thank you.
Coming up, we'll dive into the health of the consumer after we've gotten new insights this week in the form of earnings and retail sales numbers. Plus, later this hour, former Fed Vice Chairman Richard Clarida will join us. Stay tuned. You're watching Squawk Box on CNBC. Welcome back to Squawk Box. Taking a look at futures right now, we are set to open lower across the board at the open. The S&P looking to open down by 12 points, NASDAQ down by 50, and the Dow down by about 22. As for crude prices, we're seeing it here hover about 76 bucks a barrel, down 2.5%. And check out dollar yen. There's a lot of talk about the yen carry trade getting reloaded. My, how our memories are short. We do have it trading at 148 against the dollar.
It was so much fun before unwinding. Let's do it again.
Exactly.
New insights this week into the state of the consumer. Retail sales blowing past estimates, and Walmart posting better than expected results after yesterday's 6% gain. It's now the best performing retailer in the S&P 500. But we also saw Starbucks abruptly replace its CEO this week, in large part because it's been having trouble with the consumer. Joining us now to talk about all of this, Greg Portell, Kearney Global Markets Lead Partner. Good morning, Greg.
Good morning.
So let's just start with the top line issue here. Is the consumer dead? Is the consumer alive? What's going on with the consumer?
We've been talking about the consumer's death for a long time now, and yet they continue to surprise us quarter after quarter. The consumer, particularly the U.S. consumer, has been incredibly resilient, but that doesn't mean they're not under stress, and it doesn't mean that they're not being very selective about how they spend their money.
Okay, and Greg, when you look ahead, can the consumer keep up these kind of strong numbers?
Well, we're tracking consumer stress, and the two largest components into that consumer stress index are the economy and the way the consumers feel the economics, and geopolitical issues, both of which are intensifying as we go into the back half of the year. So the U.S. consumer, and actually the global consumers, are under enormous pressure, and that's going to make management teams have to be very smart how they connect with them.
Greg,
it'll be very difficult going forward.
I was talking to the CEO of a manufacturer here in the United States, and he said to me, "Oh, just forget the next 6 months because it's the presidential election season." Do you see any connection between the level of consumer spending either way and a presidential election season?
The consumer spending is going to be there. We would expect the holiday season to be positive. Now, what's interesting is this particular election cycle is going to be nasty, and that's going to play into consumer psyche, and it's going to play into where they spend their money, because they're going to be looking for those comforts rather than the extravagances.
Melissa and I this morning at 6 a.m., which was like yesterday, came up with 3 reasons why Walmart's doing well. Melissa, you had 2 of them.
Which is stealing share.
That was mine, stealing share from Target, and you had 2 others. One was the
I don't
consumer.
remember what they were.
The consumer
is challenged.
Challenged and ending up at Walmart.
Stepping down.
Right.
Step down.
Well, go to those 2 reasons, Greg. What's the reason why Walmart did so well?
Really 2 things. We've seen every management team, regardless of industry, really put inflation management tools in place, cost cutting. Walmart has a system to do that better than most companies. So when you look at their ability to really take cost out of the system and thereby pass it on to the consumers, they have a track record of being able to do it, and you see it in the results.
When Kamala Harris talks about price gouging in the food business, what are margins like in the food business right now? Is there evidence of gouging in those margins?
It's hard to say gouging. I mean, it's very difficult for food companies to take cost out of their supply chain, particularly when they're faced with sustainability pressures and the commitments they've made on that front. And even if you take a company like Starbucks, the cost of coffee globally is going to continue to rise. And the flexibility that food companies have to take cost out when those commodities are going up is really difficult. So it's not so much that there's gouging, it's just there's limited opportunity for those companies to take cost out unless they change formula, change pack size, and that's what we're seeing with some of those value meals in the restaurant channel.
Right. Real quick, is the problem then at the manufacturing level, and there's not much the consumer-facing companies can do, but there are some perhaps companies with price-setting power at the manufacturing level?
It's not so much the price setting, it's the flexibility in how they manufacture. If you can create ingredient flexibility, formulation flexibility, that allows you to get more price variability and then pass it on to the consumer. So it's a flexibility and agility question more than a pure manufacturing question.
Greg, thanks for joining us this morning.
Thank you.
Okay. Coming up, we are going to speak with former Fed Vice Chair Richard Clarida. Stay tuned for that. But next, we're going to go inside an effort to create a whole new category of live experiences as consumers can't seem to get enough. Julia Borston is live in Los Angeles and going to have that story. Julia, give us a preview.
Well, Andrew, it may look like I'm at an English soccer stadium prepping for a big match this afternoon, but this is actually a giant LED dome, and I am here in Los Angeles, and this dome will be full of soccer fans in just a few hours. I'll tell you how this company, Cosm, wants to shake up entertainment. That's coming up after the break.
Welcome back. We are already talking a lot about consumer spending. Now we're going to focus on one company that's betting that people will keep shelling out for live events, but in a slightly different way than you might expect. Julia Borston joins us now with a very cool story. Good morning.
Well, Andrew, right now I'm here in a dome that startup Cosm designed for immersive live content, what it calls shared digital reality, with a wall-to-wall curved LED display that's behind me. It wraps around the 750 people who could fit in these seats. Another couple hundred people can fit outside where there are more LED screens. Now, in July, this company raised $250 million at a valuation of over $1 billion from backers including investor Mark Lasry's Avenue Sports Fund, Cleveland Cavaliers owner Dan Gilbert, and its original investor, billionaire Steve Wynn's Mirasol Capital. Now, this company, which opened its first location here in Los Angeles in July, is expanding to a second location in Dallas, which is opening at the end of this month, and it's working to launch another venue in Atlanta to open in 2026. Now, Cosm has partnerships with the NBA, UFC, and Cirque du Soleil, along with ESPN, NBC Sports, Fox Sports, and TNT Sports to stream games, live stream games like U.S. Open tennis championships, NHL games, horse races, college football and basketball games, and Premier League soccer matches. Ticket prices range from $22 to, for some programs and some seats, $200, but the average ticket is $33. Now, today at noon Pacific, 3 Eastern, this venue is showing its inaugural Premier League soccer match as part of its NBC Sports partnership.
Now, we'll never replace going to the live game itself and being there, that energy, but we're going to get close to it. And we're trying to give the fans another fantastic offering to be that best version, to be their best fan and experience it like they never had before. And this notion of that third type of category, that's really what it is. It's not at home, it's not in stadium, it's got elements of both.
Now, this unicorn startup Cosm isn't the only one betting on live sports. Theater chain AMC Entertainment has been diversifying away from just movies by bringing live sports and concerts into its venues, and IMAX theaters have been showing the Paris Olympics just in this past month. So, Andrew, Cosm says it wants 30 to 40 of these venues by the end of the decade. Certainly, they're a big investment, but we'll see how full it is later today.
Julia, we're going to do something just a little technical right now. I don't know if the camera folks can do it. I don't know if the guys in the control room can do it, because I think that we can't fully see what's going on here. Part of it is that there are seats actually behind you. I don't know if the camera can pan out even just a little bit, because I think we're not. Part of it is that we have the banner at the bottom of the screen, so I think folks didn't even see right before that there are seats there. Okay, so this is, there you go. Okay, now we see what's really going on here. So this is a little bit like going almost to the Sphere or something and watching a sporting event.
It's like a smaller version of the Sphere. The Sphere has many more people. I think about 18,000 seats in the Sphere. There are 1,700 people who could fit in this venue. Between this theater here, which holds 750 people, there are more seats down there, which would feel like they're right on the right by the sort of the bottom of where the soccer match is getting set up. What you're seeing is a live stream to this this soccer stadium in Stratford, England. They're getting set up. The game will start in just a couple of hours. Outside, there are more LED screens and people can fit out there. But Andrew, just for context, they don't want to call this a theater. They want to call this a venue because they want people to treat this more like a concert where you can get up, you could cheer, you could sing along, you could go get drinks. You could see there are sort of couches up here. It's not like an official dark movie theater where they want people to sit and be quiet. So a different kind of venue.
Fascinating. And this now, I think, explains it. Once we got the pan, Julia, I think everybody understood what was going on. I think it was such a tight shot earlier that we weren't sure whether it was a green screen or what was happening, but now we all get it, and it's very cool. And I may have to go buy a ticket.
Still not as cool as the Sphere, which we can talk about next.
All right, yeah.
Julia, thank you.
Up next, we got breaking housing data. Stay tuned.
our business.
Rick Santelli's got the housing data. Rick.
Yes, housing starts for the month of July expected to be in the vicinity of 1,330,000 seasonally adjusted annualized units. Comes in on the light side. 1,238,000, a big miss here. 1,238,000 seasonally adjusted annualized units would be the lightest level going all the way back to May of 2020. So that's way through the rear view mirror. And in terms of permits, we're expecting a number around 1,420,000, also on the light side. It's under 1.4 million at 1,396,000. How does that comp out? 1,396 would be the least going back to, we are now going back to June of 2020. So on the start side, that's about down 7% or near that, considering the revision now from 1,353,000 to 1,329,000, and about down 4% on permits. Saw that just cross the wires. So these aren't terrific numbers. And if we take it all in a macro view, I'm sure Hurricane Beryl, considering construction in the southern part of the country, may have indeed impacted these numbers negatively. And in terms of interest rates, well, if you're to look at a chart of the average 30-year fix, it really started to move lower towards the end of July. A good chunk of that, of course, happening in August. So we'll probably see a bigger positive effect in the August numbers than the July numbers, and most likely we'll see the GPS get back on track and get some of those weather-related events out of this particular number. As we sit right now at 402 and a 2-year, that would be down 7 on the day, down 3 on the week. And we're hovering at 387-ish on a 10. Melissa, that's down 4 on the day, down 7 on the week. So we want to continue to monitor as the 10-year note right now is basically hovering unchanged for 2024. Back to you.
But what a ride. Rick, thank you. Rick Santelli. Diana Olick joins us now with more on the numbers. Diana, what's your reaction to the data and the impacts weather could have had on this number?
I mean, everybody makes that weather argument at some point when you see these numbers come down. But the issue here, I think, is you're looking at multifamily versus single family, and I always like to break these two out. You have single family down 14%, but you have multifamily up slightly for the month. Multifamily has been down considerably because we have this massive supply of new rental apartment construction come on the market this year. But so, that's not unexpected to see that. But when you see that down 14% month to month, down 14, almost 15% year over year in single family, Rick touched on mortgage rates, and it's not just the mortgage interest rate for the buyer that the builder's concerned about. It's really their own interest rates, their borrowing costs, and we're hearing that more and more from the builders. We heard that in the Builders Sentiment Survey when they said the costs of land, labor, materials, everything, but also their own borrowing costs are really hampering them from putting more holes in the ground. And that's going to obviously, hopefully, improve this fall if we do see rate cuts and we see interest rates come down. But again, as Rick said, we saw the 30-year fix come down, starting to come down in July. It really didn't hit sharply until August, so we could see better effects of that in August, Melissa.
Diana, real quick, this difference in the effect on the existing home market versus the new home market of lower interest rates. Isn't it true that a lot of the new home builders have been buying down those mortgages for buyers? So there could be very different effects, right?
Yeah, absolutely. And most of the big builders that we talk to say that they're buying their interest rates down. If you were seeing a rate around 7% on the 30-year fixed in July, the builders would be buying you down to about 5.5% for some of their best buyers. So that was a great incentive. That's why you see the big builders getting so many more people in the door on sales. But again, a lot of the country, now builders are consolidating. You're seeing the big builders have a lot bigger market share. But in a lot of the country, you are seeing these mid to smaller builders. They can't afford to buy down interest rates given their costs. So it's really up to the bigger builders to do that. And again, they've been talking about how that's hitting their margins, but they're doing much better than the small to mid-sized builders who are really struggling.
Diana, stay with us. We do want to pivot to a new rule that will impact how realtors are getting paid starting tomorrow. How big a shift is this in the real estate business?
Well, actually, this is really a landmark antitrust settlement in the housing market that will fundamentally change the way real estate agents are compensated when you buy or sell your home. The National Association of Realtors agreed to take offers of broker compensation off the MLS. That's the listing database that they use. In addition, buyers will have to sign agreements of compensation with their agents. In the past, both buyer and seller agent commissions were usually paid by the seller. Now the seller doesn't have to, and some say this could lower agent commissions and maybe even lower home prices.
Diana, stick around for more. I want to bring in Amy Lesson, your president of RE/MAX. Good morning to you. What do you think?
Good morning. How are you?
What is this really going to do starting tomorrow?
Listen, as you just heard, there's a couple of changes. First of all, offers of compensation are still allowed. They just aren't going to be communicated via the MLS. And then, of course, a written buyer representation agreement will be signed between the buyer and the agent prior to showing property. You know, what's interesting about this is the fact that, you know, buyer agency has been around since the 90s in the US, and 20 of the 50 states, these written buyer agreements, they've all already been required. However, in the other 30, the agreements have been widely used, they just weren't required. So
Amy,
I think this, yeah, go ahead.
What's the unintended consequence of this that we're not thinking about?
You know, I think that actually this shines a light on why being represented by a professional and trusted agent is important for both buyers and sellers. Making sure that your interests are represented in the transaction and that you have a transparent conversation about compensation is critical.
Diana?
And Amy, I'm just curious, there's been a lot of talk about the first-time buyer who really relies on an agent because they may not understand the process of buying a home, you know, appraisals, assessments, contingencies, all those things. If the buyer can't afford to pay for their own agent and they choose not to, is that going to be, you know, a problem for first-time buyers coming in?
I think that's where a professional agent can step in and help a buyer navigate. As we know, commissions are always negotiable. And what was possible pre-settlement is still possible post-settlement, but I do think that buyers need to rely on professional expertise so that they can walk through that process and understand what does happen and what is the buyer's directive if a seller is not offering compensation.
So can I go to the broker and say I'll pay you 2%?
Commissions are negotiable and always have been.
And the broker can decide not to take my business if I'm offering too little.
Agents provide a very valuable service and they deserve to be compensated. It is up to them to articulate their value, determine what they charge for their services, and of course, it's up to the seller and or the buyer as to whether or not they want to pay their commission.
Amy, how long am I locked in to a particular agent or broker, if you will? Meaning, I sign up with you, I say, we're gonna go look for properties, we look for a bunch of properties, I don't decide I want said properties, or I don't want them at those prices. I don't know, 6 months pass, something else happens in my life, I then want to actually go back and, all of a sudden one of the properties is lower. Can I go back without that agent? Am I locked in for 2 years? What's going on here?
Ultimately, buyers need to ask these questions, and a quality agent will explain timeline, what the terms and the scope of the agreement are in order to help a buyer make that best decision about how long the agreement should be, what the scope of services are, and the compensation that's being offered.
Amy, do you buy this argument that it will actually lower home prices because if the seller doesn't have to pay for the buyer agent commission, that they might take that off the home price?
Great question. Look, the price of property is determined by supply and demand. And foundationally, there are benefits to a seller for having a represented party on the other side. Just like for buyers, it's important for sellers that they hire a trusted professional who can walk them through what are the advantages of having someone represented on the other side, helping them navigate the complexities of the transaction, making sure their interests are being represented, and it can really smooth a transaction over. I've been an agent and a broker for almost 30 years. I recently moved and relocated. I hired a professional agent because that local expertise, that knowledge
But will the
is
prices
incredibly
come
important.
down, Amy, if you're no longer paying 2.5%, if you're the seller and you're not paying 2.5% to the buyer's agent anymore because that's being picked up by the buyer, does that price, I mean, where does that money go?
I think the prices are negotiable, as are commissions between buyers and sellers. Market price is determined by supply and demand, what a buyer is willing to pay and what a seller is willing to accept.
Amy, I did a story in my first job out of college for the Sarasota Herald Tribune. Was I was a real estate reporter. Should you hire a buyer's agent? And there was a lot of reasons for people to do that, especially in the crazy real estate market that was Florida back in the late 80s. So I think that's some good advice anyway.
I agree. Being represented by a trusted professional is critically important, and they can walk buyers and sellers through these changes, what they mean, and how their interests are represented in the transaction.
Okay. Amy, appreciate it. Thank you very much.
Thanks for
Diana,
having
thank you
me.
as well. You bet.
All right, coming up, former Fed Vice Chair Richard Clarida. He's going to join us on what we've learned from a big week of economic data and the outlook for Jackson Hole. Of course, we've got the latest in the $30 billion classic car market. Robert Frank, live at Monterey Car Week in California, and he's going to join us after a break. Robert, what's the Monterey Festival happening out there?
Well, Steve, you were talking about NVIDIA stock before, and if you were to look at what is the NVIDIA of classic cars right now, it is this, the Lamborghini Miura, outperforming every other model. It's up 30%. This car, about $2.5 million. We're going to tell you what's hot and what's not here in Monterey as nearly $500 million in cars crosses the auction block. That's coming up right after the break.
Doing. Welcome back to Squawk Box. The futures right now still in the red, more in the red than it has been since the morning began. Not sure what's troubling the market, but 88 down on the Dow, 25 down on the S&P, and 119 down on NASDAQ, giving up some of those big gains from yesterday. Check out shares of Rivian. following after the company temporarily halted production of its commercial delivery vans used by Amazon. The company is citing a parts shortage. Haven't heard that in a while. No word on how long it's expected to last, Melissa.
A fleet of classic cars worth hundreds of millions of dollars about to go up for sale. Robert Frank is live in Monterey, California with all the details and a look at who is doing the buying. Robert.
Good morning, Melissa. Well, good to see you. More than 1,000 cars expected to cross the auction block this week here in Monterey and Pebble Beach. This is the biggest auction of the year in the classic car market and a biggest test for a market that is losing speed, maybe even seeing a bit of a correction. Last year's sales here fell 15%. This year, they're hoping for an all-time record with sales up around $460 million. Why the optimism? Well, sellers have come down in price. They're dropping reserves. They're getting a little more realistic about what their cars will sell for, and they're dropping their reserves. At the same time, you have some new wealth creation, particularly in tech here in California, and especially from AI. So that's replaced some of the crypto bros and some of the IPO wealth that we had seen prior to that when it comes to buyers.
A lot of big collections built out of some of the crypto, millionaires, and we don't see that right now. There's certainly a lot of tech influence, and out here in Monterey, Northern California, pretty close proximity. I'm imagining a lot of NVIDIA employees are here hoping to fill their new garages with something, and I can't blame them.
So one of the most expensive cars selling well. This top lot over at RM Sotheby's is a 1960 California Spider GT. That's the model made famous by Ferris Bueller, of course. This is a gray one, estimated at $18 million. Then there's a 1938 Talbot Lago. You're looking at it there. That's estimated at $8.5 million over at Broad Arrow Auctions. But when it comes to what is really hot in the market, what's changed in classic cars is that both the collectors and the cars are getting younger. So the 1950s and 60s cars, which dominated these sales for years, are being replaced by 1990s and 2000s cars like this one. This is a 2005 Porsche Carrera GT. This car sold in 2005 for around $450,000. This one's selling for around $3 million here this week. Guys?
Robert, I wouldn't think they would, but do rates actually impact this market? Does anybody finance the purchase of one of these classic cars?
They do, Melissa, and rates impact this market in two ways. At the, let's say, lower end, so anything under, let's say, $400,000 or $500,000, a lot of that, maybe even half of that, is financed. So interest rates certainly played a role last year. What's at the top of the market, what affected the market last year was that the wealthy would, given the interest rates were, the Fed funds was at 5%, they could put their cash in treasuries and get 5% or cash equivalents rather than buying a car. So it hurt in returns at the top. They'd rather take the high interest rate returns than put it in classic cars. And at the bottom, it was financed. So now that interest rates are expected to start coming down in the fourth quarter, that is one of the reasons people are optimistic and could get a record year here this year, Melissa.
All right. Robert, thank you. Great to see you. Robert Frank.
Okay. Coming up in just a minute, can't miss interview on the Fed and the next steps that the central bank could ultimately take. Former Fed Vice Chair Richard Clarett is going to join us in just a moment. Do not go anywhere. Squawk Box coming right back on this Friday morning.
good skin day.
Welcome back. New looks at inflation, retail sales, and jobless claims this week, leading to a bunch of new predictions about what the Fed is going to do next. Joining us now for his take, former Fed Vice Chair Richard Clarida. He's now Global Economic Advisor at PIMCO. Richard, thanks for joining us.
Yeah.
All right. So let's talk about next week. What do you expect to hear from Fed Chair Powell about the direction of monetary policy and interest rates?
Well, Steve, thanks for having me on. I think we have a preview because I do think the chair will be inclined to stick pretty close to the press conference after the July 31st meeting. He also was at Centra and on Capitol Hill. So I think he will basically stick to the message of acknowledging substantial progress in reducing inflation, acknowledge that now that they're close to the inflation goal, that they're now definitely a dual mandate central bank. You know, we heard from Austin Goolsbee recently about they're really now focused, in my term, on sticking that soft landing and making sure that they maintain, if they can, maximum employment. I would not expect him to give any broad hint, about 25 versus 50. I do think that in September will be data dependent on what we get on the employment report. So maybe he'll use this as an opportunity to give a little bit of a retrospective on the last 2 years. Of course, 2 years of Jackson Hole, important speech, the whatever it takes speech. But that's what I expect.
Richard, I want to know how you reacted, or how you might have reacted as a policymaker, which you very recently were, to the events of the last couple weeks. We were going to hell in a handbasket for a couple days there when the jobs report came out, and then the market sold off on Monday. And we had that a little bit higher than expected jobless claims. Then jobless claims came back in. They didn't shoot through the roof. Then we had strong retail sales. How do you incorporate all this? And are you surprised at how the market and even some of your economist friends reacted to all this?
Well, I will say it. Indeed, I was actually traveling in Latin America when a lot of those events were happening, and I made a note to myself that if I were, back as Fed VC, the way I'd be looking at it in real time is, I wouldn't be inclined to adjust my view on monetary policy because carry trades unwound and equities had a correction from very lofty levels. And so I'm glad subsequent events have sort of put that into context. I think we have a lot of information about the economy. Underlying growth is around trend. Labor market has come into better balance. Jay Powell says they don't want to be data point dependent, and I think that makes sense. But I would emphasize that I do think that there is special importance in what we hear about the labor market. If the next print that we get early September looks like the average of the last several, I would be inclined to think that they go 25 and signal more the way. If it's a disastrous report, negative payrolls and big resident employment, then we'll go 50. So I do think it's data dependent for that first move.
Richard, you just underscored a point that I think I try to make a lot, which is that the market thinks the Fed thinks about it more than it actually does. But I want to move on to another point here, which is where do you think, how much can the Fed do here? And would it still be restrictive? It's kind of asking you, where do you think neutral is? But is the market crazy in thinking about 100 through the end of this year and 200 basis points of cuts a year from now?
I don't think that's crazy. I start with the dots. They're imperfect, but the dots sort of indicate one scenario, which is a very soft landing with inflation gradually returning to 2 from above, and then the funds rate sort of follows that down over the next 2.5 years. That path could make sense, but also you could make a case, as Goolsbee and others have, that it would be rather restrictive to keep the funds rate where it is when you're at 2.1 or 2.2 on inflation. So I do think we could get more rapid reductions, down the road that are in the dots. But I think that's sort of a reasonable starting baseline.
What is the argument against 50 basis points in September?
Well, there is precedent for that. The Maestro Greenspan, had a cycle in 2000 when the first move was 50 and actually ahead of a meeting, so it can't happen. There is a risk, and during my time as vice chair, we saw this firsthand. We had an unscheduled meeting. We preferred that term to emergency. We had an unscheduled meeting in March, and we adjusted rates 50. And the market reaction near term was, oh my gosh, this is terrible.
But that was an emergency meeting. This is a scheduled meeting.
Yeah. Well, that's true. And again, they could, I mean, exactly right. They could tee up 50, have plenty of chances for communication between now and then. And I think there is data that we could get that for which that could be the move. My own sense is, the market, I think, pretty well understands the Fed reaction function. They didn't go at the July meeting, but markets began to price in cuts. And so my inclination would still be to begin with 25, but, ultimately 50 could be justified.
Richard, I have this idea of thinking about it. I don't know if it's too much of a metaphor for actual monetary policy, but you might want to maneuver yourself into a position to be able to provide stimulus to the economy if you need it.
Yeah.
If you did 100 now, you're still not going to be providing stimulus according to your own calculations. I don't mean yours, I mean those of the Fed.
Sure, yeah.
You're still holding back the economy. What do you think of that idea, which kind of supports Melissa's idea? Doing a 50, get to the point where you can provide help quickly, and then make a decision whether or not to provide it.
Well, yes, and in fact, it was interesting at the July press conference. I'm not sure if it was you, Steve. Someone asked the chair the 50 versus 25 question. My recollection, paraphrasing, is he said, we're not thinking about that. Here's what I'd say. I would say on that. I do think there is, although it may be diminishing in importance, I do think there's some path dependence here in the following sense. The last 3 years, and I was a charter member of Team Transitory, the last 3 years, have not been kind to that initial call. All's well that ends well, perhaps. But I do think the fact that there has been an inflation overshoot for the last 3 years is a factor that's probably influencing, at the margin, both the timing of the first cut and the pace. And so I do think, at the margin, that could be relevant for some members.
It was transitory, Richard. It was just transitory.
Yeah. And notice I was a member of Team Transitory. I didn't say it would take 3 months or 3 years.
Right.
And so, yes, you're
Richard,
right. Yeah.
thank you so much for joining us, and we'll probably check back in with you again when Jackson Hole comes around next week.
Super. Thank you.
And a programming note here, we'll be bringing you a big slate of guests from this year's Fed
this
Summit in
guy,
Jackson
with this
Hole.
guy,
Yes,
Lee Smith.
Smith.
I didn't know that was my read. Sorry, Melissa. Thank you for
Professor
picking
is
me
going
up.
to be here.
I'm going to be out there, and we're going to have a lot of really smart people on from there, and we're going to be. It's about the transmission mechanism of monetary policy next week.
And you know what's going to be interesting also?
Whether or not they're fired.
We're going to have the overlay of the DNC convention happening at the same time, which I imagine will then get into the
I've
conversation.
got to check my notes as to whether or not that happened 4 years ago. I don't remember it happening 4 years ago. Or maybe the DNC didn't matter because it was Biden. I can't remember, but I have to go back and look.
Well, Powell's going to speak on Friday, so that'll be a big
Powell will
highlight.
speak on Friday, and that'll be right after Harris will speak on Thursday night. So you're going to have a lot to talk about.
Yeah.
For an August, right?
For an August. For
First
an
levels
August.
of the morning on the futures, by the way.
Enjoy this August weekend, folks.
Yes.
Melissa, thank you. Mr. Professor, thank you. Make sure you join us next week. Have a great weekend. Squawk on the Street begins right now.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Mike Santoli here at Post 9 of the New York Stock Exchange. Kramer in favor of the morning off. Pre-market just south of flat. Global equities wrapping up their best week of the year. S&P now up 8% from last Monday's low, just 2% from some all-time highs. Our roadmap begins with that winning week for Wall Street. Does the rally have more legs? Plus, the weakest housing starts data since May of 2020, as Redfin says the share of million-dollar homes just hits an all-time high. And the vice president set to deliver a major economic policy speech today featuring new tax cuts, housing incentives, and price caps. Let's begin, though, with the broader market in the midst of a 6-day win streak. Mike, I think it's the best 6 days going back to 22?
Yes, it's been a good streak. Obviously, makes sense to digest some of that. And really, if you go back to the intraday low of a week ago Monday, S&P up 8% in 8 trading days. And it's gained back about more than 2/3 of what was lost, high to low. So what does that tell you? I think it tells you a couple things. One, the extremity of the stress in the very short term, I think, cleared out so much in the way of accumulated exposure to stocks and positioning and risk assets and all the rest of it. You see it in all the hedge fund data. You see it in a lot of the sentiment stuff. And so that creates a little bit of a technical tailwind for that to normalize once something doesn't break as a result of that. And then the data have come in, as we've been talking about for a couple days, that allows investors to kind of rebuild some confidence in the soft landing scenario. So relief across all those fronts. I think the strength of the comeback says a lot about the buildup of anxiety ahead of it, through the numbers about July softness in consumer and all of that. So, what does it take to get you back to the highs in a hurry? Probably quite a bit. I mean, it doesn't take a lot in distance, but I still think you have to have a lot of certainty. So arguably we're going to have to be surfing from data point to data point, testing that against the soft landing scenario. Very bullish if, in fact, the Fed can signal it's going to start to ease and normalize policy and become less restrictive in a very deliberate, slow, orderly way, because that's always to me been the bull case. Not that they start to cut and slash rates, because that seems like a little more of a desperation move. So all of that fits together pretty well. Earnings did their part, I would argue, 10% annualized, and Citi's saying that the non-Mag 7 stocks up 5+% or 4% or something like that in the second quarter. Not wonderful, but it's doing some of the lifting.
Well, first contribution from the 493 in 6 quarters. Now we're starting to get some curtain raisers on Jackson Hole. It was BNP Paribas last night saying that Powell's likely to indicate that cuts are imminent.
Yes.
And set the table for September. JPM desk today talks about whether or not cuts do anything to interrupt the growth bullish scenario. In other words, do they know something we don't know?
Yeah, I don't think we're close to that.
Right.
I mean, look, if September happens with a cut, it will have been, 14 months since they hiked last. That's an extremely long time to be on pause. They've set the stage for this. They've talked about how restrictive policy is at this level. Inflation by CPI and PCE going below 3%. I mean, there's a massive gap there. There's a massive gap between Fed funds and the 2-year yield. In other words, everything builds toward they should be cutting right now, not because the economy weakened appreciably beyond what they were expecting. So I think that message should be taken okay. I guess the question is, does it have an actual effect aside from a psychological effect? It's much more about the gesture of we're no longer trying to hold the economy back. There's room to cut without it meaning there's something negative for the economy, at least in the short term. That's the win if it goes that way. But there are numbers between now and then. And, Goolsbee coming out and sort of not changing his tune, but maybe becoming more vociferous about, hey, we got to be careful about downside risk. It seemed like once you got past CPI and that didn't kind of interrupt the narrative about disinflation, it seems like the runway's clear.
And then the word robust being used a lot on retail sales, page 1 of the FT in the Journal today. You speak about Goolsbee, who's been obviously calling for cuts for a while, but did tell NPR specifically about the labor market that when you start to see rises in the unemployment rate, it often worsens quickly. Take a listen.
There are some various leading indicators of recession, and some of those are giving warning lights. But there's cross currents. Credit card delinquencies rising is a warning. Small business defaults rising, that's also a warning. And rising unemployment rate is a warning. On the other side, you got GDP growth, still been pretty strong, and there are pockets of strength throughout the economy. So that's the job. The watch pot may never boil, but the Fed's job is going to sit and watch the pot until figure out is it boiling or freezing or what's happening.
Meantime, we've got Tony P. over at Goldman Sachs note today saying that we are in a period where we'll be watching every data point. There's no one path or the other that you're looking to ratify.
Keep trying to reiterate that soft landing doesn't mean everything's comfortable all the time. It means things look like maybe it's late cycle and maybe we're tipping into something more worrisome, and then you get rescued by a data point, and it just sort of moderation is moderation. And then, if there is some kind of a landing, it's not just the Fed landing its tightening policy, it's also the economy kind of normalizing back toward trend. So I do think that's kind of where we are. Goolsbee giving voice to this idea that you don't want to be late in moving in this direction. You know, if you kind of go back and say, what was the big mistake in 2021, everyone will say the Fed didn't see inflation coming, or at least downplayed its initial surge. So is the lesson from that you always want to be mindful of where the turn is ahead of you, or is it inflation is this uniquely noxious beast that you could never be comfortable about? I think it's probably the former. You want to look for the next turn in the narrative. The market's been very impatient to set the inflation side aside.
It's almost exactly what Bostic told the FT yesterday. Quote, you really cannot afford to be late. Here to break down the road ahead for stocks as we head into the sometimes tumultuous month of September is Fundstrat Global Advisors co-founder, head of research, Tom Lee, joins us here at Post 9 on a summer Friday. Tom, thanks for coming in.
Great to see you.
Was it last week? Was it difficult to keep your bearings in the midst of that crazy price action?
Without question, because the market had been whipsawed by data point to data point, as you guys were recapping. You know, the jobs report raised recession fears, big risk off. Then we got inflation this week, which was pretty tame, and I think markets suddenly went back to thinking about liquidity coming into markets. I think that the data dependence of the markets and the Fed is very tough for investors. And I think if you look ahead, I'd say we always know the summer is tough. Summer probably runs through October, but I don't think that anything's changed into year end, which should look pretty good.
But are you lower conviction now than you were 2 weeks ago?
No change in our conviction, but it is just recognizing August historically is a tough month for markets. I mean, one thing that maybe investors can be encouraged by is since 1928, the most common month for the summer low is August, and the most common week is the first week of August. So I think maybe the worst is behind us, but it doesn't mean we're straight up from here.
Right, and I guess the question is, I keep going back to that moment in mid-July when we were at the highs. You were just shy of 5,700 on the S&P 500, and everything was a go. It was, the AI earnings path was kind of unquestioned. In addition to, general soft landing expectations, you kind of didn't have a lot of painful trade-offs to worry about in terms of policy or growth. Can we get back to something like that? I guess the idea, as you say, maybe summer lasts through October. Do you expect that we're going to have to continue to reset around these levels?
Yeah, I think if my best guess would be it's still going to be a struggle, but we're climbing the escalator again. I think Jackson Hole is going to set a positive tone on balance just because the evidence is growing. FOMC members want to be forward-looking, as you guys are pointing out. Data dependence is dangerous at turning points. And then we get the jobs report for August, which I think should reverse some of things that could be temporary. I mean, that's a guess, and if it is, then recession risk is sort of reduced, but now we have real rates are too high, and that means investors will be comfortable with cutting.
I'm thinking back to some of the notes you wrote after the last jobs number, and you looked at Hurricane Beryl and the number of companies in Texas that had no power for 2 weeks, and you do think August will be reassuring on the NFP print?
Yes, I mean, in some ways, the weekly claims is telling the story. We had a surge in claims, multi-month high that have come down since then. And so even if someone says there was no effect from the hurricane, how do you explain claims really improving so much, especially in places like Texas? And, I mean, 1 million homes without power for 2 weeks, how could that not affect the local economy and the jobs market?
This rebound that we've gotten from the lows of early last week, initially, certainly until yesterday, it was back to the first half winners. It was a lot of the mega cap growth stocks, and the eco-weight S&P really didn't have that much of a pullback, and it's closer to its highs. But small caps definitely got a flush, and yesterday they rallied big on that retail sales number. But it seems like that's still been a complicated attempt at a rotation.
That's right. They always say bottoms are tough and bottoms are a process, and small caps are really in the process of what we think is a multi-year bottom. And so conviction is not going to be as strong as things that have been working. I think most people's toolkit is to buy the triple Q, the NASDAQ or the AI names when they want to get back in the markets. But cutting rates at a time when small caps trade at 10 times forward PE, better earnings growth, and then a visible path to easing, I would say it still makes sense that the risk reward is in small caps.
And then, we had a miss on housing starts this morning. So it's funny, is that the parts of the economy you thought you could rely on for a while maybe are giving way as other ones maybe start to bottom. But what's your thought there in terms of the flow through to the rest of the economy?
I think housing, auto sales, and durable goods are essentially in recession. It makes sense because cost of money is so high. I mean, it's super expensive and hard to afford a home or to buy a car with these rates. These are also directly benefiting from Fed cuts because adjustable rate mortgages adjust, business loans adjust, auto loans, credit card, they're sensitive to short-term
builders
rates.
loans too. I mean,
yeah,
if you're building
that's
a house.
right. Cost of money for builders, yeah. And so I think these really benefit from an easing cycle, but a market that believes there's an easing cycle underway.
How many cuts you think we get this year?
I'm looking at consensus, which is somewhere between 4 and 5.
Before the end of the year?
Yes.
So about 100 basis points?
I think that's right, but it depends on where inflation prints the next couple of months. But our base case is that we're on a glide path towards 2%. That's better than consensus. So I think 4 to 5 still makes sense.
And you've been, part of your thesis has been that elements of CPI have been falling, in your words, like a rock.
Yeah.
I actually saw that phrase repeated in another desk note yesterday, so that's spreading. But are you as assured of that? And when you look at things like car insurance or some of the coincident costs of owning a vehicle, as you point out?
Yeah, I think one of the things that surprises us still is that two things are keeping inflation high on a weighted basis: shelter and auto insurance. Auto insurance adequacy is there now. If you look at the results from these auto insurers, they don't need to raise rates, so I think that's cooling, and that'll come in the second half. And for housing, rent is stabilizing, and I think housing is going to cool. It just needs to get to 3 to 4%, and then markets will be comfortable that we're back at 2. But median inflation rate is still 1%. That's below Fed's.
Well, I think as Greg Ip said this week, rents are inertial. It takes time for those new rents to cycle in.
Yeah, that's right.
Tom, good weekend.
Thanks you guys.
Great seeing you as always. Tom Lee. When we come back this morning, today is the day the Vice President is set to outline her economic plans for tackling the high cost of living. We're going to take a look at how they stack up against those of former President Trump. Take a look at the pre-market here as we try to get some of the pre-market out of the red, although they're off the session lows still decisively below the flat line. Stay with us.
StillCollection.com.
The vice president is set to outline parts of her economic agenda this afternoon at a rally in North Carolina. The focus will be on lowering the cost of living. Megan Casella joins us this morning with a look at how the vice president and the former president each plan to tackle high prices. Hey, Megan.
Hey, Carl, good morning. So that's right. Harris is unveiling what looks like a four-part economic plan today, focused on taxes, healthcare, housing, and food. On taxes, she wants to restore and expand the child tax credit to provide up to $6,000 for families with kids under 1. She'd also expand the earned income tax credit and reduce taxes on health insurance premiums. Also in healthcare, she wants to cap the cost of insulin at $35 and limit spending on prescription drugs to $2,000 for everyone, so not just seniors. She's also vowing to increase competition in the pharmaceutical industry and to cancel medical debt for millions of people. Then on housing, she would use tax credits to incentivize construction of 3 million homes in her first term and provide up to $25,000 in down payment assistance for first-time buyers. She also wants to ban corporate price gouging in the grocery industry. So overall, guys, this is really a left-leaning populist agenda. It expands on some of President Biden's ideas to spin them even a little more progressive. And in some ways, it pulls directly from her 2020 platform, including that $6,000 child tax credit. So for all the talk of her moving to the center, and she's doing that on some issues, but she's definitely not doing it on economic issues right now. And all of that comes in contrast to Trump's proposals to lower costs. Those include cutting energy costs in half by drilling for more oil, extending tax cuts, and slashing regulation. And neither of these plans, guys, is what most economists would ideally like to see. It's mostly aspirational campaign politics, and most of it would have a hard time getting through Congress. But there is a common thread here in that both parties are offering voters someone to blame for high prices. That polls well. For Harris, that's corporations, and for Trump, it's the government. Guys?
Meantime, last night, Megan, we did get this report out of Goldman taking a crack at some of the universal tariffs that the former president has been floating. Their argument is that it's not their base case, in large part because they think, unlike China tariffs, the universal ones have less support because, in their words, it would have meaningful negative effects on the economy.
Absolutely. I think that's been really clear since President Trump's first term. There's been so much economic analysis on this that the costs are transferred directly to consumers and they drive up prices. The politics of trade have really evolved in the past few years, that both parties now endorse what they call targeted tariffs, and we've seen President Biden impose some of those, but there's not a lot of support, as you say, for universal tariffs. President Trump may look for ways to do that in a second term through various trade statutes, especially depending who he puts on U.S. Trade Representative. But you're right that there's not a lot of support for that on Capitol Hill.
I was going to say, Megan, you mentioned that a lot of this, of course, is sort of political gestures and messaging. But I also wondered to what degree Vice President Harris has the ability to say, you know, based on some of the fiscal measures, we've actually ramped up factory construction, for example, in this country. And so a lot of the things that the Trump administration had talked about doing have been done. You know, Donald Trump talks about raising oil production. We're at record oil production. So it's almost like as a defensive way of approaching what the alternative message might be.
Definitely. I think that's what she wants to lean on, and I think we'll hear some of that this afternoon by saying, yes, some of these are progressive ideas, but we're also doing the pro-growth agenda, and look how strong the economy is in this first term. She doesn't really want to distance herself from President Biden's policies because on the whole, the economic fundamentals are really quite strong. What she does want to do is say to Americans, I sympathize with you about high prices, and that's where we're seeing these ideas come from. But you're right that she can lean on what's happened over the past 4 years, say that oil production is up, say that growth is high, say that we're maybe not likely, but we're looking at the moment like we might be headed for a soft landing, and because of that, we can move towards some of these more progressive ideals.
Afternoon, Megan. Appreciate that.
Soft landing.
Joining us with Harris's.
Hello, retail traders.
Today. Still to come this morning, more movers to get to, including some chip names going in opposite directions. Take a look at the pre-market here as we wrap up this interesting week of trading in a minute.
Here's a little paperwork. It's hard to be in business these days. I think they're weaponizing the IRS. Sure in hell wouldn't let them tell you any different. June.
Peacock.
Got a couple of different stories in the chip space. One is Texan now getting about $1.6 billion in funding from the CHIPS Act. The other is AMAT. You'll see it down there, down about 3.5% pre-market. Revenue in line. They guide Q4 in line, although some discussion about the China mix and sequential declines in China-related revenue. We'll talk more about it after the bell, which is coming up in 5.5 minutes. By the way, quick programming note, be sure to watch a special edition of Taking Stock with Santoli. That's coming up tonight, 6 p.m. Eastern Time.
Four more minutes, and I got one more thing to do. I got 549 for support. If we pull back one more time. Get everything set up. Good morning, retail traders. I don't know if I'd have held the SPY and made money on it, but I bet you I'd have been pretty much even.
It's another day in which we're watching some data out of China. For example, a foreign direct investment down almost 30%.
Wonder what kind of hogwash they've been feeding us today.
Estee Lauder, which gets downgraded today over at B of A, in large part because they think their China thesis was wrong.
Exactly, that the comeback of that business is not necessarily taking hold as they had thought. This has been, I guess, a consistent message out of China. You keep expecting the turn, hasn't happened. And of course, Estee Lauder, in this huge drop of the past year and a half or so, it's been a real recognition moment for just exactly how dependent EO was on those businesses. And it is kind of a similar equation as investors look at this stock to what we're seeing with Nike and Starbucks, which is always had a premium multiple. It was always these great durable brands, and they've fallen on some kind of hard time. A lot of China dependency in there. That was part of the growth story that has faltered in all of those cases. We obviously saw what happened with Starbucks. Brian Nickel goes there, the stock pops. Nike, similar thing. So I don't think necessarily the fix is going to be the same, but it is interesting. Relative to the market, Estee Lauder, Nike, Starbucks have basically fallen to lifetime low valuations. Now, it doesn't mean they're cheap. They're low relative to the market compared to their history. I mean, you could even put a Disney in there before this latest pop. So it's kind of interesting as the market looks for, I think, more idiosyncratic situations as opposed to just either we buy the AI profit stream or, we're betting on
The answer is no, I would have not. So I got out good.
Yeah, where you get Berkshire Ulta.
Oh, I was in.
And then some argued that on the activist front,
No, I was in
more
puts.
aggressive in names that are non-tech, right? Southwest.
Yeah. No, I feel like, look, the market has had a
Okay, I've had enough of you already. The market is had. I don't like him too much. That guy right there. He's got that happy-go-lucky attitude, though. He writes off everything he says. Not writes off, you know what I mean? I mean, he encourages you. They got the clap. Today's loser is Carvana. I think Carvana is going to pull back some because of car sales are picking up and used cars are not. They're kind of dropping a little bit. But I'm hearing that new car sales are picking up a little bit. Their lots are full of inventory. They're going to be pushing out some discounts. Dell just popped up to the top. It's down $1.56. PANW is one today. I mean, this thing's had a huge pop already. Then they're moaning about Target this morning. We got Meta down 443. Where are you? Chewy. That's the SPX. SPX resistance is 55.5308. $55.3308, and it should. We'll see if it pulls back from there. SPY hit resistance in the 200. Now we're going to find out if it breaks out or not, or if it pulls back. And your first support is going to be right up there. That's a rising wedge breakout. So if that holds support, we'll come up and retest that 200 on SPY. Meta losing a little bit more ground. Now Meta will benefit. Look at the calls here. See what they look like. Next week on Meta, the 550 strike. $5.40, I'd get one of those when it come time. SPY's respecting the 9 EMA. CME rejected big time off the 200. BABA might be moving. And they're waiting for China numbers. JP Morgan maintains overweight on Alibaba, raises price target to 108. JP Morgan. I didn't want that. Happy Friday, mannequin. Good morning, Johnny. Blaze. Yeah, so we got to break the 200 for it to be bullish. Not till then. We're squeezing between the VWAP and the 200 right now. I'm going to have to make a phone call here real soon. be right back. I'm going to turn the radio on. I got to make a phone call.
Sale of the whole company, right? So there is, in theory, if somebody came out and said, we have a premium for all shareholders and it's a clean deal and it can be financed, I guess you have to listen.
Which we know passed in 2022 that increased production of semiconductors here in the U.S. because that space production-wise has come down over the past few decades, actually. Once upon a time, the U.S. produced more than 30% of that sector. Now that number is down to about 10%. So the government passed that CHIPS Act.
SPY, I got 549 for my first support if we don't hold.
Especially to counter those tariffs they're applying to
We got to break that 200.
The latest beneficiary of that, besides the $1.6 billion in grants that will help them build new manufacturing plants, it will also be able to get loans of $3 billion. So the total package could be up to $4.6 billion for Texas Instruments. So it helps it beef up its production here in the U.S. Again, one of those plants will be in Texas, one in Utah. And, you know, it's aiming, in addition to that, it will also receive tax credits that could cover up to a quarter of its building and outfitting the factories with production. So it gets some help on both sides of this production equation. And because one of the reasons we know this came up was because of that shortage of chips that we saw during the pandemic, and the need for chips is increasing because it powers everything, whether we're talking about, you know, our smartphones to smart refrigerators to even defense systems, Oliver.
Yeah, even though Texas Instruments doesn't find itself in the cream of the crop for the cutting edge AI stuff, it's still such a huge company that touches like everything. I think the most diverse customer base actually among all the chip makers. So if you're going to pick a U.S. company to throw money behind, it's still not a bad option by any means.
Right, it's not a bad option, and it follows some other company supports because, again, you know, this CHIPS Act has been in play for a little while now, so they've been gradually doling out these grants or making announcements of doling out these grants. And maybe we're not seeing a lot of movement in the share price because we knew this was coming, so a lot of times, as we know, Wall Street gets in front of the actual news. So far, they've already announced more than $30 billion in grants from this program. The plan is for them to dole out up to nearly $40 billion, around $39 billion is the total figure that they are planning to dole out. They've also already awarded grants to Intel, although we know Intel has faced some other challenges. Taiwan Semi has also been a beneficiary of those as well.
Yeah. Part of it, though, you know, I guess one could argue that you are kind of maybe, look, I mean, when you've got as much demand for kind of the basic things that they're, and again, they're not like super basic to your point about like, you know, advanced, you know, consumer tech and stuff, and they've got so many different customers they reach. But it's also, you know, specifically funding for like these legacy names. So then when you like think about, all right, well, Intel, like, are we burning money, you know, by supporting companies maybe that are just getting beat out of their market right now? So I feel like for Intel, that's more of a criticism. I feel for Texas Instruments, there's just not as much overlap with the NVIDIAs, you know, and the other really hot names. Whereas Intel, it's like, all right, throw money in Intel right now might not be the best, the best use.
Right. It's true, exactly. But for a company like Texas Instruments, this could be an opportunity to, you know, expand its both production and development, especially with, we know, the rising application of those tariffs. And we know, you know, no matter what party that is, there is going to be this tit for tat between, you know, China and the U.S. on these tariffs.
Yeah, okay. It's a fair point. It seems like jobs are going to be a result of this, like, pretty quickly. So, again, yeah, I think we're going to throw money at a U.S. chip maker at Texas Instruments about as good as you can ask, you know, if you're, because it's not like the other ones need any help. It's not like the hyper-growth companies need help. So, all right, let's talk some Cisco. Yeah, exactly. The analysts seem to love the stock now, like seeing upgrades, you know, maybe the turnaround is real.
That's right, and I mean Cisco's getting more love. We're seeing more follow through off the back of its latest quarterly numbers today. The stock advancing a little more than 1%. We've got a couple new upgrades in focus for that HSBC, upgrading Cisco to a buy from a hold.
Yeah, this is
Their new
Jim with
price
Always
target is
Clean. Please
58
call
bucks
me
a share.
back
The
at
previous price target
417
was 46 bucks a share.
818
What HSBC
2456.
says is they view their guidance that Cisco gave previously as too conservative, and they've increased estimates to reflect the cost cutting. We know Cisco announced they were planning to make some layoffs. They also talked about the strength in its security
She broke.
segment. Keep in mind, Cisco had projected that sales for the current quarter would be 13.65 to 13.85 billion, which in terms of where estimates were, the estimates were at the lower end of that range. And we know they reported better than expected numbers overall.
Always Clean is Jim.
Upgrading Cisco, that would be New Street. They're upgrading Cisco to a buy from
Yeah.
neutral. Their new price target is 57 bucks a share.
All right. Okay. Bulls
How are you?
Coming in for,
I'm busy right now. What do you got?
value buying perhaps in Cisco. You kind of love to see it. You know, like I said before, I'd rather not see companies that were like the scions of tech from my childhood go bankrupt. That's not the best feeling. Intel, kind of the dividend was kind of a sad day. So Cisco bouncing back. All right. Hey, last thing here, Diane. Autodesk apparently using some questionable sales strategies, and then also maybe some leadership issues, executives ignoring accounting risks. This is also after Adobe was hit for those hidden termination fees. So like something about like creative design software. Well, what's going on in this industry?
I know. So that's right. And Autodesk is under a little bit of pressure following this.
Nice little spinning top right there. Doji. Nice doji.
Warnings continues to use this controversial sales strategy. This sales strategy is the premise of this is that it promises these big discounts to certain corporate customers who are, willing to kind of front load these multi-year contracts. This strategy was supposed to end in 2021. The company is reportedly continuing to use the strategy to meet financial targets. Employees are saying this is not cool. They're not supposed to be doing this, and that it, boosts the chances of mistakes in terms of its financial accounting, and then it makes it just more difficult for the salespeople to do their job because you already have these kind of multi-year contracts. And then how do you?
Meta got
Shares are under a little bit of pressure following this.
right there.
Okay. All right. Thanks, Diane, very much. Okay. Not too much of a punishment, though. Not too hard.
527.59.
%. Wow. Seems like market's okay with that. All right. Thanks, Diane. Good stuff.
CCL is down.
Trade some Apple. Trade some Nvidia when we come back.
Pulte's down. Starbucks is down.
Winners. By the way, seems like dip buying is going to be taking place here. The Russell's positive. We're just waiting on tech.
CrowdStrike.
Apple's down 1/3%.
Got
Nvidia
earnings
about
coming up.
So
Oil.
at a moment's notice.
TSM MCI.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim.
Nailed the bottom on this one here.
Unlock support from the
Tesla.
Schwab, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online.
More breakout on Tesla.
crafted just for trading.
245.
Also, you can trade.
Cantor Fitzgerald reiterates 245 price target. They were bad-mouthing Buffett this morning. Got a symmetrical flag on Apple. 1, 2, 3 set up. It can pull back one more time, but this is the 1, 2, 3 on the top, 2 on the bottom. It's early in the morning, so it could hit the 200. I'm going to set an alert down here at the bottom of the triangle. See if we hit that high or low. And we got PayPal and NVIDIA. NVIDIA with a good little trade this morning, first thing. Snake breakout, pull back, boom. Snake breakout, pull back. I'm going to set an alert right there at 121.85. The video broke out. We're bullish again. SPY just hit resistance at 552.55. This is it. That's overhead resistance. Oh, it broke out overhead. Yeah. Yeah, it's overhead, a little bit above overhead resistance. Let me see. What I have. Yeah, it broke out a long time ago. Actually held support there. Boeing's up $1.38. We got a triple top on SMCI. $636.72. That's where we're at 635. We did hit it. I was listening to CNBC this morning talk about Kamala's agenda. They're definitely are for her. I don't know why, but I think they are because they know that Obama's behind the scene. He's in bed with these fat cats. They're worried about the tariffs coming from Trump, relationships between foreign countries, and I'm going, what the heck are we in, man? We got 2 wars, maybe 3 going on soon, been threatened with a nuke. Taiwan might get invaded. We have great foreign policy. So I was kind of laughing about that. It's like they don't even take that in. It's hard for me not to. Open borders. I mean, foreign policy is really bad. But I remember the Arab Spring during Obama, too, saying America was a piece of crap. So it had kind of funny to have the Arab Spring and then the open border policy. Meta's double bottom in here now. This might be the time for Meta. A 550 strike, or I'm going to move it up by 540. Let's see if this holds right here. So we've got a snake breakout pullback to a double bottom. Meta. I'm going to grab them at 395. Grab one. Just in case it dips, I'll grab another. Next week, 23rd. And we could drop another notch. We definitely could. Just scalping these real fast. Tesla breakout. Consumer sentiment above expectations is bullish. Nice little breakout there on the end of
reached ATMS. Our 3 locations.
Coca-Cola and Kroger. Oh yeah, I was gonna check. Chewy has a triple top brake. What was that one? Still in Meta, we're at 410. Nile, they talked about China, waiting for China. Dang it, I knew it. I watched this yesterday. I was going to take it.
China.
Yep. Huh. Tesla busting a move. Cybertruck buyers get unusual surprise. A brand new truck delivered with dirt and mud. Their new pickups instead feel like they haven't been cleaned. Come on, guys. It wasn't clean like a new car should be if you were paying 100 grand, said Bill Walsh. Huh. I have to ask around about that. That wouldn't be right. Meta 410 might not move. SPY running up again. The way I understand it, that we're in the Camilla trade now, and they dumped the Trump trade, whatever that was. Fat cats. They're really wishing for Camilla, that's for sure. They'll be surprised. But they weren't surprised about the open borders, so, or the wars. That didn't bother them none. So I don't think it can get any worse. Unless we get nuked. Biden made a deal with farmies. He made sure and he yelled that out loud and clear. Screamed it out. I ordered it. I did it. Apple popped up. What's another one? Got Tesla. MU. Probably got an upgrade. George Soros Fund places new bets on Apple and Broadcom. There's our leader right there, George Soros. Okay. Yeah, I like that extension out. I can read a little bit farther out the chart now. I just now thought of that. Yeah, I got it. That's going to change my predictions a little bit. Might have to move it back. 9, I mean, the moving averages will be fine, but not the trend lines. Yeah, maybe. We'll find out. 425. I guess I took my eye off the ball. We're retesting the breakout. They have a price target of 645 from Tigris. Go get my water and I'll be right back. Anybody on YouTube got a stock they want me to look at? 425 on my call. Should have got 2 of them. I'm just playing it too safe. Don't predict me much. I'm going to create an alert for resistance to break. Mark at or above. AMD new high. NVIDIA Apple broke the 200. Laggard is Meta. We're at 430 now. There we go. We do have the 50 here. I think we can get up to the 200 if it decides to take off. You don't respect me much. Spy broke out. 1, 2, 3. Uh-oh. Meta at 63 now. We're up $50. Contract. If you got a couple of them, you can take your profit and run. You got in around 490, 495, 380, 395. Got the VWAP next. So if it respects the 63, we'll move on up. Right now you got a doji here, which I'm not too scared of yet. It is a sign of consolidation. You can get out if you like. Now, SPX just had a new high. Okay. See, I'm listening to CNBC and they act like they got a heart. They were talking about Kamala's going to put something about a $6,000 child tax credit. I don't have a kid, so it ain't going to do me no good. It just cause more, well, I don't know, under a year old. There is extra expense when it comes to a newborn if you're both working and need to get talking about cutting tariffs. They did that with Iran and it caused a world war. Or a big war. Oil production is going to stay the same. We're at all-time highs right now. MU's double topping. I might exit my trade at the VWAP. We'll see here if we can hold and break this thing. The 63. That's the 63 VWAP 200 SMA. Now, what time is it? 9:20. We got a Baba's got a triple top. Economic plan features new tax cuts. She's a puppet. Just remember, she's going to be a puppet. She can't think of all this shit. I heard they did a bill about collecting taxes on tips. Now she's against it. Kind of reminds me of John Kerry. I was against it, but now I'm for it. I was for it, but now I'm against it. Remember that campaign promise? Yep. That's right, Magnificent. You get an A+. Oh, Kamala stole it from J.D. Vance? I'll tell you, it's something else. One of my liberal friends this morning I said, I don't see any difference in prices in groceries. And I said, and I was thinking, what? He said, no. So he showed a picture of him shopping at Aldi's. I just thought it was hilarious. I shop at Aldi's sometimes, but so I had a couple of boxes of food, and I said, that's all you got for $100? Back to 405, Jimmy called the exit idea on Meta. 450. We come back down here for a strong buy again. To do. So we just broke support on, well, maybe not. Nope, we just hit support on SPY. This is a rising wedge. This is the 3. Oh no, I don't want to trade it yet. We had that huge run yesterday, and we're respecting that run right now. That's a 15-minute. So that's resistance, I think, right there. 55312. The 200 SMA is support for right now on the SPX with 3 white black crows. SPX. We did get a new one. Bounced right off that support. Oh hell, I haven't even got my apron off yet. Every job I've had, I wore an apron. I can't think of one I didn't. Dishwashing, I had an apron. Picture framing, I had an apron. Inventory, I had an apron. Inventory specialist. Custom frame shop, I had an apron. Always clean, I had an apron. Every job. Except this one. I'm going to go turn the light off and I'll be right back. Get me some coffee going and my water. Oh, I'm still in this trade too. I got another one. Buy the dip here on this here. 1, 2, 3. And we got a 1, 2, 3 top. So it has to hold here. I don't want to see it come down one more time. If it does. So I'm going to grab another one. Right back at the same price. $3.95. So this time I got 2. Its resistance to break will be the 50 SMA. And I think if we do that, we'll shoot on up. Scalped and back in. Easy as 1, 2, 3, baby. We got a little bitty inverse head and shoulders, a little bitty midget. This time we're going to see how tough we are. I think this is the last chance for it to break. And it is. We got a half hour for the fat cats. $3.95. I'm very tired today. I'll probably take a nap, call it half a day or something. So we got a 1, 2, 3, and a 1, 2, 3, but this one kind of lingers down a little bit. So we, if it doesn't break here, we can pull it back down to 528, $1.50 dip. That'd be your 1, 2, 3 on the bottom. This is an inverse head and shoulders with a midget head. I don't think she'll steal the plan to close the borders. I don't understand why politicians don't get that human trafficking. That's what I would say all the time. Anytime I talked about it. Every time I talked about it, I'd say human trafficking. And we got the QQQ down 13, IWM down, SPY down, shop. They were posting about shop. It had a good run, pre-market run yesterday. And Siri, not worthy of my watch list, really. What happened in the video?
Year, but I just have better, I think, memory than these markets do because we've seen brutal moves to the downside in Palo Alto Networks. As you can see from that chart we got back in like the spring, basically. But Street's expecting earnings per share to come in down about 2% from last year.
Well, that ain't good.
Expected to actually rise about 11%, but this company does rarely miss estimates. They've either met or exceeded expectations in 16 of the last 17 quarters. However, spending fatigue is one note overwhelming that the more bearish camp is arguing that this has been a major theme of the company's results in the most recent quarters, signaling some headwinds in the overall cybersecurity space. Their guidance has been used as, I think, a barometer for the overall sector, and they are expected to provide guidance for their fiscal 25 year, with analysts expecting revenue of around $9 billion, just over $9 billion. But they've been leaning into some of these platformization efforts where they consolidate their cybersecurity services on their platform and bundle offers to try to become this one-stop shop. So that's really what they're doing well, versus like a SentinelOne or CrowdStrike, which focus mainly on
we got
endpoint protection.
IWM breaks the 200, will go higher. We got a 1, 2, 3 on the QQQ.
Claims to offer a broader range.
SPY bounced back off the 363.
Very clearly so, has been fizzling out. I just looked at their growth rates from the last 3 quarters. So first quarter of this year, growth was around 20%. Then it was 19% in the second quarter, and 15% in the third quarter. And for this quarter, we're expecting another 13%. So you can just see notably the declining growth that this company has really printed over the last 3-4 quarters. Now, Street still likes this name, amazingly enough. Like Evercore ISI did just name it to their tactical underperform list ahead of the earnings, saying that survey data, well, it's mixed this quarter. There's a lack of conviction from investor conversations, along with elevated sentiment. So they actually believe that Palo Alto Networks' fourth quarter could serve as this clearing event. I think there's a lot riding on that expectation, considering the timing in which they report is never like a market-moving event. They reported on a Friday once, and that was a huge negative catalyst into the print that ended up being fine. But hey, 39 buys, 15 holds, and not a single bear in this name. So there's still clearly conviction. And of course, with the CrowdStrike fallout, this name has been seen as a major beneficiary. But will that actually translate into dollars and cents? We need more guidance on that, I think.
That's a big point. I love that point, actually, the last one there on the CrowdStrike implications. Because a lot of folks have argued that it's going to all stay at CrowdStrike, but then I feel like there's a good case to be made that someone's going to pick up some contracts because.
So far, I'm not seeing much.
Rick, not without any, downdrafts here along the way. But are we still in an uptrend, or what is this?
Well, that's kind of a hard question to answer.
Now the SPY's coming down to hit the
that the broader
trend line.
Triangular here, because we had these highs here near
bull flag.
We're down about 12% from that level, but we also had this low point shortly after earnings. So we have 2 white trend lines here converging toward each other in a more triangular pattern. Now, to the upside,
PANW.
Make a little bit of a push this week. However, we are retreating. We are basically right on the nose of that upper trend line right now. And the point that we stopped, this red line near 346, was important. That was an area where we topped out several times in the past, and once again yesterday couldn't quite make it above that level here. So even though we broke out of the prevailing triangular pattern, we still halted at resistance at this key level near 346. So, kind of a mixed picture here. It's not a good sign for the bulls that we failed at resistance. We're kind of retreating back within the boundaries of this pattern. It could just be a retest of this old resistance before we continue to the upside, though. RSI also kind of more geared toward the bullish side, trending downward overall during the broader picture of last year, but we are above the 50 midline here, so that's a more positive sign here. We are also quite close to a volume node near about the 340 level here. So that's another potential area to work through. If we were to move to the downside, we've got our moving averages near 320 and 326 or so, orange 63-day, yellow 21-day exponential moving averages respectively. Then we've got this low point right here that lines up with our 252-day EMA, our previous lows, our point of control, and our trend line here. So if we were to really collapse around, 286, 287 would be a key area to watch. To the upside, 346, like I said, then we could possibly fill the gap at this pink line here. 360 or so would be the area to watch, the next kind of hurdle to clear to the upside.
That'd be a huge ramp, exactly what bulls would be looking for if this old downtrend line becomes kind of a trampoline for a bounce now. That would be huge. That would be like the best possible outcome. Though I can't help but think that maybe the kind of gravity is still pulling into this area here. We've got the big volume though, but also it's kind of natural extension of this sort of wedge that we're getting pinched into. So it's a pretty tricky one. It's a tough one for earnings, frankly, because it kind of looks like even relative to recent history, it's kind of already run over. Big number. Maybe it takes some market from crowd share and you do it on a rip on it. Let's talk Snowflake, Jenny. Always fun, always volatile. Unfortunately, still disappointing for many since the debut.
I mean, really disappointing. This was one of these names we talked about yesterday. We were reviewing all these 13F holdings and seeing Berkshire Hathaway trim its holding after just losing substantial amount of money. They disclosed they completely eliminated their holding of 6.1 million shares of the company, which they bought at the time of its IPO back in 2020. The holding was worth about 1.2 billion at the end of March, but I mean, there was the thinking that they completely lost. There was never a profit made from that holding, which I think signals some of their performance we've seen since they went public, frankly. But Wells Fargo also has downgraded shares this week to equal weight from overweight, slashing their price target to 130 from 200, highlighting their relatively high valuation has become more and more difficult to defend in the current rapidly evolving era of open data formats, which they said between management, macroeconomic effects, and recent data breach are stacking up pretty difficultly right now for a name like Snowflake. Back in July, AT&T disclosed a months-old data theft, which affected nearly all of its wireless customers and involved information that had been on Snowflake's cloud platform. The stock fell, but recovered as it became other companies were involved as well. It wasn't just a Snowflake problem, but they said that no flaw in their software or cloud platform contributed to those breaches. But gosh, I mean, just the weakness of this name this year, we're down 36%. It's an ugly chart, and I will say that some of these names, you look at like...
Okay, we got number 4 now. This is the last shot.
It doesn't really give you any optimism either, because this name, frankly, even with this...
Number 4. This, if you ain't in the trade, 380.
We're still trading at around 189.
But we got to see. I mean, this is it. It's got to turn or it drops.
I had to triple check that to make sure it's right. That is ridiculous.
We've got like a couple pennies of earnings. It's like a mathematical anomaly. All right, yeah, look, I mean, still... 2 confirmations. Got that number 4. To Jenny's point here, Rick, you know,
It came back and hit support. So, yeah, if this doesn't hold, I'm going to get out.
Yeah, the chart is definitely...
Did you hear that, YouTube?
Right here. We're significantly off the lows. We're down about...
If this doesn't hold right here, I'm getting out of the trade. I'm not going to do what I did yesterday. And I got it at 395. It went to 380. I'm about to grab 2 more, but I sat there and looked at it. Did I say something right? I may not be able to keep up with you, but I want to give up or do nothing. Your influence pushes me when I don't want to. Are you talking to me, Tiffany? Oh, hell. I'm looking at something other channel. I'm getting a little loony over here. Fuck. I thought this chick was talking to me. Kind of gave me a compliment. Google up 2%. That's probably had a good pullback. Jim, what do you think of December calls on Microsoft? Okay, I'm going to look at the 4 hour. Right now, we're a little bearish. So I'd set an alert right off the 21 here, right around 4:15.60. Let's see if we got any confirmations. Yeah, right here. Right there. Let's bring this up. And we're going to bring it up just a little bit more so we'll be pre-alerted. Right there. 354.23. What? Oh, never mind. 4:15:34 is where I'm going to set my alert. Now the December calls. Let me see here. SPY. I got to keep an eye on the SPY. On the Meta. Ooh, they're kind of high. God. Are you talking about calls? What do you think about the calls? Yeah, I'd definitely wait for a pullback. And I'd look at the 430s or the 455s. The 430 or the 455. And then you got the 500. I figured it would go up during I don't know when that shopping starts. We missed a good opportunity right here off the 63. 5-day rule. That was a good spot. I would have took it there for sure if I saw it. So my other alert's going to be right down here on the bottom of these here candles. At 407.23. That's on the weekly. Yep, I like it. I'll raise this up just a little bit above that 200. 408.80. And if we stay above the 21, it'll go ahead and continue up. And that's the white line on the daily. We got a snake, triple bottom, 1, 2, 3 down here. So if you break the 63 for a scalp, you get $1.50 out of it. It's had a good pullback, but I don't know if it's good enough. And then your resistance is 429.57. For what? 428.98. 428.98. 429. Oh, shit. God darn it, I missed it. Okay. Grab one more. Well, that's not pretty. They made a strong buy on Meta. 360. I'm almost too tired to trade. TikTok says it should be treated like a new outlet. What it means for Meta. TikTok has a new argument for why it shouldn't be banned in the USA. Video sharing app should be treated like a foreign-owned media outlet. Man, I can barely keep my eyes open. $360. Blanket. $378. I'm going to get out right now. 375. I got 378 average. They dumped it too right before lunch. Do 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 do. I'm gonna make some coffee and I'll be right back. Sourpuss Day. Snake is retesting on all these here entities. The SPY, the SPX, the QQQ, and the IWM. And that just ain't going to work, I don't think. I got to get out of this. Let's see. It says it's ready, but I don't want to go by that. Get back to the VWAP. Took a 5, took a nosedive. If I was watching that, I probably would have got out. Well, let's see here. How the hell did I get in front of that? Well, looks to me like I got to get out of this thing. I like it right there. SMCI dropped from that high. Double bottom on SMCI. They were talking about that one this morning. That or MU. Might have been MU. No, not that one either. SPY kind of hit a pivot point on that last pullback right there. GLVX is on the scanner. That used to be one I traded. Nice pop. Oh man, look at that thing. It hit my resistance line. 572. GOVX. I'm still in Meta. GOVX. What is this? What was I going to do? Oh yeah. SOUN. Sound. Nope. Oh, there's Lily. I mean, LI. Speaking of Lily. I wonder how it's going to react with that this Biden administration. Or Harris. It's the same thing over and over again. How many times have we heard? We're going to get drug prices down. Lilly completes a $3.2 billion acquisition of Morphic Holdings. What's inflammatory bowel disease? Does that mean hemorrhoids coming out your butt? I am here to say, since I've lost my weight, I had a scientific study going on. Every time I go in there and take a piss, it's almost a whole cup. It was used to be a half a cup when I had a full belly. I mean, almost all I still got probably 3 pounds to go on my belly. I'll be at 160. Okay. Next. Disney is getting pumped. Got a new high on it today. Target 96. Actually, channel target, resistance target right there. The channel of resistance 94.82. After it breaks this 91.26. Okay, Jim, make a business decision. It ain't working for you. Yeah, I'm gonna take a nap sometime today. I can barely keep my eyes open.
Banks are still a little nervous about the small regional banks because you really don't know what's in their real estate portfolios.
Yeah, I saw you had Morgan Stanley, Bank of America, Jefferies, and Goldman being your number one pick. You also moved to the world of real estate, and you have Boston Properties and Kilroy Realty. Why now?
Well, those are two controversial picks because the death of the office has been proclaimed. We do think all REITs will do well, but the ones that have been heavily shorted or underweighted are likely to do best. And we do have a contrarian call that being in A or A+ offices is great. That's Boston Properties, concentrated in New York and Boston.
Yeah.
And a little bit in San Francisco. And Kilroy is probably even more of a controversial pick because they're in the West Coast and the tech centers. But we do think that this ruling by the Supreme Court that overturns the Ninth Circuit ban on clearing out homeless encampments is in the long run going to benefit the Western states and facilitate more back to the office activity. So, and also the AI boom is benefiting companies like Kilroy because those startups do.
It's bad out there, out west.
Because they're in emergency mode. So
Homeless rent's too damn high.
Yeah, understood. In the ETFs, ICAP and SCAP, ICAP has some of those names you just discussed, right? Boston Property and Kilroy are among the top holdings. Jefferies is a top holding in SCAP as well as the Russell 2000. You like some of those small caps?
We do. I think one of the misunderstandings about the small cap universe is that that somehow those are weak companies, that when rates are high, they borrow too much and they're penalized. Really, the problem with the Russell 2000...
Senior Hamas official says the group was briefed on the results of DOFA ceasefire talks.
...valuations in the larger cap of the same industries. But it's really mostly an industry weighting, but you can get cheaper companies in small caps, but it's important. In SCAP, we only have profitable companies trading at reasonable multiples with good dividend.
Okay, the ceasefire talks. You know what they're going to say? Come on, please stop the war and we'll rebuild your whole city. Of our taxpayers, buddy. Us. I guarantee it's on the table. Some kind of dollar.
Have a great weekend. Thank you so much for your insight.
Some kind of dollar amount.
Capital Advisors, Jay Hatfield. Plenty more
Guarantee
coming
it's
on
on the
Trade
table.
360 up next. It's the big three. Three stocks, three charts, three trades. Ben Lichtenstein goes to the technicals. Charles Moon will take us through the trades.
There's a lot of money to be made.
Next here on Schwab Network.
New Green City in Hamas. Cost estimated 10 trillion. Market's red. Boop, boop. I'll be right back. I gotta just lay down for a second and watch my stock. I mean, I'm real tired. SPY does look like, I don't know. I'll be right back. It is chop day. I'll be right back. Do. Which must trade.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time for the big three. Three stocks, three charts, three trades. Ben Lichtenstein will take us through the charts here to take us through the trades. Charles Moon, Senior Market Strategist, Equities at Prosper Trading Academy. Great to see you both. Happy Friday to you. First up, Coinbase. You're looking at this name well off the 283 highs, but it's had a good week. It's up 3% for the week, but 3% today. Most of that gain is today. Some of your thoughts, Charles, on this name?
Yeah, you know, Coin hasn't really participated with the broad market rally. We've seen a lot of snapbacks in some of these bigger tech names, Meta in particular, racing back to almost touching their all-time highs. So, you know, with Coin, I feel like this is a little bit stagnant because of Bitcoin itself having some struggles and really big washouts to the downside. But what really has been showcased here is that it's holding a key technical threshold, which is the 200-day moving average. And with stocks finding acceptance above this level, you know, all we're looking for is a little bit of propellant in both the markets to continue their rally and Bitcoin to start rebounding back. And this is where I find great opportunities on a buy low play, an extremely volatile name like Coinbase. If they could sustain above 190, I love the upshoot to around 215. And I believe that they could get up to 225 very, very quickly if Bitcoin and markets continue to sympathetically rebound here. So this is going to be a watcher for that acceptance at around that 191 level and that continuing rise here of the markets, you know, rebounding back after that unwinding from the carry trade.
Yeah, can it get up to some of those levels and hold the bottom too? Ben?
Hey Nicole, Charles, good afternoon. Massive move lower from 270 down to 160, but I don't think that validated longer term trend to the upside. The Intraday charts are a mess right now, and most of the products we're going to talk about and across the board are, right, with the spike lower last week and then the big move up we've seen in reaction too. But I wanted to avoid the intraday look at price activity here and just start off with the daily, and then we'll take note of that 200-day moving average Charles reference. But daily candle chart, bottom left, top right, easily identifiable trend up. Now, we lost some of that conviction after topping out at 283 back in March, if you remember, mostly sideways since. Here's the dip lower, V bottom that's come into play. Let's just take a look at some of these areas of consolidation where the market's been pausing and kind of regaining composure because value's been forming higher, right? So again, this move lower, not necessarily what the bulls wanted to see, but still holding up above 150. Take a look here, longer term chart, adding a bit of time on. You can see three really well-defined areas of consolidation. And again, that pullback, that move lower last week to 161, never got below that key area, 150, the middle of the last area balance that we formed. So probably what we're going to end up doing is bringing this 240 down a little bit, maybe to the 220, 215, 220 area, the middle of this range, as we start to fill in some of this area above these highs where we are above this 200 level if this bid continues. But I wanted to show you, Charles referenced that 200. We're finding support on that. It's the yellow line here. Still got to get back above the 50-day moving average. That's a reflection of some of that wicked sell-off that we saw, that weakness that came into play. But yeah, this is a stock right now. Coin, build momentum through the middle of this range, get above the 50-day moving average. I think we can retest 283.
All right, can we? Well, let's see. And talk more to Charles. Final thoughts.
Yeah, Bitcoin struggling to sustain above 60, that's going to be a pretty big catalyst. If they could actually find acceptance above that level and turn higher and this market continues to rebound, there's no reason as to why coin can't participate. And, just as fast as it comes down, we've seen how fast it could rise up as well. So for me, again, these important thresholds, it's really important that 161 level, if they would have lost it, they would have been down by the 140s, 135s to fill that big gap. But instead, we've rebounded back and we've been able to sustain. So, the fact that Bitcoin has rolled, but coin has remained above the 200-day moving average really gives me a lot of guidance that the market participants are trying to rise this stock up. And we could see that really fast pop to that 215, 225. And I'm with Ben, above that 50-day moving average, they should easily rise back up to 272 to 283.
Yeah, I'm looking next at the AMD chart, which the high was 227. Similar chart, it had a high not that long ago, but has been moving lower, but trying to give it a go right now. Not a great chart off the highs, but let's hear what you have to say here. 147 today.
Yeah, what's really been standing out with AMD to me is the strength that's been exhibited to a degree since their earnings report. Very positive result. They rejected at the 200-day and spiked down when the market started unraveling, but it's made a very sharp V reversal. It's recovered here. It's really working that trajectory back. Now, the question is, can they ascend beyond that key threshold of the 200-day moving average and 50-day simple moving average? There's been a lot of weakness in the stock that's been exhibited since it gotten below that level. Now that buyers are trying to bring this back up, along with the other semiconductor names, they've really stood out here a bit as being a stronger performer, holding up better when the other participants have rolled back. So this is where I see them running to that 155 for that retest. And then again, if they could accelerate through that 155, 160 zone, it wouldn't surprise me that they'd really get up towards that 178, 180 price range to fill that gap and perhaps start to recover. Since they made their 52-week highs, they've been really, really punished and really hit down. Very contrarian to a lot of the semiconductor names, but this is one that I still believe holds great value and really great opportunity both in the near and long term.
So maybe it doesn't deserve to be down 5% over the last month or so. Let's see what Ben says about the chart.
Couldn't agree more, Nicole, and Charles' levels, they're spot on. Let's take a look at the charts. First and foremost, a 30-minute candle and how we are reversing a bit of a downtrend that we had seen off the July highs. That was up around 187. If you remember, we always talk about these areas of value helping us determine trend, because here you can see value is forming at lower and lower levels, 183, 63, 153, 143, and while we were balancing around 130, the bears didn't want us to get above 143 because that's a bit of a reversal. They wanted us to take out that 120 low and form a new area of value at a lower level to solidify the working assumption that we were still trending lower. In fact, look at that. that working assumption's been invalidated at this point because we've now started to take out key areas that were determined on the way down. So yeah, I'd have to agree. Next big hurdle, Charles, I think was talking about the mid 150 level. There's that next big area, and then I think get above that, and you're looking at 170 ultimately. I always say through the middle of balance area after failed lower extreme tests in a trend environment to the upside, you build momentum, you get participation, you get energy. Take out those highs that we saw back in the beginning of July. Ultimately, we could retest that 227, 228 area. Very textbook example of a trend up here. Again, not what the bulls wanted to see, but holding above key support around 115. Let's show you where we are because Charles mentioned that 200, that 50. Get above them, I would agree. That would probably add to some of the momentum. That coincides right around that 160-ish area. And again, this chart, a pretty good example of a V-bottom type pattern. I always say they're not, it's not a common event, right, to see this kind of volatility that we've seen over the last couple of days, but and consequently, V-bottoms aren't either. So this chart, again, seeing some recent price decay, but not necessarily taking out key levels that were established on this longer-term trend up.
Okay, yeah, because 6 months it's down 16%. Let's get to the next one. Alibaba, Charles?
So Baba, along with a lot of the Chinese stocks, haven't really participated in the broad market rally at all this year, and obviously that's tied directly to China, but there's been a spark in these Chinese stocks over the last few days, especially since Baba has really lifted up yesterday on earnings. They are in this kind of short-term breakout threshold now. If they could continue to push, this is where I could see them really making this run up towards $88, $90 here in the near term. They have found a lot of acceptance above key technical levels, and most notably the overall response from earnings, where it was initially down, but intraday-wise it was bought up very aggressively, and we're seeing that momentum spilling into today. Could lead to this really nice risk-on rally. This market right now is really living almost on a day-by-day basis. Everything has been short-term, but because of the volatility, there's been really big expansion on normal trading ranges. So for me, it won't take long for Baba to race up to this 90 and with this upside momentum, especially coming off earnings. I really see this potential here if the market continues to stack on these recent gains for this to make this run towards that 90 here in the near term.
Yep.
All right, look. What a boring sort of stock. I mean, it's good because it's higher over 1 year, year to date, 6 months, 1 month. But all of those moves are 3%, 1%. So certainly not seeing a lot of volatility, right? But let's see what Ben says about the technicals.
Yeah, it has been a bit of a lackluster trade. It's been a bit of a mess as well, as Charles mentioned. This one trying to establish a little bit of a bottom here, and I would agree in terms of the 90, 93 area. I think I have highlighted as the big level to get above. But let's just start off with the daily candle chart. Baba going all the way back to, we're talking July of 2022. You can see range bound, lower lows, lower highs, just this kind of triangle pattern forming, but no real staircase type pattern like what I like to look for. Trend, value, migration thereof. I mean, this thing has been sideways recently, coming off some lows we saw around 70, back up into this $85 level. So let's take a step back. When in doubt, zoom out, I always say. Here you can see a trend lower, but I would agree with Charles. While even within this trend to the downside, we could still see some momentum higher here as we have established a bit of a bottom. It looks like get up above 90. We could target this 120, 130 level and still remain within this longer term trend to the downside. So there's some kind of wiggle room, as I like to say, even within this balance, this area that's been forming. I'm going all the way back to, we're talking the fall of 2021 here. We gapped down, if you remember, through that 150 level. We really haven't looked back. Series of lower highs, but we haven't really taken out the bottom and seen further follow through. Most of the conviction on the left side of this chart, and you can see the sideways consolidation, just acceptance thereof. Wanted to show you, Charles mentioned this instance, the 50, the 200-day moving average are bouncing off of those. So again, further providing a bit of lift within this bigger range that's been established here. 93, 92-ish, it looks like, those highs that we have from back in May. So
he charts like I do sometimes.
Yeah, building a little bit of momentum here and definitely trying to establish a little bit of a bottom in this longer-term downtrend that's still in place.
Come on, you idiot. Look at the triple top.
All right. Thank you both. I'm going to leave it there.
We got to break 87.
For Trading Academy. Ben Lichtenstein, thank you both for the big three today. Coinbase, AMD,
double top.
Alibaba. Coming up next,
88.62.
Bill Atkins Hedge Fund 3 million shares now. We found that out. Diving into the company, what happens to this one? And a double upgrade it got today. More. We'll be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Spy popping a little bit. SPX hit the 200 exit idea.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern.
I'll be back again.
Anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Time to spotlight Nike. So we mentioned the double upgrade earlier to a buy rating, and yesterday there was big news that Bill Ackman's Pershing Square disclosed a small stake in the company. So let's see what David Swartz has to say, equity analyst over at Morningstar. You have a 4-star rating, a 124 target. You do think it's undervalued. It's at $83 today. How does it get to 124? What are your thoughts on Nike these days?
The outlook has been pretty poor for Nike. Nike had no sales growth last year, and the outlook for this fiscal year is for a negative sales number. So, you know, I think anything that shows that Nike is getting back to sales growth will help the stock price. Right now, you know, Nike's in kind of a down cycle, but there's a lot of new merchandise coming out. Nike's done a lot of marketing recently, certainly during the Olympics. We saw Nike ads nonstop. And so, you know, I think that any kind of indication that Nike's business is turning around will definitely help the stock price.
So let's talk more about this. I mean, was it a surprise to hear about the stake from Pershing?
No, I don't think so. I think a lot of people are looking at Nike right now because the stock is down so much from its high. You know, I think at one time Nike was quite overvalued, and in fact I did rate it as overvalued, but Now I think it's swung too far the other way. It's my fair value estimate on Nike has come down a little bit because of the poor outlook for the year, but not that much. And so, I think at this price, I think Nike's quite attractive. It's not exactly inexpensive on an absolute basis, but it rarely is for Nike. Nike tends to be a pretty expensive stock. And there's a reason for that, and that's because Nike has very strong investment returns. But if you look historically, when you buy Nike, when it's in sort of a down period like it is right now, and you hold it for 5+ years, it's been a really good trade. And of course, I think that a lot of people are now looking at more of a value investment rather than just a growth investment that usually is.
Look, it pays a dividend. People believe in Nike. It's a great brand following, but it has a competitive landscape for shoes and for athletic wear, right? What about some of those other ones that may be a thorn in the side of Nike, whether it's Alo, Yoga, Lululemon, the Hoka sneakers, or the On-Cloud sneakers?
Yeah, there's a lot of indication that the sportswear market has become more competitive over the last 5 years, and Nike has to deal with that. Nike has also probably made some mistakes that it needs now to correct, including pulling out of a lot of wholesale accounts, and that has opened up market share and floor space opportunities for its competitors. And some of the ones you mentioned, like Hoka and On, have done really well, and they've come out with some very strong products that Nike needs to compete with. In other countries too, like in China, Nike has to compete with Anta and Li Ning. And so, there is a lot of competition, but it's also a very large market. The sportswear market is so large globally that there's room for a lot of successful companies, and Nike is still the leader. It's still the #1 market share company in sportswear in just about every major country. And it does have a lot of advantages in terms of product development, R&D, marketing, certainly sponsorships of athletes. And so, I don't think it's impossible for Nike to turn it around. I think that people are perhaps overplaying the risk of competition, because there really is a lot of market share to be had here. The sports market in general continues to boom. I mean, sports continue to grow worldwide, and there's still a lot of opportunities in countries that right now the sportswear market is relatively small, but in 20 or 30 years could be much larger.
I mean, I have to assume that you think there's confidence for consumers that they'll keep buying this brand when you put a 124 fair value target. So you think Nike is positioned well. And this is the one you have definitely a buy rate, 4-star rating on. Do you have 4 stars on the competitors or other names in retail?
Yeah, right now, I think, for example, Lululemon, which you mentioned, Lululemon stock price has just crashed since the beginning of the year. Because there's been a lot of concern that Lululemon sales growth is slowing down in North America, and they've had some product issues and some other things. But Lululemon is at probably its cheapest point in a long time. Typically, I've had Lululemon as being overvalued. When it was over $500, I had it as extremely overvalued. Since that time, a lot of the analysts with the stock down have cut their price targets, but I actually raised my fair value estimate after the last quarter. I think, again, as with Nike, there's a big market here, and one of the benefits for both Nike and Lululemon is that with their stock prices down, they're going to be able to buy back a lot more stock at much more attractive valuations. And in the past, I think both Nike and Lululemon have bought back stock at perhaps undesirable levels. But right now, they're going to be able to buy back a lot more. And I think the valuation is fair for both Lululemon and Nike. And it wouldn't take that much to convince investors that these are companies that are going to turn around, because these are still companies that generate a huge amount of cash flow.
Yeah. Is there anything you would want to change about Nike? I mean, the direct-to-consumer, the China story, the spokespeople that they use. If you had a piece of advice for Nike, what would it be?
I think Nike certainly has made a mistake in pulling out of too many accounts, and that's why Nike has gone back in to some retailers like DSW and Macy's. Nike, I think, prioritized the collector market and sort of the sneakerhead market too much. But Nike, with $50 billion a year in sales, needs to sell to all different people and all different demographic groups. And I think Nike lost a lot of the family market, meaning like parents buying shoes for their kids, for example. Those are cheaper items, and so maybe Nike wasn't that excited about selling them, but yet Nike has to sell a large volume of products. And so I think Nike lost some of those customers, and they lost them to some other competitors like Puma and others that have kind of stepped up. And so, Nike needs to get those people back.
Yeah, you see Under Armour, you see Adidas, Puma, to your point, David. Great to see you, David Swartz, Morningstar. Thanks for being with us. Appreciate it. Coming up next, the Disruptors. Kevin Green will join us, take a look at Applied Materials after the earnings yesterday afternoon. He'll break down those numbers, give us an example trade. Next on Trading 360.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Pinalides, live on the floor of the New York Stock Exchange. Glad you're with us. It's time for Developing Stories. I'd like to bring in Diane King Hall, Senior Market Correspondent here on Schwab Network, taking a look at Autodesk after a report that continued to use controversial sales strategy. The stock's down almost 1.5%.
Yeah.
Some of your thoughts. What are people saying?
So this is off the back of this Bloomberg report that the Autodesk has been using this sales strategy where they awarded these multi-year contracts to some of their customers, and they had allegedly promised that they would stop doing this, or they had reportedly promised that they would stop doing this back in 2021, but it's showing up as a practice still in action today, and there are some questions about what this means for how their accounting looks, right? And the documents first came under scrutiny back in April. There was more questions about their financial accounting practices in May. There's been some activist investor activity around Autodesk as a result of this. Starboard has been pushing for changes at the company because of this. Autodesk has said reportedly that they won't completely, that it's decreasing this method of how they're accounting for sales. These upfront billing is decreasing, but it won't end entirely. They say, quote, as we consider customer preferences and their presence in emerging countries. The note that they made is they said that the internal investigation showed no changes to their financial statements despite some questions about what this practice means and signals in terms of how it accounts for its billing, etc. But right now, the stock is under some pressure off the back of this strategy that it's still been employing, but even employees internally allegedly say they shouldn't keep employing this practice.
So they ignored internal warnings. Reportedly, this was the report about these accounting risks, and you mentioned Starboard and that big investor, and looking for maybe a CEO change.
Yeah,
right?
exactly.
I mean, and some value-enhancing measures. It sounds like a lot of frustration.
It does, and the CFO being pushed out as well. Back in May, they said they were replacing Debbie Clifford, their CFO. So it does sound like the activist investor activity around this is pushing for a lot of change at the top, at the C-suite for Autodesk, and employees have been talking about just the risk as a result of how this accounting occurs, because of how they're kind of accounting for the sales, and even the salespeople say it doesn't really help how they're accounting for the sales and booking deals because of how it shows up in the fiscal year and how they offer discounts to some of these corporate customers.
Yeah, Diane King Hall, thank you so much.
You got it.
Good to see you. Now it's time for the disruptors, because we'll bring in Kevin Green, senior markets correspondent here, taking a look at today's company, and that's Applied Materials. Stock a little lower here after the earnings that we saw yesterday. Take us through the reports, down about 2.5%.
Yeah, seeing a little bit of a pullback here, Nicole, but we also have to kind of keep in mind it had a really nice rally going into the close yesterday. So just giving back a couple of those gains here. But we actually did see a beat both on the top and bottom line, with net sales coming in at $6.78 billion. It exceeded the street's expectations of $6.68 billion. And the adjusted earnings per share came in at $2.12. Street was looking for $2.03. When you're kind of looking at the revenue mix here, there was a little bit of a bright spot, maybe some mixed results here, which is probably also causing a little bit of a sell-off. China's sales actually did rise by 24% on a year-over-year basis, coming in at $2.15 billion here. It's around 32% of total sales, but when you look at the past, it's actually been averaging at around 43%. So that just means that we are seeing some weakness in China, maybe a little bit of a recovery, but once again, not at the rate that we used to see for this company. In South Korea, actually saw sales increase by around 12% on a year-over-year basis, a smaller segment, but one that they have seen a lot of growth here. The revenue forecast also pretty much came in line with the street's expectations. Nothing to really write home about there, but overall they're still seeing demand when it comes to AI and artificial intelligence. I think the biggest question mark still is going to be the shipment of goods over to China for these fabrication facilities, because of these restrictions that we are seeing between the United States and China. It appears that they have been bringing in their revenue forecast a little bit lighter in light of that, but once again, if they do actually see a little bit of a reduction in some of those restrictions, that could be a tailwind for them in the future. But overall, it was actually a pretty decent report.
All right, thank you. Kevin Green, great to see you with the disruptors this week. Thanks. Oh, wait, an example trade. I can't let Kevin Green go without the example trade. Go ahead, Kevin.
I'm sorry. If you do expect a bull move here over the next couple of weeks because of NVIDIA's earnings that we're going to see on the 28th, you could actually look at doing a debit call spread, the 220-250 call spread expiring on October 18th. Doing this for a debit of $6.80. So the max loss would be the debit paid $680, and the max gain would be $2,320 with a break-even point of $226.80. Once again, you want to see the stock actually rise to the upside. You're getting a little bit more time as this does expire in October, but you're also minimizing the risk as, once again, that is the debit paid here, Nicole. So if you have a bull thesis on semiconductors and you think Applied Materials could be a part of that, this would be the trade to be able to complement that thesis.
All right, Kevin Green, thank you. Coming up next, our 360 round, we're going to look at all those restaurant stocks. So many names, we saw a CEO change, right? That was a big one. Fast casual restaurants. We're talking Starbucks and some of the others, Chipotle. What do we need to focus on here? We'll be right back here on Trading 360 on Schwab Network.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Ethan, how's my favorite client?
Great! I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Schwab Network's like no other financial media you've watched because it's all markets, all the time. It's 100% finance. We look at everything as traders and investors, and everything we say, everything we do is through that lens. There's no ulterior motive, and there's no subjectivity. There's no random guesswork about what we think. We are following the numbers all the time relentlessly. We have the best CEO interviews, hands down. They're longer, more thorough, and tailored specifically to our audience. We never take our eye off the ball, which means we're always ahead of our peers.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back, Trading 360. It's time for our 360 round about the restaurant stocks. Of course, earlier this week we had the big changeover at Starbucks with the CEO out, effective immediately, and Brian Nickel coming over from Chipotle Mexican Grill, and people really liked that. RJ Hottovy is with us, head of analytical research at Placer AI. Wanted to get some of your thoughts on some of the trends we're seeing in the restaurant space. You basically noted that people are really deal driven. Why don't you give me some examples of that? How is that working?
Yeah, exactly. I think in this environment right now, consumers are very receptive to deals, and we see it across a lot of the food retail category, including restaurants. I think if we go back to May, we saw a couple of big promotions in the casual dining space. We saw Chili's with their value promotion. We saw Buffalo Wild Wings doing all-you-can-eat wings promotion on Monday and Wednesday. Some really impressive visitation numbers for both of those chains. We saw that in Brinker's numbers this week as well. As we flipped the calendar to June, that's when we started to see a lot of the bundled meal deals for a lot of the QSR, the value wars, if you will. Burger King, Wendy's, Arby's, and several others. And then July was really McDonald's month on that. where we did see, their $5 meal deal drive visits. But I think the important thing is that even though we've seen a lot of visitation, consumers migrate to these, they are still shopping other channels. They're still going to value grocery. They're still going to dollar stores and convenience stores. So I think, QSR and full service restaurant companies are going to have to work harder. They're going to have to innovate. They're going to have to find creative ways to bring people back in the door. Value is part of the component, but there's other things consumers are looking for right now.
And does that cut in, RJ, into the bottom line? And we think about profits and margins and all that. Are you concerned now with all these deals that are happening that some of the numbers could be weaker going forward?
I do think there is a short-term risk in terms of margin penetration. I do think that we could see some gross margin, operating margin pressure because of the deals that we're seeing across the board here. I do think that is a short-term risk. The big key is if you can drive that increased visit and then keep them coming back. If they come for the value, but continue to shop and maybe find a way up the menu. I think that's a win-win for these companies. It's a trade-off that they're willing to make. It's a little early to make that call at this point. I think right now we're still in this very competitive space in the food retail category. A lot of deals, not just in the restaurant space, but across all channels. And so I think that's going to be the big hurdle that a lot of the restaurant chains have to overcome is that repeat visit. Can I drive that customer who came in for that deal? Will they come back? And that's going to be the key in the second half of the year.
Yeah, get a repeat visitor, foot traffic, get back in there. Of course, they have a lot. They use the deliveries, of course, right, to your home, or curbside pickup, things like that. But they have labor, they have trucking, supply, food costs. Which of those may be among the headwinds?
Yeah, I think labor's, you ask any restaurant operator, labor is the number one headwind that they're facing in today's environment. To be frank, it's why we're seeing a lot of restaurant chains start to adopt different AI and other technologies to either simplify certain processes or help out. A lot of news about AI, drive-through ordering the last couple of weeks. So it is kind of what we're seeing there. We actually have seen rent. We're back above where we are pre-pandemic in a lot of cases. We saw some rent relief during the pandemic, but we're starting to see that creep back up. So it really is expensive for restaurant operators right now. You understand why prices went up, but at the same time, too, now you're seeing competition with Walmart, Target, and others who are rolling back prices. You're seeing more promotions at grocery store. You've seen expansion from Aldi and others that have really made it very competitive for the restaurant space. So at this point, you have to be mindful of value, but you still have to innovate. We still haven't quite seen the space turn the corner on the innovation front. We're seeing nostalgia come back. McDonald's with their collections meal, Taco Bell introducing some discontinued items. That's helping, but the restaurants need to keep that pipeline going right now.
Joining me now, joining our conversation, is Phil Kaparakis, President, CEO, IFMA, International Food Service Manufacturing Association. And you're noticing some trends, some food away from home projections that you have in your report. Tell us about that, Phil.
Yeah, thank you, Nicole. We're watching the same thing. Everybody on the street is watching. The traffic is certainly down, but we've got winners and losers when you think about what's happening in this segment. You've heard this week some great stories. When you think about Chipotle, you think about the continuing success that's happening in Texas Roadhouse. There's people out there having great same-store sales, but at the same time, you've got issues with some of the more traditional quick service restaurants. The value meals are going to come back, and that's where this is headed. I think we're going to see some of those traditional. You've seen the $4 value meals. You see some of these kooky things that happen, free French fries on Fridays, etc. So that promotional activity is going to go into the holidays, trying to make sure the consumers are still trying to get value, particularly at the lower end.
When you talk about winners versus losers, Phil, what makes a winner, or can you name some of the winners?
Yeah, I think when again, not to talk about Chipotle too much because they just had a huge exit, but they've got great talent to replace Brian Niccol. Their CEO's going to Starbucks, but you've seen what they've done with their value proposition. They continue to put out great food. They continue not to have complexity on their menu. They have had a little bit of innovation as they've added a couple of new ingredients into their programming. And they've done really, really well. Wingstop is another one of these chains that has had success over the course of the whole year. Very focused on wings, very focused on value with respect to that. You look at what's going on Texas Roadhouse and the fast casual segment as well. Even yesterday, I think we heard some great news from Chili's as they do kind of a barbell pricing strategy, trying to get consumers in. So it'll continue to be that way, particularly going into the holidays.
Yeah, and you guys are on the same page, at least on some of these names. RJ, I mean, are there losers too, or what makes a loser at this point in the industry? I mean, Starbucks certainly has had a tough run. Its last quarter was horrible. And so Brian Nichols has a big job. You know, Starbucks is no Chipotle. Starbucks is completely different. So are there losers or struggling names that you think may have a chance or that you're watching, RJ?
Yeah, Starbucks is a great place to start here because it's actually, when we're thinking about it, it's very similar. There's a lot of similarities to when Brian took over the role of Chipotle. It was a brand that had started to stagnate. It was facing increased competition. And so he comes into a situation, immediately starts doing television advertising, immediately starts bringing new products, new promotions, and pretty quickly, we went back and looked at the visitation data. It was pretty much a matter of 6 months before you really started to see a pronounced turnaround and an inflection in results. That TV campaign in late 2018 really was the first way to reintroduce customers to the Starbucks brand or the Chipotle brand. And then they did things like lifestyle bowls, and then as Phil mentioned, they introduced the proteins. Carne asada came out later that month. And I think it was a similar blueprint for Starbucks here. Maybe more television advertising, maybe really focus in on the things that make Starbucks different from some of the best competitors, and new product innovation's got to be there, both food and beverage.
Yeah, RJ Hottovy of Placer AI and Phil Kafarakis of IFMA. Thank you both for a look at the restaurant names today. I'm Nicole Petalides. Thanks for joining me here on Trading 360. I'll see you at 2 o'clock for the watch list. Download our free Schwab Network app. It's available in the Apple App Store. Tune in 24/7, schwabnetwork.com. Keep it right here. Fast Market is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, including discussions and strategies using options. We're going to talk Tesla, which is up about 8% so far this week on positive consumer data, and Nike, which has bounced off of a recent 4-year lows, maybe some expectations of a CEO change, who knows. And like Folio, break down consumer sentiment data in Apple, which is up about 4% this week and is back near post-earnings levels that we saw, but still off all-time highs. Now let's take a look at the major indices, which are hovering around the flat line, pretty choppy trade, maybe a little bit of a consolidation after this week's rally. S&P 500 flat, Dow up about 40 points, NASDAQ just slightly in the red, and the Russell 2000 small caps up nearly 0.1%. Help me break down this market action. Let's bring in my co-host for the day. That's going to be Alex Coffey, Senior Equities Contributor here on the network. Alex, it almost feels like the market's taking a little deep breath here after the massive rally that we've seen. NASDAQ 100 up over 5% this week, S&P 500 up nearly 4%. So maybe this is kind of what's needed after the optimism and the rally that we've seen this week.
Yeah, I was on at the start of Oliver Rennick's program, Morning Trade Live. I was on around 7:30 Central with Ben Lichtenstein on futures, and one of the topics of conversation with both of them was around volatility. The moves that we've had the last few days are bigger than what implied volatility suggests would be the case. And for example, this morning we looked at the E-mini S&Ps on Ben's show. The 30 trading day historical volatility was somewhere around 20%, but implied volatility, we know by looking at the VIX, is somewhere around 15%.
Right.
That's usually not sustainable. Right. So one of two things happens. You either get perhaps a correction in volatility where it increases. Oftentimes that's associated with a move lower in the product if it's an index for equities, which I would say when you have that discount implied volatility oftentimes is the resolution. But if you do get a consolidating market, well, that'll reduce that realized volatility. It'll get things more in line with where volatility on an implied basis is. So said another way, either the VIX is going to go up or the market's going to slow down its movement. Doesn't mean it's going to go down or go up, but just the price moves will get smaller because that's what volatility suggests should happen.
Yeah, the fastest decrease pace for the VIX ever in its history since that real big spike up on Monday. I know we always talk about, hey, VIX hit 65 level. That was ahead of the open. Kind of wiped that out. I like your take on this. Look at the VIX futures, because that'll give you a clearer picture where.
Well, some bottom at 37.5. Like that there was a filled trade there. So someone's long. We don't know where they
hopefully
potentially sold them, but
hopefully they're out of that.
Jimmy's winning.
Alex, if you look at the velocity of
I'm tired. I am really tired.
Week, 6 straight
I don't
days
feel
of
good.
gains for the S&P 500 and the NASDAQ. I mean, I think that's what throws a wrench into a trader like myself that's been doing this for years, is when I see moves like that, 6 straight days of gains and the velocity and the parabolic move, just a snap back, it's not concerning, but it's not sustainable, right?
Yeah, I think the easy part of the recovery is probably done. This kind of gets us back to where we were post-Fed, in that kind of same range where we found ourselves in that, in the NASDAQ, let's call it maybe a 200-300 point range for almost the better part of 2 weeks. The S&Ps, maybe it was a 50-point range for the better part of 2 weeks. I remember a month ago, it feels like a month ago now, is probably a little bit less than that. Maybe 3 weeks ago, kind of, I think I tweeted out something like, the Nasdaq's quietly, maybe not so quietly, 1,000 points off its all-time highs. Well, we're now 2,000 points off the lows in the Nasdaq futures, while still over 1,000 points off those highs. Just to put in perspective, that volatility spike, maybe the 65 number is a little bit higher than reality, but we had some big time moves. And I always talk about, and I love the analogy of the pendulum swinging. It gets too far in one direction, and then it can get too far in the other direction. I don't need to talk about that analogy anymore. I can just point to that volatility move and say, look, we got a little bit excited on the upside, and perhaps now we're getting, maybe we've normalized too quickly also when it comes to this market. But to your point, it's exhausting when you look at how vicious these moves have been, ultimately to kind of go nowhere over the last 3 weeks.
Yeah, the narrative about the soft landing, the rhetoric is really starting to pick up in the markets due to some of the data that we've had. Solid retail sales data that was above expectations, jobless claims numbers coming.
We're at a resistance on
Meta.
Meta.
We're not seeing any cracks there. Does this fit that theme that, hey, we are going to be able...
We're at a resistance on Meta. We're at the 200 SMA on the 1 minute. So it's got, if it breaks it, we'll shoot on up higher to the next resistance past 530. There, you get out now. SPY. We got two of them, yeah. Reverse head and shoulders right there. It's a double top. SPY's a double top. $4.10, that's a 10.4. One, two, three, triple top. What do we do at a triple top, children? Moolah. Moolah. $4.25. Spy's an exit idea. No, you hear me chewing them nuts?
Still watching some of that, like we don't know what these aftershocks are going to look like. So I think that the Fed is very, very conscious of, hey, we don't want to be, mistaken like our predecessors were way too long. But some of this data doesn't have comparison, so it's really, really difficult. I do not envy their job at all.
Yeah, you got the retail sales data, jobless claims on a weekly basis; those are still low. And GDP was above expectations on that first read of Q2. So there is a lot of positives out there. How does the Fed combat that? Do they start to cut? CME Fed Watch tool now pricing at about 76% chance, only a quarter basis point cut. And as you mentioned, remember just a few weeks ago, they were pounding the table for an emergency cut, 50 basis points in September. So that's kind of flipped. But let's kind of move on to expectations.
Real fast on the Fed Watch tool. The closer we get to that meeting, as those odds solidify, once you're within a certain time frame, I think it's a couple weeks. If it's over 55,
Meta.
that's basically what you're going to get.
65%.
435 now.
Line in the sand, that Fed whisperer, Tim Rose from the Wall Street Journal. But next week, we got not a lot of data. Fed minutes on Wednesday, maybe a PMI composite data read on Thursday. So not a lot there.
You're too loud today, buddy.
More about earnings, a lot of retailers.
Yeah, no doubt. We don't get NVIDIA for the following week, so you have one more kind of potentially exhaling type week when it comes to some of those earnings names. But I think Walmart did a lot this week to quell those concerns. But at the same time, if Walmart's doing very well, it's also telling you that there's a demand at kind of a cheaper, more value-oriented place.
Oh, come on, guy.
Depot. So I think that's going to be critical. I do think every single week now, for the time being, initial jobless claims are going to be something you have to pay attention to. But don't get too caught up in the week-to-week numbers. Watch that trend. Is the trend continuing higher, or is it leveling off? That's more indicative, so that 4-week trend on that. And then, yeah, I think the Fed minutes are going to be important because we're going to get an idea how serious were the conversations around July. Yeah, we're looking back. It doesn't matter. Nothing's going to change from now. Right. But we'll get a little bit more of an idea of, were they really about to do something or not? Jerome Powell made it kind of seem like they weren't that close, but we'll see.
Yep. And the earnings, we've got them listed there: Palo Alto, Lowe's, Toll Brothers, Macy's, Target, TJX on the retail side of it, Workday, Snowflake, Baidu also. So we've got a good mix next week, but maybe focused a little bit on that consumer. We'll continue to watch that jobs data also that you mentioned. All right, let's take a quick break. When we come back, we're going to take a look at Tesla. EV maker stock is up about 8% so far this week on the back of positive consumer data and potentially those falling rates. Fast Market's coming right back.
Oh, shit. Do 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 do. Break on down. We're going to the down. Come on down. We got another hour before the fat cats come back. They're not going to like it up at this high level. I'm going to have a one-on-one interview. Yeah. On the hour, we're at a resistance on the hour.
Technical insights on every changing trend in markets. Available anytime, anywhere on
553.88.
live on the Schwab Network. I'm Oliver Rennie.
Resistance channel, double top for market high.
Broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So, what are all those for?
Listen to me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know, Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Welcome back to the Fast Market here on the Schwab Network. We're talking Tesla. Made some inroads from some losses. Still negative on the year, but up 8% so far this week on that optimism that the consumer's still there. Interest rates a little bit lower. Let's bring in Diane King-Hall, Senior Markets Correspondent here. Diane, you know, when I see moves like this, I know a lot of it's probably due to the fact that, hey, we've got some pretty good data coming out from the consumer side. Interest rates have been pulling back. That helps auto sales. But then again, I don't know if any of the headwinds that Tesla's created for itself, competition, everything else, warrants maybe the optimism in the stock.
Oh, that's meta.
It's true. It's a tricky
That's
place
not more
to
so.
be when you kind of observe the different factors that affect Tesla, right? It's not a traditional car maker. It's an EV maker, and they would argue it's not even just an EV company, or Elon Musk would argue it's an AI company. But Tesla shares are gaining another percent.
August 19.
This after the stock started out under a little bit of pressure at the
The
session.
552 put.
Was under a little bit of pressure. Tesla was moving higher. It's gotten some tailwinds this week from some of the data that we've seen. You mentioned the retail sales data. We saw that a big part of that unexpected increase had to do with vehicle sales. Vehicle sales rose 3.6%. Investors looked at that as boding well for Tesla, especially when we think about the concerns we had about the consumer. You also have fresh consumer sentiment data out today that was better than expected. So it shows that maybe some of those concerns we had about the consumer may have been a little bit overblown. We're not going to say it's all overblown, because we know there are some consumer-facing companies that talked about some of the challenges they're facing. But again, when you think about the vehicle space, that was a big part of that contribution to the increase that we saw in retail sales for the month of July. Now, some of that also had to do with that vehicle sales recovering from the decline that we saw the prior month in June. And you may remember that dealerships had been hit by the cyber attack, so that impacted the ability to move vehicles. So July may have been some recovery. So we'll see what August brings in terms of if that pattern continues in terms of vehicle sales, guys.
Yeah, Diane, when I look at this this company, it seems like Toyota and some of the other automakers have pivoted away from EVs. They're going hybrid. And then the competitive side of this, whether it's the Chinese automakers or overseas automakers, that they need another cycle where people start to pick back up that EV. Maybe it's going to be credits from a new administration or something like that. Is that the key? Because it seems like, that whole green wave of going EV has pulled back, and that's going to take a while to kind of cycle through.
Yeah.
It's more than we expected this year, right? So there is some hope, and it depends on, kind of the direction that, both there's some of the which administration
takes charge on the road ahead, right?
Tight stop just in case it breaks.
Within the EV space, what administration is supportive of more investment in this space. But look, in terms of what the demand picture looks like, we're getting a little bit more clarity on it. There was more demand than expected for the Cybertruck. Kelley Blue Book put out some recent data showing that the Cybertruck was the best-selling vehicle, priced above $100,000 in July. So that was surprising, considering how there was some blowback about the Cybertruck, and some people, you either love it or you hate it. And then Tesla's average selling price increase of chunk of that was due to the sales of the Cybertruck that rose 11% year over year. So that's the highest level since February of 2023 for Tesla. Kelley Blue Book says,
I mean, I was real close to my target.
Model Y's average selling price actually increased from earlier this year.
So,
Model
we got a hangman.
also rose, and those Model 3 prices rose by double digits. Now we know there was also some discounting earlier this year.
Let's get that red candle going and jump to the next one.
Yeah, and then we've got the Robotaxi event on October 10th. That's going to be maybe a catalyst, the Optimus humanoid robot, so pivoting away from EVs. All right, great stuff. Thanks to Diane King Hall, senior markets correspondent here, breaking down Tesla. Alex, let's bring you into this conversation because, the
Need hangman.
is going to be a big one for this company. FSD, the ability to license that to other auto manufacturers might be, the next wave for them. But when I look at moves like this after the disappointing results and the slowing growth for this company, it's a concern.
I think it can be, but again, I don't know that you could ever rationalize long-term investment in this stock just simply because they sell vehicles. It's more about the technology and innovation the company has and belief in Elon as sort of a forward thinker. I think for those who are kind of rabid Tesla, fans and investors, you guys talked about generally the optimism around electric vehicles being overzealous. I don't know that negatively impacts Tesla because Tesla's the market leader in this space. I could make the argument that a much greater impact is going to be on the Fords and the GMs because those are like your cheaper alternatives, the ones that you're not necessarily buying that car because it's cool, more because maybe you thought you had to or you were trying to save money in some way if you thought you could through charging the vehicle as opposed to traditional gas in the vehicle. Tesla has a mystique to it. You're buying the Tesla because you like Tesla or you like the luxury nature of the vehicle.
Well, I heard they look like trash.
Unique looking, I think, is maybe an understatement, but
We know better than that.
everybody to buy those. It's a 100,000 plus vehicle. Not everybody
Damn it.
drives a 100,000 plus price tag. You can see it in the way that this stock trades. It seems there's negative story after negative story after negative story. Clearly, there are people who are writing these stories who have negative feelings about Tesla, perhaps Elon
Musk, yes.
But the market doesn't really take them that serious. Like, the market doesn't care that a writer thinks the Cybertruck looks bad. Because if people are buying the Cybertruck, that's all that really matters.
Right.
So these are the longer term conversations. If you're talking about near term, this is a high beta stock that has a ton of volume in the options and in the shares. If you feel strongly about the market, it's probably, it's not perfectly correlated to the market, obviously, but it does carry a 0.9 correlation, which is pretty strong to the ES over the last 30 trading days. This can be a high beta way to get market exposure. And I think that's honestly why it gets so much trading action, is it has a 0.9 correlation to the ES, which is the S&P 500, but it trades with volatility of 50%. And actually realized volatility 72%. So way more movement, but similar movement to the market, just greater magnitude.
Yeah, 1.5 beta on that, with the S&P 500 being a 1 beta. So it's got that high ability to move. You got an example trade for us, Alex? Walk us through it.
Yeah, I looked at a strategy that would kind of play into if you think Tesla may go higher, maybe because the market might go higher, and perhaps
Take 10 cent profit.
Recent levels that it had fallen from
Winning.
up near 235. So what I went out to in this particular strategy was buying the September 20th 225 call and then selling the August 30th 235 call. Now this is a pretty hefty debit, and you can see it's about $700 in debit for the $7 debit. That would be the max loss. I think it says 600 there, but it would be 700. It corresponds one for one with that that debit spent. This is a strategy though as structured because you're buying an out of the money call that's longer dated, selling that further out of the money call that's shorter dated. If you don't get the movement, time is going to work against you. Now, the 235 call, because it's shorter dated and further out of the money, will decay faster, in theory, than that 225 call. But when you're looking at it, what you really will want to happen...
there we go. We got 1, 2, 3. We need it to pull back here.
And what you'll also want to see, too, Tom, is this to happen relatively quickly. So I would say this is one that, while the theoretical max loss is...
Oh, man, come on.
If you don't get that movement, I'm not going to tell someone how to manage their trade. This is going to be up to them to decide if you look at something like this, be it an XYZ or a Tesla. But this is
It's got to drop below that blue line.
So if it doesn't happen relatively quickly, perhaps you would look to
We're squeezing
prior to the expiration, and you could kind of
you got to watch that tape.
Have a mental stop loss almost set up with this, where you don't have that full max loss potential. You contain that to some. So some that might be, hey, I'll risk $1 in this, $2, $3, whatever that might be. But if it doesn't start working relatively quickly, perhaps you contain that loss by taking it off.
Yeah, let's break this one down because I think we had the wrong risk profile up there on the strikes and the price. So let's break this down. September 20th monthly cycle, so 35 days expiration. By the 225 strike call, that's about 9.
Yeah, they're moving around quite a bit.
And then in the August 30th weekly options that expire in a couple days, in a couple weeks, excuse me. So the 235.
Fuck.
It's a $10.
We want to take it to 550, 555.
This is wrong on the screen there, so we're not going to use that one. We got a $10 wide call diagonal that we're actually looking at. So we're going to take that down. If you pay a $7 debit,
They want 555.
235 call diagonal. That's going to be your $700 per spread, as Alex mentioned, because it's a $10 wide call diagonal, and the price paid is less than the width of it. You've only got one break even. That's going to be probably around $230 on this one because you have that ability to roll that short option a couple times into expiration.
The shape of the risk profile that was on the screen is right. It's going to look like a counter.
Man, not really.
Describe sort of a mountain-like peak.
They don't want it.
Because of how it's structured, debit spent less than the width of the structure.
Yeah, they do. Kind of. Well, no, they don't.
It's tilted on its
Yeah, they
axis,
do.
so it moves that up.
554.20.
Yep, and you've got some assignment risk over the next 14 days into August 30th expiration on the short 235 call on that one. But this is a medium dated. You're buying something in September, 225 call, 35 days to expiration.
Yes, they do.
30th weekly,
I think they do.
call. That's got about 14 days till expiration. So good look. If you think this thing's going to start to grind higher towards the apex of that profitability around that 235 level that Alex talked about, this works out in that regard. All right.
We want the
Let's take a
50.
quick break here. Then when we come back, Mike Folio is going to join us. I have sentiment data.
We want to catch it off this 1, 2, 3.
Maker stock is up about 4% this week, and
Oh,
all
that's
eyes
a-
are going to turn to its upcoming iPhone 16.
Where the
release
fuck
this
did I
fall.
see that?
Stick around. Coming right back.
Where's my blue line? Oh, there it is. Do, do, do.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
my favorite client.
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right?
Yeah.
Tell me you know this.
You gotta run, Carl.
Schwab. Have a choice in how you invest with Schwab.
Damn, that woman's hot. That's a real woman right there. That thing.
Welcome back to Fast Market here on the Schwab Network. It's time for Cash Tags. For that, let's bring in Megan Brantley, VP of Research at Likefolio. Welcome back to the show, Megan.
Thanks for having me, guys. Happy Friday.
Happy Friday to you. So we're talking Apple. You know, the supposed super cycle is supposed to start coming with the advent of all their AI integrated into all their products. But what kind of data are you guys seeing on this one? Because it seems like, declining sales for, six out of the last, or 5 out of the last 6.
Okay, this is it. Do or die.
The stock, but now it seems like, hey, everybody's got to upgrade their phone because they want AI.
1, 2, 3.
Yeah, so whenever we look at this, we can break this down by the different products, especially because consumers love to
Could have got 110, but I held it.
products that they are considering upgrading. And then we can also look at services. And we know last quarter, Apple actually beat expectations driven by strength in
So we got a squeeze.
division, and we see continued strength. We looked just over the last 2 weeks, and you can see on this chart here, services continues to lead the way. We actually see some improvement here. These are searches for things like, people who are looking to upgrade their iCloud storage, for example, or other subscriptions that Apple may provide. And you can see strength in iPad, we see strength in MacBook, and we actually see building strength in iPhone mentions. And a lot of that is due to the hype that you mentioned. Apple unveiled its Apple Intelligence, I think in its developer conference earlier this summer. This will hit devices expected in October. And obviously we have a keynote event in between now and then, which is one of our favorite times of the year that we'll be listening really closely, because this is when consumers actually tilt their hand to say, okay, I'm considering upgrading, I'm considering getting a new iPhone. We're already seeing hype up into this event a little bit higher than normal. So I think that there is something palpable that consumers are just really hoping for something new and fresh and exciting that provides value from Apple. Now that remains to be seen, how Apple executes and what that demand actually looks like once they preview these new iPhone products. But I think looking ahead, at least for us, iPhone really is the main thing to watch here. iPhone still accounts for, I think, 46% of Apple's sales. And so it's going to be really important that the consumer feels like they can continue, to turn to Apple, that they're still sticking with Apple. So far, we don't see any signs that consumers, at least our U.S. consumers, are turning away from Apple. But I think that Apple definitely has a lot of eyes on it and high expectations for improvement with its new Apple Intelligence.
Yeah, this is a fascinating conversation. We're certainly very early stages, I think, in this conversation. But the bar's been set so high. There is so much hype around this from people who are basically making a call on the broader consumer, saying they've been waiting because they're waiting for this, not maybe because their phone works for a little bit longer.
Well, I got my 22.
Is limited. I have a theory that much like that VR headset, the Apple Vision, this could be a flop relative to expectations, just because I don't know that this is going to move the consumer needle the same way the hype and expectations are. Now, it sounds like there might be a relatively high
554, you dick.
off there is some excitement around the iPhone, but is 4%, I think that was the number, is that going to be enough to meet these expectations?
That's a really good question. I love your comment about the high floor. I think that exists, but I think that, that the ceiling is even higher now too, because people are looking at all of the things that companies have been able to accomplish with AI, and they're looking for Apple to set
Damn
the
it.
bar. You know, whenever a couple of years ago we used to talk about Apple as this groundbreaker, and just over the last few years, whenever we talk about these keynote events, we're like, okay, you know, battery life has improved a little bit. Maybe the cameras improved a little bit, but nothing groundbreaking. And so I think consumers are really waiting and latching on for something groundbreaking. I think that there is a coiled spring, though, if Apple can step up to meet these expectations. I think there are estimates that 1 in 5 Apple users or iPhone users haven't upgraded their iPhone in the last 4 or more years. And so that's a huge leap in terms of technology, especially if Apple comes out with something that's really impressive, or even moderately impressive. And I think that that's something that maybe Apple can latch onto. So this will be really interesting. It all comes down to whether or not consumers are impressed with what Apple has to offer. But the hype is building. We have consumers who are searching for upgrading my new iPhone, who are talking about, you know, wanting the new iPhone. So this is almost, you know, this is Apple's ball to drop.
You know, Warren Buffett just sold about half of his stake in this company, maybe based on the valuations, because they're still elevated compared to historicals with that built in about the super cycle. But Megan, when you look at this, you know, services is growing, that's higher margin business. With the stock at these levels and the rebound that we've seen over the last couple of weeks, are you guys still positive if, say, if they were going to have earnings in the next week or two?
Yeah, so we are positive. We think that Apple has a lot of tailwinds at its back. And I think another thing that Apple is really good at that we haven't hit on yet is FOMO. You know, Apple kind of mastered the
Okay, we need to definitely, this is number 4.
Its new generation of phones.
And we definitely need to come back. I hit my target.
Intelligence. And so that,
I hit my target of 55422. Now, I also was getting the idea that we could hit 555 if we break this with a body candle above it. For right now, we want to try to get under that 9. We want a body kind of like what we see here. You gotta watch that tape. I mean, it's my resistance level. If it breaks it, I'm going to get out. Everybody's excited about Apple, this new Apple. I'm not sold on it. They're questioning Buffett's idea of getting out of the trade. They used to not question him. I always questioned him, because I thought he was kind of stupid. He's not a tech guy. Now, the other people working for him, I mean, the guy can't even use a computer. The old man doesn't even use a computer. He probably does now, but emails, but I don't know. Buffett. Tempted to get a put on SPX too. I'm still in this sucker. We're going to see here. We're going to know something here real soon. We just got to keep remembering this is a very, very bullish market because they think we're going to get an interest rate cut into an election, which we probably could because they put it off so much this year. We can get that. We can get that one. Powell look back and see the reaction of the market. It'll probably piss him off because his idea ain't working and the 1% are getting rich. He's way behind the curve. And I agree with that. Should have cut him a long time ago. At least did one. And that would have really curbed inflation. The more people have to pay for goods off the high interest rates, the more it's going to cost you. %, 8%. We want the 200 SMA. If it breaks down below now, I should have grabbed some at 90, but I didn't. God, look at that put. This can come back down to the 63. We're under my trend line now. Nailed that to the T. Look at that body on that candle. 554.22. It hit 20. It hit, what is it? 25. So I was 3 cents off. It's been 8 minutes. You got to see some weakness in this tape. Camptown races 5 miles long, doo-dee, doo-dah. Gonna run all night. Gonna run all day. Let's just drop this mother. Somebody bet on the bay. Okay, I want to get lucky. I want to get lucky. Somewhere over the rainbow, way up high, and a dream that you dreamed of once in a lullaby. Somewhere over the rainbow, bluebirds fly. And the dream that you dream of, very true, come true.
Someday wish upon a star, wake up where the clouds are far behind. Be where trouble melts like lemon drops, high above the chimney top. That's where you find me. Oh, somewhere over the rainbow, bluebirds fly, and the dream that you did to, oh why can't I? Oh, someday wish upon a star, wake up where the clouds are far behind.
I don't know if it's gonna work or not. Been too long. Chimney tops sky, you'll find me.
Dream that you did too. Why, oh why
Can I? Retesting. Come on, you son of a, don't break it. If we break this, I'll just get out of it. I mean, we've been here what now? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 minutes. Pushing it, man.
And now On Holdings in their running shoes, they're taking market share, and they're actually become a viable competitor at this point, right?
Yeah, definitely. And once again, those are kind of growth names, so they have they're starting at a very low bar, and it does appear that they are taking some market share. Also note too, both of those companies, their direct-to-consumer strategy has been paramount for them to be able to grow, and rightfully so. I think when it comes to Nike, the reason why they have maybe pulled back a little bit from direct-to-consumer is because of the third-party sellers or those wholesalers that are a little bit upset about the relationship that they've had, and so I think they want to be able to make their sellers happy, but also trying to go the cheapest route in order to sell products, which is direct to consumer. They also have some issues when it comes to branding in the online space as well. I mean, they've had a couple of initiatives that did not grow as well as they had planned about a year ago or 2 years ago. So once again, I think this is just more optimism about the outlook moving forward and potentially leadership changes, and then also a lot of these value names that have just not really been catching a bid have been the ones catching a bid this week. And let's see if we're going to have some follow through. From a technical standpoint, it is trying to fill the gap. I mean, there's a very big void here. Yeah. And so when you're looking at around $90, $95, that could be your area of resistance if the technical landscape really does hold up.
Yeah, after that last earnings report, the gap down was massive, to say the least. All right, Kev, great stuff. As always, that's Kevin Green, Senior Markets Correspondent, breaking it down for us. We have to add in that Williams Trading double upgraded the stock to 93 from 67 previously. They said the rehire in the wholesale side of their business from Tom Petty is supposed to be accretive, and it's going to move quickly. But I got a couple different trading strategies I want to look at today. Directionally, both the same, but it's based on what probabilities versus maybe a little bit more directional. So the first trade that we're going to look at here is a bullish call vertical here, but giving myself duration. So if you think this thing is going to continue to rally, fill that gap, and continue to move higher, this is a strategy that may take advantage of it. Went out to the
They're pumping Nike.
cycle, so giving myself a couple months until expiration on this one.
I have it for December.
Strike call in the money by about $1, and then sell the 92.5 strike call. So it's a $10 wide bullish call vertical, paying roughly a $370 debit for it. That's going to be your risk. The debit you pay on this spread, $370 per spread on this one. Break even, $86.20 to the upside. That's going to be less than $3 above the current share price in that one. And when you're looking at October options, you've got 63 days to expiration on this one. So bullish directional call vertical where, hey, I can do some adjustments on this even before it expires because you're buying the vertical. Now, time decay works against you in this one. It's a long Vega trade too, so volatility continues.
Okay.
But the idea is, hey, can I
84 cents. I got to do something.
Pop here, get above that break even. 370 in risk with a potential reward of 630 on that one. So good risk reward setup, but you definitely need to move higher, continue to fill that gap from pre-earnings. Now, let's look at it the other way. Maybe you want to be a little bit more passive, but you still want that bullish direction. So I looked at another strategy here, and this one's a little more short term. So going out to the September monthly options, so 35 days to expiration. And I looked at just selling an out of the money, slightly out of the money put vertical to take a neutral to bullish stance.
Shit.
Hey, even if it consolidates here, I can still potentially profit on it. Selling the 82.5 strike put and buying the 77.5 strike put. So a short, neutral to bullish, $5 wide short put vertical, collecting roughly $1.40 credit. That's what you can make it on it, $140 per spread. Now, what does that leave you with? About $360 in risk. So you can see how
I didn't want to see that.
Vertical versus a short put vertical, it kind of flip flops on the risk reward. But what you're
So I'm gonna. I don't know what if I'm gonna cost average down yet. I don't think so.
Is better probabilities of success. That short
We got 20. We got 30 minutes for the fat cats to get back.
Strategy.
So I'm staying this for now.
Probability that'll be out of the money at expiration, which is what
I'm thinking about adding on, but I don't know if I'd do that. They definitely want to take it up to 555. $5,548. They just sold some. Oh shit. 5,520. 5,535. 5,570. 555. 556. $555. Well, it's not working. The market makers are pushing it up. They want that 555. Oh shit. God darn. Israel hopes pressure from mediators and USA will lead Hamas to accept ceasefire deal. Now they'll take this as good news and then they'll run the market up. And I don't want to have a ceasefire before Biden gets elected. All the Hamas people will be very happy. There's your 555. $555. So here, I'm going to make a business decision. They want more out of it. There it went. Went bye-bye. Proposed on May 27th. To accept ceasefire deal proposed on May 27th. Hamas senior official says U.S. administration is creating a false atmosphere. It has no intention of stopping the war. No, Biden says closer to the Gaza ceasefire deal in 3 days, but we're not there yet. Hamas, it's all about Hamas right now. 7-day humanitarian pause to vaccinate Gaza children from polio. Oh, God. Well, they threw that. That's a smart move. Let's give them all polio shots. It's for the kids. Still ain't heard him apologize for the genocide. Drop, you beast. Now we're retesting support again. Meta. Stone Spy. Meta's at 385. $0.80. I was real tempted by another 100 there. I mean, another 10. 70. Well, Jimmy said we could hit 555, and we hit 555.
Theme for good reason. These stocks, which is the one that we begin with, has not really been a leader as of late. It's had a lot of negative spotlight on it, and that is Alphabet, parent company, of course, of Google, YouTube, Waymo, and of course other names.
Okay, so recently Oliver Rennick has put me on to the fact that their search is very manipulated. Like it's gotten a lot of scrutiny for that fact recently. And so I've been using Bing to see like how it compares, and you do get, it's wild how differently it results. I'm such a
I'm surprised how much AMC has held up.
my horizons, and now I kind of understand maybe some of the flack that they've caught as of late with just very specific queries. It feels like regarding what you search, and it
Now
doesn't
what's
sound
going
like
on here?
You're basically
We have a
searching
split?
manipulated, but I guess that's
Yeah, they're telling you what the story is oftentimes and letting you find it. But that's one thing. I think the real key piece here that I think is really the crux of the antitrust stuff,
Medicare's
Jenny, is more that
negotiated drug price will save taxpayers $6 billion now.
to that position. And I think you can make
Biden said $1.5 billion. They got a headline in here saying $6 billion now. That's really going to be a big catalyst for them, they think. I probably won't even be affected by it. I ain't affected by anything they do. Nothing. I'm a single white male with no kids. The only thing I got affected with is all that printing and trading stocks, but besides that. I got affected by a 21% increase in my cost of living. %21.1%. I don't know when I want to add on. Not sure. I hit my target, 555, so I should have probably jumped in there at 70 cents. That's the 63. No, that's, what is that, VWAP? Huh. No, that's the VWAP there. Oh, I don't have a 63 on here. We're at 85 now. We want to keep dropping, but stair-stepping down with 3 crows. And we've got 16 minutes. Let's see how fast it takes for me to get pissed off at CNBC.
Diana Olick for more, and it's also a big day in the real estate industry for other reasons, Diana.
Yeah, we'll get to that, but first, on housing starts, it was a big miss for both starts and building permits in July. Single-family starts down 14% month-to-month and nearly 15% lower than July of last year. Multifamily, which is much more volatile month-to-month, it was actually up 12% from June, but down 22% from a year ago. That's because we're just seeing a record new apartment supply coming on the market this year. Single-family permits, which are an indicator of future construction,
That's not the reason, honey.
month-to-month really at all, and we're just 2% lower from July.
Reason is because we got high interest rates. Don't you just say it?
In August, so we haven't seen the effects of that yet. But rates, of course, affect builders' borrowing
Finally.
costs, and that's hitting them hard. So maybe some relief in the fall, Kelly.
Oh,
Maybe
God,
it's pursuant to
maybe.
the discussion we were just having, maybe not, but probably. Some new rules are set to take effect.
Thank you,
this
Kelly,
week.
for setting her
The ones
straight.
that will maybe change real estate as we know it. What can you tell us?
Well, they will change real estate. Look, this is a landmark antitrust settlement that will fundamentally change the way real estate agents are compensated when you buy or sell your home. Now, the National Association of Realtors agreed to take offers of brokers' compensation off the MLS. That's their listing database they use. In addition, buyers will have to sign agreements of compensation with their agents. So in the past, both buyer and seller agent commissions...
It's not as bad as it was yesterday, that's for sure.
Now, some have claimed this could actually lower home prices because sellers had baked that buyer agent commission into their price.
3,000
I spoke with the CEO of one of the nation's largest brokerages, EXP, about that this morning.
I think that's categorically false. I think the value of a home is dictated by the supply of properties, the demand from buyers, and the affordability index. As we saw interest rates retreat by about 1%, that'll bring some reprieve to buyers on the sidelines. But really, we have a fundamental lack of inventory in this country that comes from the financial crisis where we didn't build enough homes for the household formation we've experienced.
But there is widespread concern for first-time buyers who might not be able to afford the commission, so they might choose not to use an agent, and that could hurt them if they don't understand things like down payment assistance, contingencies, inspections, appraisals, closing costs, all the things that an agent is there to explain.
I just find it's a hassle. You know, the nice thing about an agent is you can kind of say, this is what I'm looking for, and then they go set everything up, or they might look around for you. So how would that work if you tried to do it on your own? Is it changing the way that people might, you know, schedule a showing or access a home or something like that?
Well, so much of that is in technology now, right? You go on the website of whatever area you're looking for, whatever company, or just the general Zillow or Realtor.com or whatever, and you look for homes, and then you decide, well, I want to go visit one. What this is really talking about is when you decide to make an offer on that home. You can go visit as many homes as you want and do that yourself and figure it out. Would it be easier to have an agent help you streamline that so you don't have to go see 30 or 40 homes? Yes, that would be helpful.
555, Mannequin. You nailed it.
To make an offer on a home, before you do that, you must sign on with a buyer agent to make that offer. And if you don't want to use the agent, so you would have to pay that buyer agent, not the seller. In the past, you could show up and there might be an agent there and you could just use that agent as your buyer agent. Now you have to sign an agreement first. And it has to be decided if you're going to pay that agent or if it's going to be somehow paid in the way the seller is using perhaps some offsets to it.
It sounds complicated. For something that is simplifying, maybe it sounds complicated. Nevertheless, it will be interesting to see how it shakes out with everything else about housing up in the air right now. Diana, thanks very much. We appreciate it. Diana Oleg. Still to come, Vice President Harris is set to speak next hour, unveiling her plan to lower costs for the middle class. Our guest says the campaign clearly believes inflation is her biggest vulnerability. We'll look at what to expect from her on the economic policy front. But first, you've heard of AI chatbots, you know, like ChatGPT. But what about a bot you can actually haggle with while you're shopping online? Well, we decided to put my negotiating skills to the test. They're not great, but I did okay. We'll speak with the CEO behind this technology next and how it could reshape retail. The Exchange is back after this.
This is The Exchange on CNBC.
YouTubers, the shirt that I'm wearing, it's made out of bamboo. I love the feel of this shirt. It kind of feels like satin, but it's not. Soft. It's breathable.
CNBC.com.
Welcome back. 2024 shaping up as the year of generative AI as large-scale business adoption ramps up. A recent McKinsey survey showed 65% of companies are using it on a regular basis. That's high. Seems high. That's nearly double the percentage from another survey just 10 months prior. The marketing and sales segment has seen the biggest usage increases, with Gen AI enabling things like content
Is Elizabeth there?
personalized marketing. And as I recently found out, customers
Elizabeth.
discounts on some products.
Come to me.
I haggled with a chatbot.
I need some smooch.
Kind of want a California King. I'll settle for this Nectar memory foam mattress. In stock, but quite pricey. $650. Ooh, make us an offer. Let's see.
I'll make you an offer.
Hi, I'm Nibble. I'm here to help you negotiate a better deal. Since you're here chatting with me, I could lower the price to $625. What do you say?
Oh my
I say that's
God.
not low enough. I say, how about 200? I mean, 200 would be pretty nice. They gave me a laughing, crying emoji and said that technique isn't working. $598.50? No. How about $150? Getting sassy. That strategy you're trying really isn't going to work. I need an offer I can seriously consider, so make your next offer count. How about $399?
$375.
Got a little thinking of. Keep in mind, it comes with a 365-night trial. Wrap up this deal at $560. No. How about $499? We're getting there slowly, but that's not quite enough. Oh, could I accept $535.99? I mean, it's better than. Okay, one more time. How about $515? That's it. It's sold at a 21% discount. Does that mean I got $515? Add to cart, baby. Joining me now is Rosie Bailey, the co-founder and CEO of that haggling chatbot.
You're funny, Kelly.
Alongside our very own Deirdre Boso. Welcome to you both. Deirdre, I know you can explain how this is very quickly becoming commonplace. But Rosie, welcome. And first, to explain how this works. Does it know anything about me? Does it already know how low the price can? Like, what are the parameters around this experience?
Fair enough. By the way, we started this business in lockdown. I've watched a lot of people using my chatbot on Zoom, but that was the best. So thank you very much. So the retailer sets some parameters, yes, and they give the chatbots some guide rails. You know, we want you to not discount too much. We want you to maximize conversion. We want to maximize margin, and then after that, Nibble does its best. And the way it works that out is we work with a professor of negotiation. So there's some behavioral science in there. There's some natural language AI, and there's an algorithm.
So, okay, so, and by the way, Rosie, can you tell us what are the results for companies so far using this technology in terms of, because it did offer me a few times like a decent deal. So I know maybe they're selling, at some lower prices, but maybe it's increasing sales. What have you found?
So a lot of our clients, not all of them, but a lot of them have seen more than 20% uplift in sales and conversion. Some of them have seen 145% uplift in conversion. And most of them see a margin benefit at the same time because they're much more targeted about their discounts. So when I say a margin benefit, obviously this chatbot is offering a discount, but the margin benefit is relative to their.
Man, they're tight. They're tight with this thing. For 2 days in a row, they've done this shit to me.
Because I couldn't figure out exactly how it worked, it made me want to use it a little bit more. Sometimes it would stop a few bucks short. Sometimes it would give me a bigger deal. And I could see me or my husband or people who like to go in and try to break LLMs. I could see that person sitting there, trying to find the best deal and maybe therefore ending up further down the experience than they would have just simply browsing the website.
Yeah, everything is gamified these days. I think that's what you're pointing to, Kelly. I have to say, that was so charming. I love the laughing emoji when you lowballed the chatbot, and that is really in line with what we're seeing from the big AI companies. Google with its latest chatbot, OpenAI with its advanced chatbot. The idea that they're more human-like, that you can converse with them, you can interrupt them. I was trying to get through a traditional chatbot yesterday on hold. It was so frustrating. The few seconds delay after every answer, not seeming to get it. This chatbot certainly is in line with some of the most advanced ones that we see from the big players. I guess, Rosie, a question I would have to you, though, is really on the business model as well. This feels almost like an AI-powered Groupon. Really good at drawing in bargain hunters, but one of the problems that Groupon had was that it was able to pull in one-time buyers, but it wasn't very good at making sure people had that brand loyalty, which eventually led to merchant fatigue.
It's a good question, and we're a young company, so there's a little bit of we'll find out. But one of our clients has been using us as a permanent feature on their website for nearly 2 years now. And they use us that they say, as long as you spend more than a minimum value, you can negotiate a discount on the basket. And we've analysed their users of Nibble, and their repurchase rate is 10% higher than the people who don't use Nibble. So the advantage here is you've got deep brand engagement. I think you noticed the chatbot talking about the brand values, and perhaps that makes a difference. Certainly the numbers seem to show that, but obviously we've got to keep working on that to make sure it stays engaging.
Yeah, and Rosie, maybe cover your ears for a second. I tell Deirdre, it wasn't the smoothest experience always. Look, it's new technology, and maybe that's part of the charm almost in it is kind of figuring out how it's going to work and what it might remember and what it might not. I would be curious whether, Deirdre, this actually is a implemented technology that retailers use, or if it becomes itself a new way of shopping through, look at the rise of Temu Shein. Like, could there be an app that kind of just takes this, has the best cutting edge technology and takes this all the way to the top?
Right, that's a really interesting question, because what you see with Temu and Shein, why they've been so successful with the American consumer is, again, that gamification point. When you log on to Temu or you open up your app, there's a wheel that you spin for different discounts. So in that sense, you're spinning a wheel for a bargain, and this isn't particularly new. I don't know how many people are willing to spin a wheel, do something very quickly, versus going back and forth with a chatbot. I mean, Kelly, I lived in Asia for many years, and haggling was part of the fun of it, so maybe that brings it back in. I wonder too, Rosie, if you can actually outsmart the system, this is where my mind goes, by asking ChatGPT to bargain with your chatbot.
We've had everything. In fact, we had a little bit of a very nice Google analyst, technician, like a developer at Google, bought a mattress last month. Nothing to do with us, but he put this on Twitter, and his group of friends were prompt hackers. And we've never seen...
Honey, I don't know who you work for.
Demo, but it didn't break, and it didn't give anyone the lowest price.
Well, then I know I can't crack. If the Google technicians can't crack.
Fingers crossed, because I'm wondering if it's happening now. Do you know what I mean?
Yes, absolutely. Rosie, thanks so much for bringing this story to us and creating kind of a fun and new retail experience I think is absolutely going to go mainstream. We really appreciate your time. And Deirdre, thanks for joining us as well. Our Deirdre Bosa and Rosie Bailey from Nibble. Coming up, the $30 billion classic car market is stalled. Those beautiful 7-figure hot rods just aren't flying off the lot like they used to. What'll it take to turn things around? We sent our intrepid Robert Frank to Monterey Car Week in California to find out. Robert?
We're at 86, 87 now. I have a support of 553.94 on the bottom of this channel, but we could stop right here. We got a 1, 2, 3. I added on a little bit here, so we're going to see. That takes you right to the 63. And we hit the 63. I'm gonna nuke my coffee and I'll be right back. Fat cats are back. U.S. Baker's used oil rig count 483 versus 485. Baker's used gas rig count up 1 to 98. Winter's coming up. How to time Social Security if your spouse earns more than you do.
Welcome back to the Exchange. I'm Tyler Matheson with your news update at this hour. 2 White House staffers are expected to leave the Biden White House soon to join Vice President Kamala Harris's campaign.
Oh, God.
Sources tell NBC News the Harris campaign is expanding in the final 80 days until Election Day, and that the campaign plans to announce more new roles as early as today. Ford will recall 85,000 SUVs over engine fire risks, according to the National Highway Traffic Safety Administration.
She's definitely I know girls like that. I know girls exactly like her. My sister's kind of like that. I couldn't stand being around her, I would think. I'd look at her when she got into one of them belly roll laughs, and I'd go, what the fuck? This chick's a nut. She laughs about anything. I'd have to have a woman that had a sense of humor, that wouldn't laugh at everything. But she... Look at that inchworm crawling on the ground.
They've started to auction off, and they're hoping for $460 million in sales this year. That would be an all-time record, and it would mark a big turnaround for a market that, as you say, has struggled recently, and that was because of high interest rates last year, as well as a big divide between what sellers were expecting in terms of price and what buyers were wanting. Now I'm told the sellers have capitulated in the classic car market, so you've seen prices come down, especially on the older 1950s and 60s cars, and you are now starting to see deals.
The mood is good. There's a buzz. Don't ask me to quantify it, but you can feel it. People are here to do stuff, whether it's to buy, whether it's to sell.
This has also become the world's biggest stage for supercar reveals and unveilings. Lamborghini just announcing moments ago the launch of its Temerario. That's easy for you to say. This is a V8 hybrid car, estimated starting price $350,000. And Rimac, that's the electric car maker, announcing a new electric supercar with over 2,100 horsepower, 0 to 60 in under 2 seconds. And then we just had here at Mecum the unveiling of a car that's going to head to auction. It's a Porsche 1979 17K. This was the car that Steve McQueen drove in the movie Le Mans, the most famous racing movie of all time, the most famous racing car perhaps of all time in cinema. And I'm told, Mika won't tell us who is selling this car, but I am told Jerry Seinfeld was the owner of this car and is selling it. This could set an all-time record for a Porsche, and probably north of $16, $18 million. We don't have a number yet, Kelly, but this car is going to sell in January at Mecum Auction. So a lot of unveils in the past 10 minutes, both in new cars as well as auction cars.
But I thought it was so interesting what you said, Robert, how high interest rates have really been a factor here in what they're selling for.
Yeah, and the high interest rates were interesting to me for two reasons. At the bottom of the market, about half the cars, classic cars that sell, are financed. So that those high interest rates have, just like they affected mortgages, are affecting classic car sales. Now with the expectation that interest rates will decline this year, you're starting to get people borrowing again, coming back in the market. At the high end, the problem was investors would rather keep that money in 5% earning cash than buying a Ferrari like this one for $500,000. So it's both the top and the bottom that were affected by interest rates. And now what's helping this market this summer is the expectation of lower rates in the fourth quarter. We'll see whether that happens.
And I'm excited to see what the final tally is. Robert, thanks. It looks beautiful. They all are such just gorgeous works of machinery. I don't know how else to describe it. Thank you for bringing that to us. Our Robert Frank out in California. Coming up, healthcare, housing, taxes, and groceries. Those are expected to be the four main areas for Vice President Harris's speech on the economy next hour. We will look at the exact policies she could unveil. By the way, an all-new CNBC original podcast series is out now. The Crimes of Putin's Traitor.
Slow, choppy days.
Hosted by Eamon Jabbers, exploring the secret life of a young Russian oligarch who was part of this month's historic prisoner swap between the U.S. and Russia. Just scan that QR code on the screen to follow and listen to The Crimes of Putin's Traitor wherever you get your podcasts. And The Exchange will be right back.
I'll call Nancy and see what she's invested in. Yes, I will. She's actually in the kitchen in here. Hey, Nancy, grab me a Valium, a shot of vodka. Make sure you're wearing your bikini underwear. Yeah, surprise. Today respected yesterday's run. This is what? A red day today? No, probably green by now. Chew got a new high. Broke the double top.
Game plan.
back, Vice President Kamala Harris set to unveil her economic plan at a speech in Raleigh, North Carolina next hour. She's expected to announce policies that aim to lower the cost of groceries and prescription drugs, expand affordable housing, and cut taxes for the middle class. Joining me now for more is AEI economic policy analyst and CNBC contributor James Pethokoukis. It's great to have you here. We've gotten some broad brush outlines of what she might say. What jumps out to you the most?
Well, I think the way I look at this is not so much Harris laying out an agenda, but telling a story.
Exactly.
And when you look at the policies, the story that will end up being told through those policies is that inflation is not the fault of the Biden-Harris administration. It is the fault of these companies, corporate greed, and going forward, I have all kinds of ideas that will tackle inflation. I think that is primarily the story they will tell, because it's clear that that is perhaps the biggest weakness of this campaign, is their inflation record and the inflation record of the Biden-Harris administration.
What I find interesting as well is I think a lot of the critics who want to say, no, it's the Biden. A lot of the public doesn't want people to go back in time, and to some extent doesn't. I would say they obviously care how we got here, but what they really care about is what's it literally going to look like in 4 or 6 months' time for the cost of everyday life. What is the story that the Trump administration is going to tell about that?
Depression.
Again, we could debate these policies on their merits, but this is really about competing stories.
It is about a competing story. And I think you're right. That the Trump team is going to tell a story about.
You're going to have the same crew working in there that worked here in the last 4 years. You got the same crew in there that worked during the Obama years, and we ran the deficit from $9 trillion all the way to $20 trillion. $11 trillion, not counting unfunded liabilities. Trump came in, run it up 10 trillion. But we had COVID. We didn't have COVID during the Obama years, where they shut down the government, shut down businesses. Then Biden came in, printed 8 trillion, plus another 8 trillion, 6 trillion plus another 8 trillion, which is 14 trillion. Not counting unfunded liabilities. Harris is going to come in. She's going to do the same thing. It's the same plan that Obama had, share the wealth. Share the wealth. Share, and it never works. Never works. Share the wealth. Obama's the one behind the scenes doing all the decision making right now. He even said he would do that in an interview while he is president. Yeah, I wouldn't mind sitting back in the basement and doing all the work, and talking. It's a huge comparison to both administrations. We had the Arab Spring and we had the open borders. Arab Spring under Obama, open borders. 11, 12 million. I'm hearing 16 million. Of illegal criminals. Some of them are good people, but a majority of them, I do believe Trump. I mean, they're exiting the mental institutions and the prisons and say, hey, go fuck up America for a while. I'm still in this trade waiting. I think I'm going to get out even. But it's going to have the same clowns in there that were in there before, Susan Rice and all them other nuts. Foreign policy, same thing. Obama had a genocide in Syria. He threatened Russia. Russia came in and showed him who was boss. We didn't do nothing. We said don't cross the red lines, and they did, and we didn't do a thing. And children and women died in Syria, over 500,000 civilians. Then we had a genocide with Biden in Israel, and genocide in Ukraine, genocide in Russia, genocide in Hamas, and we're about to have another one. I don't know if Iran's got the guts to do this, but and then we've been threatened with nukes. Russia's, it was Bolden with Sleepy Joe. We didn't have none of that going on during the Trump years. I had a lot more money in my pocket, I know that, my business. Right now, it's costing me about $1,200, $1,000 more to run my business a month. So if we get Kamala, I'm just thinking, man, I got to get out. I can't do this no more. I'm not going to work my ass off and not get nothing out of it. We'll get another 20% increase in cost of goods. Foreign policy is just no good. We'll end up buying our way out of it probably. That's probably what they're doing now. The war machine's at work.
Kelly, because you did.
It's the same exact scenario. More drugs on the street. More fentanyl. We got fentanyl now. It was ice and some other stuff back then.
The bill's a little different because it doesn't have the SEC component. That would have required Stabenow to work with Sherrod Brown, and she was not apparently able to do so. Like we said, there's kind of a reason he's got that F rating. But so the Senate bill would only focus on the CFTC, but at the same point, that's the one that Schumer seems really interested in. Stabenow is, of course, the chair of the Agriculture Committee, so they can put it through like that. I think the big question is, would Republicans back that bill? They've backed previous versions, have been bipartisan, but several lawmakers who I talked to have said they still have some concerns about what that legislation looks like.
We've created higher highs now.
To see if they wind up taking this up in September when they're back for just a couple weeks, and then that's it before the election.
And a reminder of whichever candidate kind of becomes president, this is where the policy will really be played out, and it could be very different depending on what that final bill does look like. Emily, thanks for now. We appreciate it. Emily Wilkins. Coming up, shares of applied materials are lower today despite beating on the top and bottom lines. Fourth quarter guidance.
I listened to this black chick last night. She was in the Army, saved up her money, and then bought a food truck. And with the high interest rates, she's going to have to sell her food truck. And the guy that's going to buy her food truck is an illegal immigrant going to get the loan money for free to buy the food truck. $20,000. Check handed right to him. It'll go right to her. He won't have to pay it back. Not counting the $10,000-15,000 that they gave him a month to come up here in the free room and board. And that's just one of 16 million. She's just in tears. I've worked so hard, she says. She said, I've done all the right things. And so I can't operate this business with the inflation the way it is. And I predicted about everything that happened during the Biden years. I predicted it to come true. Even I said we might even get threatened with a nuke, and I was right. I hate to say it. But I did not predict open borders. That pulled me there. I didn't see that one coming. If he'd have said that on the campaign trail, woo! He wasn't on the campaign trail anyway. He slept in the basement. So we're back to 80. But these things cost average down. I'm trying to get out of this trade. I need 10 more cents. We did hit the 63 again, so that's support. Now, if we fail this, we got a good pullback coming. And it's now 10 to 2. We got 2 more hours left. Could be a little too early still, but if we breach below the 63, we're going to drop. I need 87. That's my target right there, but I'm going to raise it up to right. There's 86, 87, 91, 92. Who's in this trade with Bobo? 96, 97. Time. It's time. Time. Finally. Getting out. Now, how did that get on there? Oh, I replaced it. I'm out 95 cents. She was a veteran as well. You heard that too? Randy? It just made me cry. I mean, I sat there and listened, watched her cry, and I said, fuck. Why don't these liberals understand? think she'll be voting for Biden, Democrat. That's right. Even Tampon Tim, he didn't fight though. He served. I give him credit for that. Oh God. Do I think NVIDIA earnings will be good? Yes. They're going to be buying that new chip. I bet you they have a lot of back orders. Wow. Willie John. Willie, is this you from high school? Willie. I remember that afro you used to have. And you used to always grab your balls. Remember that? Had a black friend named Myron. He had a big old afro on him. We'd be around girls and all of a sudden he'd be rubbing his crotch. And God, I said, damn it, man. You ain't going to pick up no chicks like that. Right in front of him, you're rubbing your crotch. Let me teach you a few things. First thing I did is got him a haircut. I'd take him dancing and he'd be out there in the middle of the disco floor and all of a sudden you'd see him over there rubbing his balls. Perfect. Look at that. Right to the penny. How did you get that number, Jim? That was the SPX. See that? See that? You could have stopped there. I could have put it right there, but nope. I decided to put there. You know why I put it there? Because that is a pivot point. And that's the bottom of the pivot point. Here's the top of the pivot point. That's the top of it, and that's the bottom of it. That's a pivot point inside of this here pattern. That's about an equilibrium. So I got out of that trade right when we hit that double bottom. I was really happy to get out of that trade at the double bottom. I didn't want to get stuck in another one. 160 bucks. They probably are. But we did it. Mama, I'm excited. I'm almost out of breath. See, I'd hit that support level on my SPY. Right to the penny. Just a little bit shy of it. Took it right to the bottom of that candle. Finally got out of that. That felt good. Now we're down to 80 cents. I ain't going to be looking at it much anymore. TSM. Is that? No, that's that Taiwan semiconductor. It's not the one. Golly, man, look at that. $40 bounce on that one right there on that knife we had a couple weeks ago. We already had the pullback and that flush with head and shoulders. You got a snake on Meta. Apple can come down to the 200 and maybe hit right here, but we'll put an alert right there on Apple. I don't think I'll trade it though. Unless we start to consolidate. It's double buying. There's still that return. I'm going to see if we reverse here. That's the 200 SMA, folks. I made a ton of money using just that one moving average. Is my initial target to get there. I get out, I move on. $200, $200, $200, $200. See, everything pulls back to the 200. 200 on Apple. We got the 200 here on Meta. We got the 200 here on AMD. So if they fail that means we come down more. There's still more room to come down on the indices. No, here comes that Santelli.
To a pretty good or a couple of pretty good weekly unemployment claims reports and a good but not gangbusters monthly retail sales number and a pretty good Walmart earnings suggests to me not that everything's great, but that we really did hunker down and have low expectations or really were kind of saturated in this idea that July showed a faltering consumer. So I think that's what it is. You kind of overshoot in one direction and then correct.
I like what you said at the very beginning there. Nothing else broke.
Yeah, exactly.
Yeah.
I mean, I never reason to think so. But there were some real exaggerated moves in so many respects. Many people have recited this, but the S&P Volatility Index.
That's the one.
It went above 60. You know, it's interesting because even that was this weird phantom number at a blink in time. Yeah, the math that calculates the VIX was there, but nobody could sort of trade at those levels. Nonetheless, above 35 it closed. It goes down to below 15 now. Pretty much its fastest deflation of volatility, expected volatility ever. So it shows you that underlying it, okay, earnings came through fine. There's still this kind of baseline demand for stocks, corporate buyback, all that stuff is holding it together. Continue to think that at the highs, which by the way, 1 month ago today was the record high, July 16th, and you know, you're down a little bit from there, but semis are still down a lot more. An ongoing rethink of all the high momentum stuff that got us to those highs.
It feels to me a bit like a continuation of the post-pandemic theme that nothing's working kind of like it's supposed to, which is fine, but that's why they're markets. If they were predictable, we'd all be billionaires. But even with the economy, all the leading indicators that were supposed to work haven't worked, and it keeps being. It's just.
Honey, it's easily to predict.
From a couple of weeks ago. So the intensity.
I could teach my grandma to trade this market.
Humans panic really that much. It really
I could teach a 5-year-old to trade this market as long as they can count to 3, Kelly.
That we're essentially saying we think things are going to stay calm, and then once they're no longer calm, you race to the exit. So
1, 2, 3, Kelly.
That particular storm is over. It'll probably take incremental bad news on the economy to get us to retest those lows, and you're still in a weird seasonal period. Though.
To the 200.
That's true.
475.
Because our next guest says the market and the economy are in a sweet spot, but could be setting up for potential disappointment. Let's bring in CNBC contributor by phone, Greg Branch. He's also the founder and managing partner of Branch Global Capital Advisors. Gregory, welcome. Good to have you here. Why do you see us setting ourselves up for disappointment? What are you pinpointing there?
Well, I think
Debt
it harkens
war.
back to something Mike just said. It's not that something broke. It's that we were suffering under the facade that something had broken. And so a 4.3% unemployment rate.
God damn, he talks like Kanata.
We've had it the month before. The Fed had always projected that to embed a 2% inflation number, we needed to get to around that. A jobs number of 114,000, again, shouldn't have been that alarming. We saw 0 basis points growth in core over core for May, 10 basis points core over core for June, which compares to 30 and 40 for the months before that, which we naturally should have implied would have led to a low jobs number. And by the way, we had seen 150,000 in October. And the last thing that people were throwing out to say that the world was ending for those few days was an ISM manufacturing number of 46.8. Again, while contractionary, shouldn't have been all that alarming, particularly when you factor in the services number of 51.4. Yet, we had those vociferously calling for emergency rate cuts, which, by the way, if you were doing that 10 days ago, you should probably be still doing that today. Nothing has really changed, and if you thought that was necessary then, why not now? And the reason I worry is because we got a glimpse into how the market would react if we had a real deceleration, and that wasn't it. Is it going to do so mildly? Sure. I think the consumer is stretched. We have data to suggest that, and I don't think that they can embed this inflation without something of a deceleration from here, and we saw how the market's going to react to that when it starts.
So what I think I hear you say is that here were some incipient signs of what a real slowdown might look like. Rising unemployment, slowing consumer spending, and we got a taste of what the market reaction would be like, right?
That's right.
But
When
there
we
has
have
not
some
been
action.
But since then, as Mike pointed out, a lot of the numbers have been relatively more benign Consumer retail spending was pretty good. The CPI was okay. Walmart's doing okay, man. People spending money. So a lot of that worry has dissipated, it seems. Greg, are you there?
I agree, and this is why I say, and what we said. Yep. Hello, can you guys hear me?
Yes, we got you.
You guys got me?
Yep.
Okay, and so I agree, Tyler. This is the underpinning of why I moved to neutral about 6 weeks ago. Is we really have a sweet spot right now. You know, GDP growth doubled into the second quarter. It's projected to rise slightly again in the third. We have the best earnings growth we've had since 2021. But that unemployment number, particularly if the Fed elects to leave it there, and I think they will. I'm in the minority. I'm often in the minority. I don't think they'll cut in September. They don't have to. The retail number, like you said, bounced back in a big way to 1% for retail spending. But nothing's broken in this economy right now. And we are reaching a point where we have some price stability. I don't think they'll risk that newfound price stability with a rate cut, particularly when they failed to have price stability for 3 years.
I think you're absolutely right. You are in the minority with respect to whether there be a rate cut in September or not. What, Michael, would be the reaction of the market if there is not a rate cut in September? Because, boy, it sure looks to me like the market's pricing one in.
Well, not only is the market pricing one, but it seems like the center of gravity on the committee, based on their comments recently, is moved in the direction of we've set the scene for this. We have enough assurance about inflation that we think it's time. Now, presumably that's going to be 1 week from today, Jay Powell's message at Jackson Hole. I say presumably because if you just look at their framework going into all this, as many have said, right, here's where they said inflation was going to be right now, and we're below it. And the Fed funds rate is way above the rate of inflation, is way above the neutral rate, is way above the 2-year note yield, is way above every other indicator of where perhaps would be a normal rate. So they're going to characterize it as normalization, not as accommodation. That's been the case for a while, that they feel as if, hey, we're restrictive now, we just have to...
Opportunity. These are right now in metals, in my opinion. We're looking at.
They say the same thing over and over and over and over.
So that is a massive opportunity, in my opinion.
We hit the 200. Jimmy called it.
Miners are likely the way to play these going forward. So
yabba dabba doo.
Of names like
Randy,
Rio Tinto. Are names in mining that I personally
200 SMA.
You can do great with an index as well and leverage somebody else's expertise in finding names. I think healthcare's got a lot of great opportunities as well, especially because AI is bringing some innovation in. And so, you know, as I'm looking at different healthcare names today, I have a name for you that's Veritex Pharmaceuticals, VRTX. You know, this organization is an innovator in what are specifically like significant issues that people are dealing with, and they're trying to find, you know, sort of the needle in the haystack. AI is really going to improve their efficacy in this, I believe. Now, there's no dividend in this particular player, but their profit margin, net profit margin, is 38.5%. So I think that that's a very healthy operating expense ratio, and I think that that innovation is really leading them in the right way for that. And then Rio Tinto as well is going to do well with AI because they're really an accumulator of different projects, and they put teams in the mix of it. But they got a 6.2% dividend right now, and so I think that's a great name with a 21.5% net margin profit. So, you know, these are a couple of names I think are solid. You know, you're certainly going to be seeing, you know, the treasuries being okay places to go right now, specifically on the short side. You know, on the long side, as we're seeing the rates come down, that's gonna see some numbers too. But here's where I have the biggest concern, and I apologize for taking a second to say this. Yeah, and that is this. When we continue to print like this, I believe that it's putting our credibility as the world's reserve asset at risk. And I believe that the 10-year treasury is being questioned right now. That's part of the reason why gold is as high as it is. And so that's a big concern for us because we have the printing press and our wealth is essentially based on this fact. So anyway, we'll continue to watch these things develop. Nothing's today.
Yeah, look, the national debt is a big story here as well, so we'll continue to follow that. So I got your picks. You had Hecla Mining, and that's in the silver realm. Rio Tinto. You like the AI play there with Rio Tinto and Vertex Pharma with the innovation. Thank you, David Strzeski, CEO at Sound Planning Group. Coming up next, Options Corner, you know who's next. That's Tom White. Standing by, and will highlight unusual options activity from the day and how investors are looking to trade on recent news of JD.com, Barrick Gold, and Macy's. We'll be right back.
$0.99.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. Tonight, hosts of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. Let's welcome in Tom White, host of Fast Market here on Schwab Network. He's taking a look at JD.com. Some of these Chinese stocks have been getting a bid. You're looking at a bullish trade that you found on JD. Tell us a little bit about it on the day where it's up 7%.
Yeah, we've seen a little bit of a resurgence in some of these China stocks. Some of the data that's coming out of China has been improving, right? As far as the consumer side, the retail sales number was a little bit better than expected. And then if you looked at the news out on JD.com today, got an upgrade out of JP Morgan. They put it to an overweight from a neutral. They put a price target on at $36 from $33. They said the shares have reached an inflection point at this juncture, and that they have a competitive edge. If you looked at their earnings that they released recently, they beat on EPS, came in a little bit lighter on revenue, but they did beat that year-over-year number. While the majority of their revenue and earnings comes from the online e-commerce business, their logistics business actually did really well last quarter. So they're banking on more of that as they expand. And I think this is a story about the health of the China consumer, which has been lagging, and growth rates have been coming down for the last 6 to 12 months. But we've seen some reversals in some of that data. Stocks now flat on the year, which is a bonus. George Soros, his fund, bought JD.com in the Q2. That was just released on their 13F. So it's getting a little bit of a lift here to JD.com. And I think the option traders are taking heed of that, because we saw some buyers out in the September monthly cycle, so 35 days to expiration. Trader bought 6,000 of the 30 strike calls, paid an average debit of 68 cents. So the break even for this trader after putting this trade on is 30.68 over the next 5 weeks. It's about 5.5%, 6% above the current share price in there, with call volume about 4 times normal daily average volume that we've seen over the last week of trading. So yeah, piling into calls here expecting that some of these China stocks are going to continue to rebound. Even though JD did get the upgrade, it got a couple of price target cuts today. Alibaba got some price target cuts, but this trader believes that JD.com is going to still continue to move higher over the next 5 weeks.
Look, I see JP Morgan with a $36 target. You were talking about that upgrade. And I can't believe about this AI talk about how much it's improved and cost savings. In fact, posted 92% increase in profits, which you mentioned, but I just can't get over what we're seeing here with this kind of growth. I mean, that's pretty amazing. So there you have it. That is JD.com. Next up,
there you have it.
Moving higher with gold
Best damn dog man ever had.
new highs this week.
His name was Jack Rabbit. So we're going to play that song. This is a song that I used to write songs with this guy. I didn't write this one. This guy named Bill Pasalakva, about a dog.
I had a dog, his name was Jack Rabbit. Throw him a stick, throw him a bone, he'd jump right up and grab it. Run like the wind, jump like a deer, there you have it. Best damn dog a man ever had, his name was Jack Rabbit. My dear wife named Big Nellie, she'd laugh so hard she'd shake like jelly. She'd send Jack Rabbit to the grocery store with $1 in his collar and sometimes more. I had a dog, his name was Jack Rabbit. Throw him a stick, throw him a bone, he'd jump right up and grab it. Run like the wind, jump like a deer.
There you have it.
Best damn
Dog man ever had,
his name was
Jack Rabbit.
Well, you see Rabbit run, say, give me Jack. Count to 10 and he'd bring him on back. He could run a death spread through a holler log. He was half blue heeler and a half hound dog. Well, I had a dog. His name was Jack Rabbit. Throw him a stick, throw him a bone. He'd jump right up and grab it. Run like the wind, jump like a deer. There you have it. Best damn dog a man ever had. His name was Jack Rabbit. My first boy we named Red Jimmy. He'd throw up a stick and say, jump Jack, gimme. And that dog would grab it out of the air. He took first place in a county fair.
I had a dog, his name was Jack Rabbit. And we'll throw him a bone, you matter lapping rabbit. Run with the wind, look like the wind, there you have it.
Best damn dog a man ever had.
His name was Jack Rabbit.
Dog a man ever had.
His name was Jack Rabbit.
Dog a man ever had. His name was Jack Rabbit.
Bill Pasalakwa. You motherfucker, you got them turned off. Huh. I haven't seen him in years. We entered a dancing, not a dancing contest. We entered a band scramble. And we were the Soggy Bottom Boys. I've won probably 22 times in the band scramble. Nobody can play the washboard like me. This thing right here, that's a cookie can made out of I called it Stella. See the two holes in it right here? And I had a pickup hooked up to this. It's called a weed eater base. And then you can get the keys are on the neck. This is all handmade. There's my ukulele and my Taylor. I got a Martin. I got a banjo. I got a mandolin. They're pumping target. We're kind of at a reflection point right here, a pivot point. 144.34. Failed triple bottom. It'd been a couple weeks.
CSG Systems, company that takes a look and helps telecommunications companies with system software, services, all kinds of things to make their day better, make things move better for the clients, for the company, data and such. John Ray is with us, Vice President, Head of Investor Relations, Treasury and ESG reporting at CSG. Thank you so much for being with us. Ticker symbol CSGS. Folks can look it up at the same time. In the meantime, tell us a little bit about the company so people definitely know what it's about.
Yeah, thanks, Nicole. We appreciate the opportunity to chat with you about our company. So CSG Systems, we are a SaaS software company that helps our customers solve their trickiest and most challenging business problems. We primarily provide solutions for three distinct issues, and that's complex billing, customer engagement, and payments. Now you'll find our customer base kind of spread throughout different industry verticals, but we focus on the communication service provider space. So think cable companies, telecommunications companies, wireless companies. That's kind of the core of our business. But then we also help support financial services like JPMorgan Chase and various industry verticals. So that's kind of the high level overview of CSG.
Yeah, understood. So as you're doing this, how do you think the quarter went?
Yeah, we thought the quarter went really well. I mean, we have some very exciting news coming on the back of our very strong 2023. performance in over 20 years last year. So it's always tough to kind of follow up that act. But we were able to raise a number of our key guidance metrics in Q2, including our profitability and earnings per share. At the same time, we really gave this vision of future growth with respect to new logo wins. So one of the more exciting things on the call was our ability to put a slide in our earnings deck which showcased the various new key logo wins that we won all across the world. So on that list, you'll see some household names like Comcast. We signed a new extension with respect to a new business solution that they're providing that we had previously not served. And then when you kind of look elsewhere in the world, we're able to sign contracts with the likes of Telenor Denmark, one of the leading telecommunications companies in that country, Lyse in Norway, Telstra in Australia, One New Zealand, which is formerly Vodafone New Zealand. So it was a really strong quarter on a number of fronts, and it's always great when you can raise certain guidance metrics halfway through the year.
Yeah, without a doubt. And right now it's trading at $46.95, folks. How about some of these acquisitions? Tell me a little bit more about that and how that fits into the company and the bottom line ultimately.
Yeah, for sure. So we were excited to announce 2 acquisitions in the first half of this year. It had actually been a while since we had done any sort of acquisitions. It had been about 2.5 years. So specifically with the 2 that we were able to acquire this year, the most recent one was a company called ICG Pay. That's a payments company that is a perfect complement to our payment solutions that we already had existing. So we would kind of view this as a great tuck-in acquisition that allowed us to get into specifically
Spy wants to move up.
on the payment side of things, insurance. So they had a great customer book in terms of insurance companies that they were serving, and we just think it's a slam dunk in terms of an acquisition. The other company that we acquired as well earlier in April was the same sort of thing, where it was a perfect complement to our customer engagement suite of solutions, primarily focused in the insurance space as well. So we were very excited about these. They're relatively small, but at the same time, we got them at attractive multiples, and we think they're the perfect complement to what we're doing in our core business.
Yeah. You know, as I look at this and I see the 5,800 plus employees, 112 countries, so you certainly, and you mentioned Norway and Denmark, and it just shows you the footprint that you have and how much you're growing, and working with great companies like you mentioned telecom. But you know, I think about Charter, Comcast, Dish Network. You have Airtel in Africa, for example. Are you working on new partnerships every day?
1, 2, 3.
Because when you think of the global scope of how we're able to serve some of our customers, in each country, there's probably 4 or 5 different telecommunications or cable companies that we could serve. So absolutely, and that's how we're able to sign and land all the wide variety of new logo wins like we announced to do. It's because the hardworking CSG employees that are on the ground having those conversations, you know, with our customers and our potential customers. So absolutely, it's a day-by-day sort of engagement that we have on that front.
Yeah, what do you find the customer experience, these customers of yours, you know, what's the feedback that you get for the most part, and is there anything that they're looking for that you need to step up and create for them, because there's a demand for that too? I mean, and where does AI fit into all of this?
Yeah, so they're really coming to us because they're having problems with their existing systems, whether that's with one of our competitors or they have an in-house solution that really just isn't working anymore. Where we have found increasing success is when we're able to pair together our entire suite of solutions. So for example, we can take our core kind of complex billing, which is the bread and butter and really the cornerstone of what CSG is, and we're able to bolt on our solutions on the customer engagement side of things. What we are finding, all of our customers and potential customers, they are starving for a better customer engagement suite of solutions, which simply means they're looking to find better ways to have a better relationship with their end customer. So with our solutions, we are able to kind of embed those within the solutions that we launch, and that's exactly what the marketplace is looking for. They're not looking for compartmentalized solutions. They're looking for holistic suites of solutions. And the customer experience is so front and center. And that's something that you've heard us talk a lot about with our Exponent suite of solutions, SaaS-based, and we're winning across multiple industry verticals. With respect to AI, it's a great question, and I heard the conversation you were having about 10 minutes ago with one of the presenters. We are seeing success in AI effectively on two fronts. We think of AI and how it can help us internally, so looking at systems, ways of doing business, ways of just being a more efficient organization, and that's kind of one way that we're kind of harnessing and leveraging the power of AI. But the other way that we're doing it is we're actually building go-to-market products that leverage the capabilities of AI, and we've actually launched our first AI-driven solution about 6 months ago. It's a product called Bill Explainer, which allows our customers help their customers to head off kind of that bill shock that you may get, especially if you're thinking about a cable or telecommunications package. These tend to be, you sign up for 12, 18, 24 months at a discounted rate. And then after
She's breaking it out.
Customers get bill shock. And that is one of the biggest points of churn that our customers are trying to solve for. So with our Bill Explainer AI, we're able to use AI-driven technologies to help identify those customers that may be
I don't trust it.
susceptible or coming up for that potential bill shock experience and kind of head that off at the pass. So 2-3 months before they actually get that elevated bill, perhaps we engage with them. We say, hey, would you like to have, a different package? Is the package you signed up for still the one that you want? As a reminder, you signed up for this discounted package, 6, 12, 18 months ago, and you're going to be going to this new elevated price. So really, we are trying to harness the power of AI on both sides,
You scammer.
internally and externally, and we're finding some initial success there.
All right, John Ray, great to see you. CSG, thank you for being with us. We really appreciate it, and a lot about, obviously, what you do there with the billing, payment, engagement, and AI. Good to see you. Until next time, thank you.
Thank you.
Yeah, we're going to charge you more, man. We got a great opportunity under this Harris administration.
So, mortgage rates have dropped. In fact, they dropped to the lowest level in more than a year. Saw a lot of rate financing. What does this mean for the housing?
We had the same thing happen during the Obama years. Prices went up big time, but not like this. This is different. This is a lot worse. A lot worse. I heard him last night on the radio screaming, "We passed the $1.5 billion bill, you beers. I did it. You damn laborers. We passed the bill." Coming at you like he's going to attack you. He couldn't sit up there and say, "We have come to the conclusion where we have made saved money for the elderly." I don't have to yell at you to get my point across. And we're not saving you one bit. We're actually behind the scenes paying for it. We're subsidizing them for this pill. We said we give them more business if they just lower the cost a little bit. Unfunded liabilities, 218 trillion. It was 65 trillion during the Bush years. Medicare keeps going up because we got a bunch of illegal immigrants in here now. Social Security liability, 27 trillion in red. Like I said, 36 by the end of the year. We'll get there. Liability per citizen, $646,000.
Managing Director at Dolly Lens Real Estate. So glad you're both with us.
I am too.
There's been a lot of excitement because I had, and I know
Mother-daughter.
Lower, but you know, a couple of weeks ago, someone said, "Oh, we're refinancing," you know, and I saw we went from 675 to 650 roughly, and I know they're lower than that now, but there was a lot of excitement because they finally moved. Right, we were stuck for a while, right? Dolly, tell me where we are now and what does it mean?
We're 6375-ish. It's a good direction. It's not good, but it's a good direction, right? Because we're going from over 7 to low 6s.
Sure.
So it's pretty good. It's almost a point.
And 86% of homeowners have a mortgage that's 6% or below.
Is that a man or a woman?
78% have 5% or below, so it's not quite enough to make a huge move, but like Dolly said, we're going in the right direction, and hopefully this golden handcuff problem that we always talk about will be relieved a little bit because people will be able to move.
Right, a lot of people are just locked into their mortgages and they say, I'm not moving, I'm not selling, I'm not doing anything, I'm going to stay here until the end of time. Yeah, right, until something changes. It feels like that, doesn't it? It does. Because, I mean, the whole thing was that there was going to be more supply and then that was going to help affordability. And where do we stand on that? I mean, there's been some more supply. Is it really helping, though?
Well, someplace like Florida, where we have the new, DeSantis law, that HOAs have to be up to date on building fixes and reserves.
Yeah.
So, how much have you gone up from 8,500?
So in Florida, there were 8,500 listings in Q1 of last year, and now there are 21,000 listings.
Oh my God!
Yeah,
Right,
in 3 counties.
right. So the problem is that prices have gone up so quickly.
Right.
HOAs are more expensive because, like Dolly said,
The DeSantis law.
Yeah.
right? And you have mortgage rates are high, right? So all of those people are saying, "Wow, I can't even afford to live in Florida. Insurance costs have gone up."
Insurance, forget it.
Yeah,
I can't afford my own home. Right. To move. That's the reason for the tripling in listings.
Yeah, and look, housing starts not particularly a bright spot,
No,
right?
not a bright spot.
There
Builders are
was
not a
some
bright
hope.
spot.
What?
Yeah, builders are generally are not a bright spot.
Yeah, originally it was the builders building new homes, and it was exciting, and they were able to sort of finagle
Make a
the
deal.
mortgage with
Yeah.
you.
Yeah.
But now, what's
Sentiment
going
is
on?
right.
Why
So-
is the housing market stuck when it comes to housing starts and new homes?
It's confidence.
It's really builder confidence and buyer confidence. Right. They're getting their leads from buyers, and buyers are saying, you know what, I can't afford to do this.
Right,
I'm
and
gonna wait.
home building sentiment is definitely down. That's a change. Even though companies like D.R. Horton are up 15% in the past month. But still, I think it's a confidence thing. I think it's the election. Uncertainty is always a disaster when it comes to housing. When you're buying your biggest, your largest purchase, you're not exactly going to want to spend all this money when you don't know what's going to happen.
Right.
So.
Right. I mean, when you think about the home builders,
Like we might get nuked.
so many of them, but 5, 6 of them that we follow closely. Do some stand out more than others?
I think D.R. Horton stands out the most. They're as I said, over 15% up this year.
Because some are more luxury, some are more multifamily, some are,
I think they're more the sweet spot of the 400,000, 500,000 mid-price range.
Right.
And I think that's the reason they're a standout. I think the luxury ones aren't the standout at this point.
How are we doing on the pricing and affordability?
I mean, it's still not good. In Florida, as we said,
The median prices, you were looking at that.
They went down 4%. But
it's not enough because they're up 28% since COVID overall.
Right.
So this is again the wait and see period where hopefully prices will come down, like we said, because when listings go up, supply goes up. Hopefully prices will come down a little bit, but it's going to be a wait and see, in our opinion, until the election and until things cool off after that.
You have the median home sales price right now at $412,000 as one of the most recent prints. But the big picture is everything seems to cost so much. And now we're going to have a change in the fee structure, something that has been discussed for a very long time for real estate brokers. What is that and why does that matter? Does it matter more if you're a buyer or does it matter more if you're a seller?
Definitely matters more if you're a buyer, because buyers may now be on the hook for an additional 3%. So they may be asked to pay for the buyer's broker side. So traditionally, it was 5, 6, whatever percent it was you negotiated.
Right.
And average across the country was a little over 5. And half went to a buyer's broker, half went to the seller's broker.
It was a simple sort of...
Right.
But the seller paid.
The seller paid.
Yes.
Right. And now, it may be the buyer being asked to literally pay out of pocket, not part of the transaction. So they now have to have 3% more dollars or 2.5% or whatever they negotiate than before in cash to pay.
It was in an effort for transparency, but in our opinion, it's less transparent.
Yes.
Because people don't know what's going on.
Yeah, they're not going to know what they're going to get, and it's another legal form that you have to deal with.
Yes.
And now, before you even buy a house, you're going to have to shop your broker that you're going to go around and look for houses with.
Exactly.
And maybe sign a touring agreement or a buyer's agreement. It becomes confusing, and people don't like to sign things. I know I don't.
Right.
Like I read everything I sign.
Right.
So it's just not good.
No. And look, they may get a less qualified broker who says, look, I'll take you around for buying.
Yes.
I'm wonderful, but I only charge 2%, 1.5%.
Yeah.
Or you're
may
stuck
be
with
the
them.
worst broker.
Right. And you could be
So
stuck with
it's
them.
sort of, this seems like a consumer affairs sort of issue. I mean, but it's something we've been waiting for. But was this the way to do it? What was the better way to do it? Is there a better way to do it?
I think the better way to do it was to have left it as it was before, where it's buyer and broker share, and perhaps I don't have a problem with signing documents saying, look, I'm the buyer's broker, I'm your broker. Here is what I'm charging.
Right.
Here's what I get paid. I think it's very reasonable for the buyer to wonder, what am I getting paid to tour them, right? I think that's very reasonable, and I think it wasn't readily disclosed, right? So I think that should have happened, but I don't think now with the forms and this and that, and people will be confused.
It's going to be confusing.
Well, it actually comes into effect, I believe, tomorrow.
Yes.
So we'll see how it rolls out.
Yeah. And then, I also think about New York City. That's a high-priced city. How are we doing here in New York City?
Well, New York City does not have a requirement because of REBNY. Does not have a requirement to sign a buyer's brokerage agreement or touring agreement as of now.
How are we doing with the selling?
Oh, sorry.
And buying.
Oh, with selling,
what's the buy?
It's the high end is doing okay, meaning the 5 million and above is doing okay.
Right.
Treading water. What is a big change is foreign buyers, which were really big in June, suddenly have disappeared. Foreign buyers have completely disappeared. There was 1 in 10 purchases were foreign buyers in 2014, 10 years ago. Now it's 1 in 50. Think about that.
Which is
Right.
huge. All those dollars aren't coming in, and we really did rely on our foreign buyers.
Yeah.
And it's not only us. We talked to a big restaurant.
Yeah, you scumbucket.
We love to eat out, and they said literally,
You're guilty selling probably
all of these foreign buyers aren't
real estate to China.
And meanwhile, I saw some recent news that Vice President Harris, presidential candidate, had
Americans don't have the money.
in her economic plan to include giving some first-time
Not with this high inflation.
$25,000 up to $25,000 in down payment support. That could be interesting when it comes to the housing market as well. We're sort of out of time, but
definitely.
we'll have to leave it there.
Yes.
Thank you.
Thank you so
always.
much.
Dolly
Thank
Lenz,
you.
Jenny Lenz of Dolly Lenz Real Estate. Great to see you both always. Still ahead, our panel will discuss big box retailers. Walmart, Blue Wave Investors, new all-time highs there. Target next week, Lowe's next week, much more here on the Watch List. We'll be right back.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern. Available anytime, anywhere, on any device.
Watching the SPX.
Only on the Schwab Network.
We could come down here to 55.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds.
We could. We got a kind of a megaphone. We got an inverse head and shoulders. We could get a sharp sell-off and hit this bottom part into close. Right at 55.48. Or we could double bottom and hold. So we put it raised up just a little bit. Trading alert. August 16th. Okay. Let's get this a little bit closer here. 125. August 16th. Strike 560. $125 to $140, $150. There's your 150 right there. There, boom. $125 to $150. $160. Take it. 180. 185. I'm going to take it here. I don't know. Fuck, this might run. No, there's a 1, 2, 3 out. I'm going to get out here. $220, damn it. Three white soldiers. There you have it. One of them, two bits, and a freebie. Exit idea when you see them. Did you get that, Senior? God. 260, 295, 320, 340. Hello. Wow, 125 to 340. That'd have been $2,000. 2,300.
Trade brilliantly with Schwab.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics...
The futures sell-off was made for, did. And so we're heading into the bell here with everything higher. Not by a ton, but after the ground that we made and the distance we traveled and the VIX that we fell, it's a pretty good week, especially on top of last week, which was also, not bad, considering that all the pain was last Monday, basically 2 weeks ago now. So we've spent essentially 9 days, like 9.5 days, going pretty much straight up. This week will definitely, or this month rather, will definitely be remembered most particularly by perhaps not the magnitude of the VIX boom, but the speed at which it came back down. Something we talked about here yesterday afternoon. So the volatility index right now, just shy of 15, speaks volumes. I think that's kind of the most important thing when assessing the market here today and this week. It's just how quickly we normalized, and generally normalizing means going up. So after we got the massive vol spike, we just continued to bring that in and achieve some more equilibrium in the market. Dollar notably lower today. So here's what's interesting though, is some of the moves that brought us to this point have gotten a little bit more kind of mixed up, and that's where this week did get interesting, because when you think about the strength of the data, that's what stocks needed, but it's also shifted some of our relationships that folks were trading for a long time namely the idea that bad data is good for the markets, that you want to root for Fed cuts. So I think the last couple weeks also kind of served as a learning lesson that these aren't things that you want to root for. But it also makes the trading relationships from here kind of interesting, given that the next big event is the Jackson Hole conference and Jerome Powell. Look at the dollar chart to kind of get a sense of what I'm saying. Because the dollar coming down and yields coming down, the market welcomed. But then when we had the bad employment, obviously that didn't work out as well. So the dollar was crashing 10 days ago while stocks were crashing, yields were down. Since then the dollar has stabilized, yields have also stabilized and risen. So that's important. That means that the stock market now wants to see good data. That's good. It's nice to see that kind of normalization come back in as well, a traditional relationship. U.S. stocks go up when data are strong. The U.S. dollar firms up when data are strong. Yields do the same. Stocks enjoy higher yields. That's a more traditional trading environment, but it does present us a few different challenges going forward, namely that the data need to keep holding in strong. So we really did connect the stock market with the economy in a way that I feel folks still maybe don't appreciate because it was so disconnected in some ways. A lot of folks describe the big tech run-up and the super concentration around AI and the index as stocks being disconnected from the economy, which is kind of true in some ways, kind of not in others, because those were the companies that generally are the backbone of where there is growth in the economy. But this is more kind of a holistic, broad market movement. Notice we've been getting NASDAQ up and Russell up, NASDAQ up or down and Russell down, the reconnection between different indexes. You're not getting that split market anymore. That's basically the entire market agreeing that what matters the most right now is the economy, is that you want it to hold in. You don't want to have emergency cuts. You don't want to have this massive downshift to save the economy. So that does mean going forward, I think we should probably be looking for more volatility on basically every economic data print. So the dollar holding its range there, despite having a generally bearish bias, kind of represents all that in my mind. Today, Bitcoin bounced back. Yesterday, it was out of the action and was down while stocks were up. So today, you're kind of getting a little bit of catch up there, maybe for BTC. Also, the defensive trade is somewhat present in today's market. It's not quite as gung-ho. The strength is obviously more limited. The size is smaller than yesterday, but what's also important is that yesterday was very broad. It was high beta, but it was also value and quality. It was a really great rally in every way. Today, you've got the anti-beta factor actually doing the best, which is more kind of a defensive factor. But here's the thing. The most important company still, NVIDIA has been chilling above $120 all day. I thought that was maybe going to be a level to give it a little pushback to NVIDIA, but nope, we got right through it. So just another box to check for a good week overall. I got Jenny Horn here with me, host of Next Gen. Talk about the week that was, get us going into the bell here. We're in pretty good shape, Jenny. It's not quite as aggressive as yesterday, but who's complaining?
Okay, who's complaining when you look at the S&P 500 winners of the week? I mean, are, first of all, outpacing the losers by magnitudes, of course. I mean, with this week, but the winners are so specific, which I think is what's made this week fun as far as like the stock pickers market. This feels like it's become. You got Starbucks as the leader, so up 26% this week. Super Microcomputer up 23%, Nvidia up almost 19%, Ulta Beauty up 17%, and then Micron up another 16%. So that's a pretty good rally. Chips and those specific. I mean, like this was also the week of the 13X.
That's true. That was a big deal because tech was the best, but right behind it, performance-wise, is consumer discretionary.
God.
That's really key. I feel like this was kind of the week of the consumer.
It was the week of the consumer. I mean, think about CPI, PPI, retail sales. That was another major theme of the week that I think puts us in a very interesting position to Jackson Hole because we're so catalyst light right now. I feel like we cling on to every economic data point we get because there's so few right now. It feels like happening in the market. We're just like looking for volatility.
Okay. Really consistent throughout the week. Not a lot of pushback from this. The 13Fs were interesting too because I do feel that the overlap there with some of the retail stuff like Pershing and Nike, Ulta as well today. A lot of these stocks like got this kind of jet fuel a little bit. Some already had some like Nike really needed it. But to see big investors, to see these folks put their money on, the status of the consumer, the potential is pretty encouraging.
I think especially for Nike too ahead of, because we still have earnings from them. I know they're like a month away at this point, but I think that I was looking at Nike, and we were still off of highs, all-time highs by over 53% here, but you need a few more weeks like this. Like you need right now, and if we're going to like claim any sort of recovery, I need to see more of this momentum continue. I still have like a lack of faith in some of these names. I mean, Ulta was one that was our high flyer of the makeup train, and then it just completely disintegrated. So, and I mean, some of these winners today, you have Bath and Body Works, you have Tapestry, had objectively a mixed picture from their quarter, but they're having a phenomenal week, and I feel like I'm cautious on some of this momentum though, because it's like, I don't believe in retail right now, it's all created equal. Walmart, to me, that rally makes perfect sense. You're expanding and like grocery market share, you're continuing to improve your margin story, you're dominating as far as like these earnings goes, and I think you're showing that you're a safe haven. I don't know if that's the same way for some of these other retailers that are also rallying. Like
yeah, no, I hear you on that. It's a good point. It's a fair pushback because a lot of those were just making lows. Ulta, Nike, I mean, even Tapestry, which was okay on the year and had a pretty good run up off of lows, still has got like such a difficult road ahead integrating the deal and stuff. So yeah, some of these look like they fall into the value category, but whenever there's a value description, one could also argue that maybe it's cheap for a reason.
Right, and that maybe these investors were picking up shares for a reason. And also, it's backdated. So, like, these were all holdings that were through June 30th. So,
sure.
I think, like, we don't even know what the holdings look like as of this quarter, which just, I mean, it's following, like, the money trail of big investors. I get that. But I think that retail still makes me a bit cautious because we're all of a sudden all clear on the consumer, but that was not the narrative last Monday.
Yeah, totally. So, it was a big dose. Like, all these things came together with the beat for the retail sales, sentiment solid. Some of these 13 Fs really was like, the way so many things combined in a negative direction on the previous 2 weeks with employment and all the other stuff, and this was like the opposite. You know, we're like the sell-off had all these things kind of cooked up into it, yen carry trade and all this other stuff, and then this week was like you had all these different examples of good news from different places, mostly consumer focused. Like, how much better could it have gone?
I know, really, how much better could this week have gone? I feel like, unless you're maybe Chipotle. But
right, that's true,
about
Chipotle.
That's about it.
Yeah, Brian, that's true. Brian Nickel, I forgot. Have we noticed any difference yet?
So, okay, everyone was telling me that the portions are going to get smaller now.
Right.
They've gotten smaller at Chipotle. But
it's Starbucks.
I did my channel checks. I went to a Chipotle this week in due diligence. The portion was huge.
I have no idea. That to me is still the most confusing story of the year. Where it came from.
TikTok.
Who? Yeah.
Kids
the biggest fake news ever.
I know.
So now, like, they think that Starbucks portions are going to be small because now this guy's like the small portion guy. There's no way. That's like not what Chipotle is.
Chipotle is like the best value deal you can get.
It's crazy. Yeah. All right. If anything, Starbucks is going to start running. Okay. Thanks, Jenny. Appreciate it. All right. Fun stuff this week. Let's bring in Sam Stovall. He's Chief Investment Strategist at CFRA. Keeps real close tabs on the market. Sam, so this week, I mean, are we right? Kind of seemed like a great combo of a lot of things compared to the last 2 weeks, which is a combo of a lot of bad things.
Oh, absolutely. Well, I think the market was really gearing up to rejoice your birthday today. And so...
there you go.
Multiple days of positive performance. But when you look back to the bottom that we experienced on August 5th, all sizes, styles, sectors are in positive territory, along with 94% of the 155 sub-industries that are in the S&P 1500. So we're not just going back
off the 200.
Magnificent Seven being the sole.
I think what fails would come down here.
Very positive participation.
That's so big, right? That we kind of moved away from that. It took a little bit of pain. That whole fake rotation definitely burned some folks, but you want to root for the broad market. It's kind of what we wanted all along.
Absolutely, and certainly people were shaken up by the VIX on a closing basis, up more than at 38, after having been closer to 14 just a few days earlier. So a lot of people sort of wonder, well, if we're at that high, then it implies we're likely to fall even further. But I did a study going back to the inception of the VIX in the early 1990s, and there were 6 times that we closed above 37. And interestingly, but of those 4, whenever we were within the -5 to -10%, we did not go any deeper. So typically we got the nervousness out of the way very quickly. And so 4 of those 6 times, and the other 2 times we were down 10.5% and 16%. So typically this kind of a very sharp spike in volatility, sort of an indication that, like ripping off a Band-Aid, it's done pretty quickly.
Sam, how much have the earnings helped to also kind of stabilize some of the expensive stuff when you combine the drop we did get in some of the AI and big momentum winners? Has that played a big role or no?
It's played some of the role. I mean, we were trading at 38% premium to the S&P 500's 20-year average PE on forward estimates. We were trading at a 78% premium for tech. Tech got down to about 46%, and the S&P itself fell into about the mid to low 20s. But we're back up, obviously,
this is
because
cool.
of the price gains that we've been seeing, with the S&P up now 7% since.
Vance has got a German Shepherd. We have decent this dog is. Well behaved. It ain't like Biden's. Biden's dog bites. Bites the staff. He had to get rid of it. Just like his children. Crackheads.
So you've got fundamentals.
Both of them. I'm sick and tired of not hearing that she's not a crackhead.
August and September, during presidential election years, have actually seen improvements in their overall results.
Okay, so seasonally usually not good, but election year maybe a little bit better. Look, so far, I mean, we had a pretty big event that's getting swept under the rug. So maybe we took all that historical, weakness and squeezed it into like a couple days. Sam, just to come back to the earnings side for just a moment, given the point you started with about the breadth of the market, the fact that earnings are expected to grow bigger for the value cohort seems like something worth revisiting, talking about here.
Yeah, well, that's true. I mean, when you do look specifically at 2024, value stocks are expected to post a 14.5% gain in earnings, but the S&P 500 growth component down 7.2. Yet we see sort of a flip to that in 2025. We're going to be seeing the growth group come up about 5.4% in 2025. See the value stocks still growing by more than that, up 13%. So I think value just has a lot of catch up to do based on the growth that we had seen for quite some time in the growth area.
Wow. So that the concentration of the growth stuff into a few names kind of skews that number a little bit. Also, though, the rate of growth for these companies also seemed to have peaked a couple quarters ago, at least for some of the AI stuff. Like they're still growing, but at slower paces. So then I guess
Okay, we're retesting the snake.
For the AI stuff.
We're to the 200. I want this.
Semiconductors being the poster child for AI.
We could bounce here, but I want this.
2% in this second quarter.
This is what I want.
They were up
I'm going to get it.
8% in the first quarter. They're expected
Rodney.
to be up 48%
We're waiting.
for 2024 and 42% for 2025.
Rodney.
18% in 2026. So, you just the comps are going to get harder and harder, but they're still double-digit advances.
Yeah, it's still the biggest ones out there.
Yeah, I might not get it.
Sam, anything else from here to the election seasonally? Historically, it seems like we've got more positive outcomes than negative. It seems like.
Right. Well, the market is up about 0.5% since July 31, and you know that from July 31 through October 31, a positive move in the market has traditionally signaled that the incumbent person or party will get reelected. A decline has traditionally pointed to a replacement. So right now, I think that
so we're a percent higher.
Say that again.
And right now, the conclusion is we're 1%, 1.5% higher, right?
Yeah, just squeaking through. So
That's
right
a fun
now
one.
it favors Harris right now. We've got a ways to go.
Yeah, that's a fun one. Okay.
You're not too bright, sir.
Need to have a good little nugget there for us. Thanks, Sam Stovall.
All right, birthday boy.
I appreciate that.
They said the same thing about Hillary. Hillary was going to win by a landslide. They just kept on and on and on and on and on and on. I mean, they were celebrating before she even got turned down. They're saying the same thing. These guys are, I'm telling you, they're liberals. And I don't know about this station, but the other one, he was.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. The Schwab Network.
She's a woman.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know, Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Do, do, do. 20 after. And we're waiting, waiting and waiting. Drop it. There we go. Get ready.
Perspective into full view. Real-time example trades.
Get ready.
Of trading insights. I'm Tom White. I'm Kevin Higgins. Catch me on Fast Market. Weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. I'm Oliver Rennick, joining us to talk some C-suite shakeup and the role of a couple big stories from this week, like Chipotle and Starbucks. Jerry Sneed, private wealth advisor at Procyon Partners. Is that like a astrological, astronomic thing? What does that mean, Jerry?
Yeah, good guess. Exactly. It's a navigational star.
Oh, okay. Did I say it right? Procyon?
You did, absolutely.
Nice.
Here we go.
You guys are pretty keyed into some of these.
Here we go.
Shake-up. Tell me why. Are these companies that your clients are interested in? I know you advise on big high net
Come
worth
on.
mostly.
Yeah, with Starbucks, we've been invested for quite some time through a few of our managers, so we've been kind of following the story. Obviously, you've seen recently the
Waiting.
decline in operational efficiencies and earnings power on the Starbucks side.
Waiting.
Not as Victoria's Secret, we just think that's a
125. I can buy 5 now.
important stewardship is to these big
Right at the same price.
Now, we were talking earlier.
5.
There's a rumor going around. I guess the word is that Brian Nickel is going to make the items at Starbucks smaller because people are blaming him for burrito sizes. I don't know if you caught that whole TikTok thing a month ago, but as a consumer of Chipotle, I found it to be very untrue.
Yeah, I didn't see that story particularly, but it's no secret. Brian's an operational aficionado, and he's hyper focused on efficiencies across the board. So much so, a few quarters ago, he told his employees not to eat the chicken in their employee meals because he wanted to save it to sell to the customers. So.
Okay, maybe there was some truth to them shrinking up on the sizes. I mean, he just moved market cap over. There's not a lot of examples that we've seen where a CEO just brings market cap from their existing company. Do you think it's
Could get out of 145.
for Starbucks? I mean, the market basically traded it like this man is their hero.
I mean, I think he is the hero, right? And I'll take the 22% pop this week in the stock. I think you're getting the immediate lift from the belief that he can fix the online ordering system and the customer loyalty, which to us is the two biggest challenges that's facing Starbucks to date. To give you an example, I was speaking with a woman yesterday who actually designed the first app for Starbucks in the loyalty program. They were trying to figure out, how do you entice the infrequent customer to come in more frequently, but not over reward the people that are going to continuously go no matter what. And so imagine that's your situation coming across his desk, and you have to figure it out. And mind you, it's not one location, it's regionally across this country, across the world, different demographics, different buying habits, etc. That's what you hire this guy to do, and hence why you got a $100 million paycheck to come over.
Whew, yeah, not too shabby. I'm with you really. I mean, I feel like Starbucks already has kind of been a little bit underappreciated. I feel that they have worked their way into the daytime menu as a staple. Could just be me, but I mean, it's hard.
You could get out right here at 140, 145.
Really underappreciated for them. Like, I feel like that's taken market from McDonald's to some extent.
145. 145.
I think you basically do with it.
Yeah, I think there's a massive opportunity on, rewriting the ship. I think that a lot of people are not talking about what he did with the food safety concerns at Chipotle coming out in 2015. He took over in 2018. I think Starbucks has a reputational issue as well that he needs to address. They stand for certain things politically and maybe a little bit more aggressive than they should. And I think he's got a big thing to fix there on that side.
Okay. All right. What about, did you follow some of the big active investors this week, the 13F stuff? Is that interesting to you as C-suite movement?
It is. I think I'm a big fan of Paul Singer and LA management. I think he candidly got lucky with the Starbucks one because they just built a position a few weeks ago. I don't think he had any inside knowledge into this change or facilitated it by any means. So I think that's quite interesting. I think their position in Southwest Airlines, I think is a real interesting move. I think that's a brand and a business that when you have margin compression, all of a sudden there's not enough meat on the bones to make investors happy. And so I think there's a lot of operational improvements that need to happen.
Ooh, what happened there?
I'm curious to see how LA helps them out.
Okay. Last point, one other CEO shift from this week that we actually haven't really talked about here on the show this week was at Victoria's Secret, bringing over a high-ranking member of Rihanna's line, right?
Yeah, Hillary Super. So this one to me is more interesting than the Starbucks story, just because it's kind of.
So you had 3 white soldiers here, an extension pattern to the upside.
And she has real challenges. Stock was up 30%.
I sold them there. If I'd held them, that'd have been another $1,000.
Versus $100 million. And to me, she has a bigger job to do than Brian does. But she has mall traffic issues.
Watch this candle here.
With inflation, loyalty issues, brand awareness, and tons of competition. I think this is going to be the story to watch. If she can
120.
Years of experience, I don't think you can buy it after 31% move in a week, but I think this one maybe is on your shopping list. Or at least it'll make a good case study for an MBA program.
All right, cool, nice, good take, good stuff. Jerry, thanks for the commentary.
Thank you. Happy birthday.
All right, there we go. The dominoes falling. All right, good stuff. Well said from Jerry Sneed there, private wealth advisor, Procyon Partners. All right, let's talk some levels. Let's talk gamma. Let's talk options. Heading into the bell. 34 minutes left. We're going to get a ramp and we're going to get a fade. Right now, it couldn't go either way. Haven't really been able to just take off today, but we haven't seen much from the bears either. Mostly just kind of steady hovering in place after the dip buying from the morning. Maybe that's just what we had there today, and that would be a success. We got Kevin Green coming up as we head into the last half hour here. S&P's at 55, 54.
Now watch it.
No politics.
We could drop another one.
Available anytime, anywhere, on any device for free. Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex around the clock.
We broke the 9.
Even when equities markets are closed. So no matter what or when you want to trade,
You're up 15 cents.
tools, curated education and insights, and trading specialists ready to help, however complex.
140.
With a wider range
145. Do it again.
trade brilliantly with Schwab.
You ready?
The market with Schwab. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com and on all of your favorite streaming services. Schwab Network available anytime.
155.
Any device for free. Schwab Network. Accelerate your market knowledge and shift your perspective into full view. Real-time example trades.
Whoa, don't hide it.
I'm Tom White. I'm Kevin Hayes.
Hickey.
On Fast Market. Weekdays
I'm Kevin Hickey.
Fast Market. Ready to go at 12 p.m. Eastern on the Schwab Network.
I love to make money to the 200 to the 63.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique
What the
algorithm.
fuck, man?
Buy it as is or customize to align with your goals.
Come on.
All at your fingertips.
I can't put the.
Investing themes, 40 customized
There it is.
themes, up to 25 stocks in just a few clicks.
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly? It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. Welcome back to Market on Close. We've got 30 minutes left here. Stocks a little bit softer than when we started the show. Kevin Green joins us to look at some options flow. All right, nice little rhyme there, KG. Good afternoon, sir. What are we looking at here?
Well, we did see a little bit of a development when it came to the open interest, so that's actually nice to see. We actually saw some rolling up from the 5550 calls yesterday up into the 5600 calls. So we've been just continuing to see the stair-stepping activity taking place, and right now we are seeing a little bit of resistance at 5550. We kind of talked about this yesterday.
Yeah, we did.
There's a lot more activity. There's a lot more flows or dealer pressure at those levels. In particular, 5550 up to 5585 or so is where we're going to have some trouble. Now, if we break through 5585, then it probably is going to be clear sailing to 5600 here, Oliver. On the downside, once again, I mean, we don't see a lot of movement. 5500 is always going to be on our radar here until we can actually fully break up another 75 points to the upside. And then 5400 is a negative gamma level. We're not seeing puts really rolling up, not a lot of put activity in general here. So I think overall, this is a really good market. We talked about it yesterday. We're at a point where you want to be able to like have a little bit of compression, right? We're out of that negative gamma territory. We're in positive gamma territory. We have compressed markets right now. Grind it higher here a little bit, and that's going to be a win for us. Be able to prove these levels can hold.
Kind of seems like if you were to write it in a book exactly as you'd want it to go down, that's the way it's gone down this week, right? Like every level that we rolled up to on the call side, we eventually reached. It was just kind of this stepwise sort of magnetism, higher.
Yeah, actually, pretty much every open, we actually broke through positive gamma. I think today is actually the first one where we did not open above that dealer pressure level to the upside, really creating these short squeezes that were taking place here. And that's also probably complementing the price action that we've seen today, which is, it's been decent, but I'm already hearing people saying, oh man, this is a boring market because we're only up 10 points today. This is actually a good and healthy sign that we are able to either to at least sustain these levels here. One thing that I kind of want to highlight, just from a volatility standpoint, and I know we'll talk about going into the close here. From a volatility standpoint, we're still at a scenario where it's actually relatively cheap on a seasonal basis. So even if we continue to see the VIX going to maybe a 13 or even a 12 handle, that's kind of out of the norm if you're looking over the last 20 years or so. And if you're looking at the S&P 500 options expiring on Friday of next week, where we had Jackson Hole, which could be a risk, Oliver, they're not that expensive. If you look at it, it's only around 0.5% of notational value. The implied move right there, if you actually bought the straddle, is about 1.5%, give or take a couple of percent. So it's actually relatively cheap. So the reason why I bring this up, we don't provide any advice to anybody, right? But we bring it up because before we saw that vol spike last week, no one wanted to hedge. And now you kind of actually have a little bit of an opportunity
again, baby,
the seasonal trends of volatility to see maybe some cheap hedging opportunities that might be available for traders if they so choose. And so I wanted to just kind of highlight that the yellow bar there, that's sitting between 13 to 14. If we get to that, I would say that would be really outside of the norm, or more like a 2 standard deviation move outside of the norm for this type of, for August and September when it comes to volatility. Or at least volumes.
Yeah, it kind of fits with the time frame we were looking at with Sam Stovall at the top of the show too, kind of pre-election wise. It's going to be really important. Nature of vol kind of coming back in, and keeping that perspective, as you mentioned, that when we blew up, folks are okay. Oh, I wish I vol, or I wish I was hedged, and it came back down so fast that it seems we should kind of remember that mindset that when you are at 65, okay, maybe that's an aberration. But whatever was under the surface, did it completely go away to the point we're going to go down to like VIX 13? I mean, because it looks like that's like what it's trying to do right now, and I'm not sure that makes a lot of sense.
I'm right there with you. Actually, I'm a little bit surprised that we actually cracked the 16 level to the downside here. So yes, it does appear that the market's really not concerned about volatility.
Month-long average, right, is still like we're now almost on the lower side of the month-long average.
Yeah, and if you kind of look at that trend, so starting from now going out into the end of September, and I hate using percentages when it comes to the VIX, but you do see around an 18 to 20% increase in volatility just for the VIX itself over that time frame. And so once again, we're outside of that band right now. Now we had a really massive ramp up. We had a massive ramp down. I think it's actually the quickest removal of vol in the markets that I know that I've seen, and I believe on record, if I'm not mistaken. So we just wanted to kind of highlight that. We're actually seeing pretty cheap volatility. If you look at those, the at-the-money SPXs for Friday of next week, they're going for like 33, 35 points. Once again, not a recommendation, but highlight 35 points on a put. We were doing 90-point and 120-point days pretty much every single day this week. So just some perspective there to see what that value is.
Yeah, that's where today is kind of like, in many ways, sort of the best outcome, to have a more calm day, really just crush the VIX and hold on, to the gains that we made. As far as volume pickup, the other stuff you've been watching, KG, did any of that come to fruition?
For volume here today, Oliver, it's actually very light. It's probably the lightest volume that I've seen on an OPEX this year alone. I mean, the top contracts last time that I checked was sitting at around 50,000, maybe have cracked the 50,000 level for the top contracts for expiring today. That's not a lot. Compare that to yesterday and the day before, when we were reaching 65,000, 75,000 for the top traded contract. That being said, are we looking for a melt up or melt down? I know that's your favorite question. With that light of volume, it just doesn't seem like you're going to have that massive gamma squeeze to the upside or downside. In fact, we're kind of looking a little bit weak. Really rejecting off of this 55-60 area right now. But we did see some call buyers getting into the 55-60s, selling the 55-70 call spread, and then put sellers selling the 55-60. So they want to see a ramp, but I'm not sure if we just have enough volume to be able to push those dealers to be able to get there. If not, we have that balance area sitting a little bit lower than where we're at right now, 55.42 is going to be your balance area for today, meaning that would be pretty much your dealer net neutral spot.
Got it. All right. Love it. Helpful. Seems like most likely we kind of have a compressing close rather than like in a big expansion, big blowout. All right. We'll see you at the bell. Thank you, Kevin Green. Excellent analysis. of the options flow and the positioning this week, of course, over the past week, giving us the levels to look for, and we've been pretty much grinding to each one. We've been laying out every day. So good eyes, Kevin Green. All right, coming up. Let's talk some of the other stuff. Going to take a look at gold's just continued success. The thing doesn't stop. Bitcoin caught up today too, though, so we had a little bit more of a different type of risk on today than yesterday. We'll talk about those as we head into the last 20 minutes here. The stocks catching themselves from a little bit of a dip, so a bounce back after a kind of slide about 15-20 minutes ago.
Do do do.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends. All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Networks.
Schwab Network's like no other financial media you watch because it's all markets, all the time. It's 100% finance. We look at everything as traders and investors, and everything we say, everything we do is through that lens. There's no ulterior motive, and there's no subjectivity. There's no random guesswork about what we think. We are following numbers all the time relentlessly. We have the best CEO interviews, hands down. They're longer, more thorough, and tailored specifically to our audience. We never take our eye off the ball, which means we're always ahead of our peers.
I've got the FBI monitoring these calls, so I hope we get your ass.
Trading at Schwab is now powered by Ameritrade, unlocking the power of thinkorswim. With robust charting and analysis tools, nailing endless customization, and up-to-the-minute news and insights. Trade brilliantly with Schwab.
All right, let's talk some Bitcoin, let's talk some gold and other stuff. Dan Deming, managing partner, KKM Financial, here to keep us rounded and balanced. Dan, a good day for gold, even better one for Bitcoin. Needed to bounce back after going AWOL yesterday.
Yeah, absolutely. And you and I were talking about it earlier this morning how Bitcoin was under some pressure, and now we're seeing a nice ramp up as we move towards the weekend. And yeah, I mean, just shy of 60,000 now. For it to really break out of
AT&T had a breach. I don't know, a couple months ago, 3 months ago, and I've had nothing but crank calls ever since. I'm so pissed off at the AT&T. I had AT&T service for 6 months, and I just could not stand it. It was horrible in my area. cell phone. I was with Verizon for many years, and I found out when I got this phone here that I was on the grandfather clause or something, some kind of special deal, because I've had Verizon for over 20 years. And I forgot why I got mad at Verizon, but I think I was trying to get a cheaper bill, and it ended up not being cheaper. And it was horrible service. I was living out in the country. Ever since they've had that breach.
If you look out on the, if you forecast for, look forward, it's just some of the general trends in the marketplace that you would expect if, rates do come down, then you would expect the dollar to be.
And of course, I had to keep the same number.
As rates come down, gold becomes more attractive in two fronts, cheaper dollar as well as less competition from interest rates. And so those things are definitely a tailwind for gold moving forward. And then you got the uncertainties from a geopolitical standpoint, and then the constant discussion about how the debt's going to be managed moving forward. Now, I guess lower interest rates would, in theory, help support some of the debt issues, but again, it's still not declining. Debt's not going down; it's only going up, Oliver.
Okay, yeah, very true. Okay, so gold versus Bitcoin. I guess we're learning to do different things with the charts looking so different.
Yeah, I mean, gold is more established and continues to show that it is the more, preferred, I guess, choice for risk diversification, and again, having something that is counter to the U.S. dollar.
Okay, my alert was triggered.
It's still in its evolutionary stage, and even as it continued to become more and more a part of the
SPX again.
allocation models from an allocator standpoint, you'd say that it's still not the mature asset class, and that the metals are that gold has shown, and until Bitcoin becomes just easier to use and easier to I guess quantify and value, you're going to have these ebbs and flows. But I do think longer term, the technology is the key there, and from the technological standpoint, that's what's supporting Bitcoin and probably will continue to moving forward.
Okay, and overall, getting back.
We got a double bottom
Threshold for Bitcoin
right here.
technically above or below that kind of has a.
I think this is it. We got to see here. This has got to be it.
Absolutely. Sentiment as well, Oliver. I mean, yeah, you can play the different facets into that.
What's the call?
Price action, and
50 cents.
I like to look at the markets, in different tranches as far as technicals, fundamentals, and sentiment. And so if you do see that $60,000 mark, that shifts the sentiment in the market psychologically, and then and if we do hold here and take out 63,000, then you could look on a short-term chart pattern that you got higher low. So that would be something also to possibly keep it moving higher.
Seems like in the crypto world, it's a much more painful trade in Ethereum since the ETF.
It could drop all the way back down here. I didn't even think about that.
So far, yeah.
That'd be zero.
That's still,
Damn it.
That's in its infancy, so that, I guess over the years, Oliver, I've been in this business for almost 40 years now.
20 years.
But I've seen the ebbs and flows of flows into different products, and some of them that have made it, some of them that haven't.
I've been here 20 years.
It's still too early to really
Let's get together.
How that will unfold, because I think the driving force is the technology and the way that it's, the way it can be used moving forward, and there will be some winners there. Now, if it's Bitcoin or Ethereum, we don't know, but there will be some winners.
This here might not work.
As far as digital currency moving forward.
Next week, Dan, what's top of your list? When you
Could come back down here.
Monday morning, what are you going to be watching? Yen? Dollar?
If I don't get, if we don't.
Well, apparently so. Bank of Japan backing off. It appears to be like they got their bluff called, but we'll see.
Tweezer bottom.
I mean, that's always a possibility. But what am I going to be looking at next week?
Could have.
The Fed. I mean, we got a lot of Fed speak. We got Fed minutes on Wednesday. You got Jackson Hole on Friday. So to me, that's going to be a big theme next week.
All right.
There's your third crow.
Thank you, Mr. Deming. Have a great weekend, sir.
Thanks, you too, Oliver. Appreciate it.
Should have had it right there, 30.
KKM Financial. All right, when we come back, we're going to take a big picture look at the week.
There's 50. There's a fast scalp here. I'm going to get out of here with maybe the hair of my skin.
But we did lose NASDAQ, so S&Ps are going to have to work extra hard for it now as some of that tech stuff turned red.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network anytime, anywhere, on any device, for free. Schwab Network.
Neil, how's my favorite client?
Neil.
Question, Carl. Can you offer me the same choices as Schwab? Choices? Yeah. At Schwab, I can get full service wealth management.
Fuck, that made a fast decision to the upside.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this. Gotta run.
10 more minutes left.
Have a choice in how you invest with Schwab.
There we go. Break it. Break.
Trading at
It's not working too well here. I might just get out.
Giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Not gonna do it.
How you invest with Schwab.
Welcome back to Market on Close. Let's talk about what we learned from the Treasury market this week. Expectations for Jerome Powell around economic data and how.
A little bit too close to the end of the day, I think.
Cooper Howard, Director and Fixed Income Strategist at Schwab's Center for Financial Research, with us here this afternoon. Cooper, great to see you. I'm starting to think in terms of Jackson Hole now on the calendar. How about you?
You know, I think I never want to jump ahead a week in life, but I think that's going to be the big event next week. I wouldn't be too surprised if Chairman Powell uses that as the opportunity to tee up a rate cut. Now, we all know Jackson Hole is very beautiful. It's very well known for its hikes, but I'd very be surprised if anything about a hike comes up. So I wouldn't be too surprised, though.
What about the Bears?
I'll stay away from the Bears, though. I'll stay away from the Bears. So I wouldn't be too surprised also, though. He uses that as the opportunity to tee up a rate cut. We have heard from some Fed officials already that they are comfortable with a rate cut, so I would be very surprised if we don't get one in September, though.
Okay. How do you think he sets it up? What does that look like to you? What's the language? What's the hint? How explicit?
I think that he'll probably say we have seen more good data on inflation. We know a couple months ago that was kind of the key line that they had teed up. But we want to see more good inflation data. We haven't seen more good inflation data. So I wouldn't be too. I would expect that they would probably try to bring that up, that they are more comfortable with where inflation is trending. Also, probably they're bringing up the labor market, that's coming better into balance. We've heard from Fed officials that they have been saying that the labor market's coming more into balance. That brings up kind of the other side of their dual mandate. So that's what I'll be expecting.
Okay. And getting comfortable with the path of inflation, does that mean 25, not 50? Do you think Powell will make it clear what that first move magnitude should be?
I don't think he'll make it clear about what that first magnitude should be. I think what they like to do, and what you've seen in the past, is they want to keep their options open. Just in case something between now and then really kind of surprises the market, I think they want to keep their options open, not tip their hand. Now, our view is that they'll likely go 25 basis points. I think that it'd be a little bit of a surprise if they do 50 basis points at this point. Reason being is that we're not really seeing the economy fall off a cliff. So we've seen this week that retail sales, they held up fairly well. Inflation is trending down. We saw that in PPI, CPI. So the data this week, Oliver, really signaled to me that the narrative is relatively intact. So I think that that's why they'll probably
this one didn't go too well.
To this and likely do 25 basis points.
Okay. Cooper, the data, how compelling did you think those numbers were for this week, especially when weighed next to the NFP that got the market freaking out? Did we get enough secondary data points to break us even kind of on the weight of that NFP miss from last month?
Yeah, I think what's interesting is that if you were to close your eyes and wake back up from where we were on the NFP miss to where we are today, really not much in the way of the yield curve has shifted all that much. Now, some expectations of what Fed policy has done is likely shifted a little bit. But I think what we saw this week is, again, that the soft landing narrative is relatively intact. And we've seen a little bit of a tick down in the Atlanta GDP number, but overall, it doesn't appear as that the economy is falling off a cliff. Our view is that it is slowing, so that should bring yields down a little bit. We have the view that we're going to be in a bull steepener, meaning that yield curve should move lower, led by shorter term yields moving more lower than longer term yields. So I think that the data so far this week, it was good in the sense that it didn't add on to that non-farm payroll miss.
Okay. This is a good point on the yield curve to come back to. We were getting the bull steepener, the kind of classic end cycle, Fed's got to act thing. And then this week, in the last 5 days, we got a little bit of a bear flattener as those 2 years moved pretty quick to price away from the extreme emergency cuts. So, market okay with that, you think, Cooper? That's not like us getting worried that the Fed's going to be too sticky?
You know, I don't believe so, Harm. I think that as the market gets a little bit more comfortable and a little bit more clarity on the path of rate cuts, that's when we would expect to see short-term yields move a little bit lower. So what we've been telling clients, Oliver, in that sense is that staying too short is a risk. So once we start to see the Fed cut rates, we would expect that yields on short-term investments, whether it be short-term CDs, treasuries, money market funds, cash-type investments, things of that nature, we would expect the yield to continue to move lower on those. So for clients who are sitting on those types of things, what we've been telling them is consider using moves up in yield to extend out on the yield curve just slightly.
Okay. As far as credit, as far as quality goes, Cooper, anything in the game plan change over the last, call it 4 weeks now?
You know, I don't think so much has changed now. Off that non-farm payroll miss, we did see credit spreads increase quite a bit. They've pulled back a little bit since then, but if you look relative over the past year, spreads are relatively tight right now. So we do have just a neutral view on the high yield market, the investment grade corporate bond market. But given the tightness in spreads, we think that it is a little bit of a difficult balance to get that adequate compensation in those markets there, Oliver.
Okay, all right, good stuff. Thanks, Cooper. Appreciate it.
There we go, baby.
Recap of the bond action this week.
And it's zero.
Fixed income strategies, Fitch Loans at Center for Financial Research. 2.5 minutes. See you at the bell. Good luck.
With the
Took a loss on that one.
chunk of trading here. Russell 2000 and the Dow doing the best. We're all back green. Let's just keep them 4 for 4 here into the bell.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Accelerate your market knowledge.
And shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes.
Oh, well.
Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar,
Okay.
some drums.
Wow, so many choices.
Yeah, like Schwab.
Could've went
I
up.
can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know, Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Schwab Bank Investor Checking. The checking account built for investors, named highest in client satisfaction by J.D. Power for...
What a week. What a week. What a week. Yesterday I had a red day for the first time in a long time. And I came in today encouraged a little bit. Kind of played it a little bit more slower. Didn't get too excited. I was nailing it. First yesterday, 1, 2, and then 3 I got slammed. And it lasted all day, and I was just going, oh, God. I had a chance to get out even, and I did not do it, so I blame myself a lot for that trade. Could have got out even. I said it even. I said, exit, I'm getting out, but I didn't do it. Then right after that, when I hit my resistance, well, she drops. And probably rushed that last trade. I shouldn't have probably took that one. I looked at the clock and I said, oh my God, 15 till. That wasn't too bright. So I'm going to get out of here and relax. Been real tired today too. That was probably a big help. Had to take a nap. I feel like I'm going to take one now. Watch a few videos and get queued up on Kamala. Oh, I gotta go. Ha! I'll get ready to do my video things. Woo! I'm gonna watch a few fights. Everybody hit the like button. Huh? I'll get ready to do my video things. Woo!